obviously I did have a fallback, and a lot of people don't have that. But I never really thought about the fact that I might have to fall back, like having that certainly, deep inside made me feel better, but I didn't want to ever doubt myself. And I think that's kind of almost a necessary thing, especially in a performance-based job. Like you really can't doubt yourself, or, it's so easy to just fall into really bad habits.
So you funded an account to trade futures. Was that with $2,000 or was that with a little more?
No, I think I literally had the minimum amount that you could to open up an account.
Okay. So you started trading futures intraday full time. What kind of success were you having at that point?
So it's interesting, and this is why when I look back, like I think it's been a really crazy time. Like if you started trading 2 years ago, just look at the markets. Like if you pull up SPY or the NASDAQ or anything like that, the past 2 years since 2018 have been, interesting for financial markets. The week after I started trading live with my own money, the VIX crisis happened. So, volatility started to really expand for the first time. 2017 was one of the most historically non-volatile periods that we've had in history. And all of a sudden, in 2018, the volatility products explode and we get this huge sell-off. And I watched that live. I was living in an apartment with a couple of buddies of mine, a couple of fraternity brothers. And we were all kind of huddling around the screen when they weren't in class, and they were trying, to watch what I was doing and see whether or not I was going to make any money and stuff like that, because they didn't really understand what I was doing. And maybe I didn't even really at all either. But that day, I remember watching the markets just collapse and thinking in my head, okay, I really have no idea what I'm doing. So maybe it's not the best time to, actively start trading this money. So for the first couple of weeks following that, I really don't remember making any money. I don't even know if I made any trades, because the ranges and the SPYs were, in ES were things that I had never seen. And, I'm talking to Tom, and I'm like, do you know what's going on here? Like, should I be involved in a market this volatile when I really don't even understand what volatility is? I don't know why these VIX products are blowing up. I don't really understand what's happening here. So, those first couple of weeks actively trading live full time with my own money, I don't really think I did much. If anything, looking back, I definitely lost money. Because I remember at a time, I made like a couple of trades, and, they didn't have the micro E-minis at that time. Every tick is $50. I'm sorry, every point is $50 in ES, for the $2,000 account. Everyone thinks about ideally you'd like to risk, 1 to 4% if you have really good risk management. So I'm risking like $100 to $150 a trade. It doesn't take that long to dwindle down a $2,000 account if you have no idea what you're doing. So, learn very quickly that one, I was completely ill prepared for the markets that I was involved in, considering I had only studied, historically low volatility markets. 2, didn't have a set system, was trading market profile, was trading off some levels that Tom would give me, trying to make inferences, trying to learn how to read market internals, the NYSE tick, the AD line, things like that, but never really understood what it meant to develop a system, have a playbook, have specific trades that I take that have statistical edge that I can back test, that I could build up a business around. Was basically just out there, slinging, like trying to make trades and trying to hit in and hit out and racking up fees, taking quick losses, getting upset at the fact that I was failing and not really doing well, and quickly realized that trading full time on my own was going to be extremely difficult with the amount of capital that I had. So I'd be sometimes trading on a Robinhood account, trading options, but everything was all kind of around trading, the SPYs and the overall market. Hadn't really dived into trading individual stocks because I never learned how. Right away, what Tom taught me was, if there's anything to learn, you should learn the most liquid market because it's infinitely scalable. You could drop in and out of, tens and hundreds of contracts. If you just think about how many points you need to make a week, how many points you need to make a month, you could scale it up by contracts. Everything's risk reward, no dollar amounts. It all sounded very structured and regimented. And I think for a new trader, one, that's necessary. And two, I thought that it would be really easy to all of a sudden just get in. Like, oh, I only need to make 2 points a day in the SPYs. And the next thing you know, the range, 2 points a day in ES. And the next thing you know, the ranges are opening up 20, 30, 40 points intraday. And I have no idea what I'm doing. And I'm, taking 2-3 point losses all over the place. Next thing you know, that account that was 2,000 is, under 1,000. And the margin requirement for ES futures is like $500. So I'm like, oh, I can only take like 1 or 2 more losses and I'm not going to be able to do this anymore. So I had to start, infinitely looking for more ways to leverage the small amount of capital that I had. It's not like, I saved up a bunch of money before I tried. You hear a lot of stories about people becoming traders and having tons of money, or that they saved up from previous jobs, leaving their jobs and then starting a new career. I was a broke college kid, saved up money bartending. I was working 11 to 3, 11 at night to 3 in the morning, Friday, Saturday, Thursday, bartending, and took all that money that I could and, put it together and funded this account, and very promptly lost almost all of it. So kind of realized that, one, I needed to really learn what it meant to be a consistently profitable trader. I needed somebody to help me to capitalize. I had no money. I needed somebody to fund me. I needed somebody to teach me. And, I really just needed to be backed and exposed and in a situation where there were other traders who were making money. And that's, what eventually led me to SMB. Obviously, I had read Mike's book and was talking to Tom about, I want to do this full time. I've been doing it while still, at the end of my lease with all my college buddies. Everyone was moving on to graduate. My girlfriend, Annie, she was going to graduate. We're trying to figure out what to do. I know she's moving to New York. I'm from New Jersey, so my family's all around there. So I started looking for firms in the city. And, I don't think that there's any firm that beats SMB in the city. And I had already been exposed to, his book and knew what the firm was about, had watched videos on YouTube. I generally knew what type of program was going on there. I knew that this firm produced profitable traders, and I wanted to be one of them.
Okay, so you came to the realization that having a $2,000 account, which dwindled down to probably less than $1,000 very quickly, wasn't going to cut it, wasn't going to be enough for you to become this big shot trader.
That's right.
So you started to explore other options, one of those being looking into trading for a proprietary firm.
Right.
SMB you were familiar with. Did you explore any other options? Were there any other firms which you tried to apply for?
I didn't apply for any besides SMB because I applied here and I got the interview relatively quick, I think, to when I applied. And then, the process snowballed to the point where I honestly didn't even have time to think about anywhere else. I kind of just put all my eggs in one basket, which, isn't necessarily the best idea, but it worked out in my case, luckily. But I loved everything about what they were doing here. And I knew that they had a strong founding in education. This isn't the kind of firm where you come in, you buy in with, $5,000 or whatever you have of your money. The firm doubles your intraday margin or something like that. And once you lose it, they cut you. Here we take pride in the fact that we're looking to develop, the next 7-figure trader. So the firm covers downside risk. There's things like stipends to help you out your first year or two. And I was very attracted to the prospect of, working with a firm like that. So no, I didn't explore any other options because it kind of was a sweetheart deal for me. It checked all my boxes, and, I respected Mike, and I knew Dr. S was stepping into the firm. It was Dr. Steenbarger, who I know has been on the podcast as well before. So I knew that there was high-level talent here. I'd seen videos. My current mentor, Shark, does a bunch of videos. He's a 7-figure trader. So I knew that there was enough resources here that I could become what I wanted to become, and didn't really need to look anywhere else.
Tell me about the process from applying to landing a spot on the desk. What did that look like?
Yeah, so the way that we bring people on here is every fall we bring on the new class of developing traders. So I applied to be a part of the 2019 class. And once I got my application in, I sent in, a big, my resume and, all that stuff that you send in for jobs. And, included a cover letter where I just talked about how I had trading experience, had studied, under Tom, had, tried with my own money. I knew how market profile works. I have this big overall market understanding background. Got the interview, came in, and we did 2 rounds of interviews. The first one, I spoke with one of the onboarding traders. So, one of the traders here basically does the onboarding process. It's switched up over the last year, so I'm not sure who does it now. But I came in and had an interview with him. His name's Dan. And we were going over, my background, what led me to trading, why, this is what I wanted to do. Basically all of the things that we've gone over so far. And that was the first interview, which went relatively well. And then I moved on from there. I met a bunch of the traders on the floor. And the idea of the interview process is that it all kind of culminates with talking to Mike. Obviously it's his firm. He's the one who's going to have the final say. So the interviews with all the traders, I met some people, talked about what they did, and then got the interview with Mike. Now that I've gotten to know him, he was quite intimidating at first, I will admit. Had that interview with him. That went well. And then, had a couple weeks went by before I heard anything. But eventually I got an offer letter, essentially, through email that said they'd like to have me as part of the class. Came in September, and from then on, I've been at the firm. So we can talk about the exact process of starting out at the firm as well.
Yeah, let's get into that very shortly. I would just like to ask you beforehand.
Sure.
What were some of the questions that you were asked? Like some of the more important questions?
I think the most important question and the most important thing you really want to bring into an interview like that is whether or not you have trading experience. You don't necessarily need to have traded a live account, I think, to get a job at a trading firm, especially one that focuses on kind of developing you from the ground floor. We're going to teach you really simple setups. We're going to teach you risk management and things like that. But you always want to have some type of an edge over the rest of the competition. This is just like any other career. It's extremely difficult to get a job at a place like this. So you have to have something that sets you apart. So when you get asked the question, have you ever traded before? Do you have any type of live trading experience? If you can power out right away, a sheet filled of trades that you've made, in the past 3 to 4 months, you have specific setups that that you like. Those are the questions I think I responded to that really put me ahead of other people. I knew that I was extremely focused on the psychological aspects of trading. I wanted to leverage my own personality. I wanted to take advantage of my confidence. I wanted to really challenge myself and pick the hardest thing that I can do and strive to excel at it. So a lot of the questions were really centered on, do you have any trading experience? What really sets you apart? And, if you have really good answers to those, that can be the difference between you continuing to be a retail trader who might struggle and then, landing a seat on a professional trading floor.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news, IPO. Create your account platform and build confidence, risk-free.
Let's move into your experience starting out on the desk. So if I understand correctly, you were put on a demo account to begin with. Can you tell me a little bit about that? And also, I'd be interested to hear about How much guidance did you receive on what to trade and how to trade it, etc.?
Yeah, definitely. So kind of like the process here at the firm is you come in, you get set up on the demo account, and we have about 1 to 4 meetings a day as the developing class. We come in at 9 o'clock and we do a pre-market prep. We all talk about our trading ideas, what is in play, what could we potentially trade on the day. Then we come in at 11 o'clock, and that meeting is when you go over your trades that you made in the morning. 12:30, we do reading the tape, where one member of the developing class will show a video, a recording of their screen on any particular day of a setup they took, a trade they missed, a stock they liked, etc. Then there's a 1:30 meeting, which is, we call it the playbook, aptly named after Mike's book. And again, a developing trader will come in and say, all right, this is, an outlined, detailed version of a trade that I made. This is how I have edge. This is what I did. This is what I need to do better next time, etc. So that daily meeting process is definitely where the educational foundation comes in. We, SMB has a ton of videos that we produce and content that we put out that really tries to control the molding of a new trader. You come in and you learn, all right, how do we trade a stock that just had earnings? How do we trade a stock that just had a catalyst? How do we trade a stock that, is super extended from VWAPs, super extended from moving averages? Why are we trading this stock? Does it have a certain type of relative volume? What makes it in play? What's its average daily range? Things like that. So all of those little mechanical aspects of trading were taught to us at those daily meetings. We'd come in at 9 o'clock, and, early on, my risk manager, Carlton, who he runs the educational program for the developing traders, he would start us out and be like, okay, this is a really good example of something that you guys should pay attention to today. And for this week, we're going to focus on changing fundamentals plays. So we're only going to watch stocks that had earnings today or have some type of news catalyst, an upgrade, something like that. And those are the setups that we're going to focus on this week. And then after that, the next week or a week later, from that, you start a new setup. We're going to trade only high beta stocks, or we're going to only trade market plays. So there is some type of, streamlined structure that's been designed by Mike and designed by the top traders at the firm that kind of is designed to funnel you into good trading habits. The interesting thing that ended up happening with my class is right around the time that we were settling into specific setups, our attention was completely changed to focusing on those marijuana stocks that started to just go completely parabolic, because that sector got so hot that there was so much opportunity day trading that Bella, Carlton, the top traders on the desk thought that it was most important for the developing traders to pay attention to that. So next thing you know, we're coming in every day, trying, as new traders do, to say a good idea. It takes a long time to figure out what a really good stock looks like, especially pre-market. And we were just having our ideas tossed down. They're like, no, you guys need to watch Tilray today. You need to watch CGC. You need to watch Kronos Group. Like, those are the stocks in play. That's what we're focusing on. Until they reach some type of daily top or go completely parabolic, we don't want you guys focusing on anything else. So next thing you know, we really just had our time and attention encapsulated by these outsized risk-reward opportunities that really don't come along that often. So that kind of led us away from, I think, the traditional streamlined process. Like, I've talked to some of the guys in the class before me. They had like a very diligent way that they went through the training process on the demo. They specifically learned these setups. They specifically moved on to this setup next. They developed their playbooks, and it was all very regimented. But things just started getting crazy while I was on the demo with both the pot stocks and then the Q4 sell-off. Next thing you know, we can only focus on market plays. We need to be trading the ETFs. We need to be trading high beta stocks. That's what's in play. We're having these crazy ranges in the SPYs. Is the market going to go into a recession? Like, what's happening? Is this a bear market? All of a sudden, things really heated up. And that structured guideline that we had originally had when we first started out kind of fell to the wayside, and it was almost a learning from experience.
How long were you trading on demo for?
It was 3 months. So started in September, and then I went live December 10th of 2019.
Okay. And did you have to meet certain criteria before you were enabled to trade real money? Or did everyone come off demo at the same time?
Yeah, everyone came off demo at the same time. It's kind of a time-based thing. I think Carlton could have kept us on the demo a month longer if he wanted to. There wasn't really a set time. As soon as he felt that, we were coming to the meetings with good ideas, our review processes were good, we have all these stats. We upload our stats every day to a program called TraderView, which is, a great way to track your trades. I think every trader should be doing that, having some type of way to really quickly statistically analyze your decision-making process. So, we had 3 months of stats to look at. We all had a general idea. I think there were 7 of us in the starting class. We all had a general idea of like where our niche was. We had a couple guys who liked trading low float stocks, a couple guys who only traded earnings plays. I was trading a lot of like market-based things, high beta stocks, trading the market ETFs because they were so in play at the time. So I think it was kind of like a qualitative thing where Carlton realized that, it was time. Let's throw them on the demo and see what they can do.
And how did your stats look prior to trading real money? Like your stats from demo trading, were you seeing progress? And was that reflected in your theoretical equity curve?
Oh yeah, definitely. I mean, this is a running joke for me around here. I think on the demo, I was, successful to the point that almost thought that losing wasn't possible. Just because it got to the point where the market was so crazy, there were so many opportunities, and it wasn't like I really had any type of real money on the line. Mentally speaking, I think there's a huge difference between trading real money and having actual skin in the game and basically playing an arcade game. I'll buy a little more here, or, I'll sell a little more here. Oh, that was my stop, but I think I'm still going to be right. So maybe I'll just buy a little more and let it go. Because at the end of the day, you're not going to get stopped out. It's not real money. No one really cares whether or not you win or lose today. So I think some aspects of the demo really negatively impacted how I developed just because we weren't regimented in the way we were doing it. And then we went live and it was like deer in headlights. All of a sudden real money was on the line. The market was extremely challenging for even the top traders. And very quickly came to realize that, the demo is not really trading. It's important to have skin in the game because the emotional differences between both of those things are so categorically big that you really don't even realize it.
This is probably a good point to break down your equity curve from coming off demo to trading real money up until now. So if I understand right, you lost money for around about 7 months pretty consistently once you came off demo. Is that right?
Yeah, definitely. That's certainly right.
Speak to me about that. How come you were losing money? I mean, do you know the reasons why? Like looking back on that?
Yeah, definitely. So, what really ended up happening was I didn't have any type of consistent strategy. I was trying different things. I didn't know specifically where I was putting on risk. I couldn't tell you every variable that I needed to have in this specific setup. I wasn't trading things top down. I wasn't looking at daily charts and going all the way down to minute charts. I really just wasn't being sophisticated about the way that I was putting on risk. Was having a couple green days in a row and then I'd have a big red day. So it all really came down to my selectivity. I wasn't picking the right setups for me. Risk management, for those first 7 months, I'd argue I had terrible risk management. Was having stop out days. When you're at a firm, you have an intraday stop loss limit where if you hit that number, you're done for the day. It's obviously put there to prevent us from blowing up like, what happens to people all the time. Was hitting that stop limit, repeatedly, was looking for leverage, trying to trade triple levered ETFs, trying to have that huge first 4-figure day, really just did a lot of things that just aren't good habits for a consistently profitable trader. And it took me a long time to kind of get out of my own way and cut out a lot of the noise that I was doing and refocus, study my stats, look at what I really was doing well. only trade those things that I was doing really well. Recognize what really led to this being this kind of setup that I wanted to trade. Am I just throwing on risk here for no reason because I think I can make money? Is there some type of real tangible setup that I think has variables that are backing up? Is this a daily chart breakout? Is this, higher time frame technical level? Is there a real wind at my back for this trade? Is this a trade I've taken before? And I wasn't asking myself those questions for a long time. And, that's kind of just a product of there being a lot of things going on at a day trading firm. It wasn't like I was specifically focused on one corner of the market. When you're trading with a team and you're trading with a bunch of other traders, someone will throw out an idea and you'll pull that chart up and you'll be like, oh, this looks like a good opportunity. I'm going to throw some risk on here. It was kind of lackadaisical in, where I was looking to exercise my edge, and really didn't know where that edge was in the first place. And that was a product of thinking I needed to trade SPY because I was a market trader, trying to trade triple levered ETFs, trying to trade volatility products in a, arguably a pretty crazy market at the time, and never really getting a handle of what I could do that worked. Am I taking setups from my mentors who are consistently profitable? Am I really focusing on doing the things that work and not doing anything that I know doesn't work? Am I diligent in my review process? Am I aware of my intraday triggers? Do I know what gets me on tilt? So a lot of that introspective analysis just wasn't really happening for those first couple of months because I was so caught up with the fact that I wasn't doing as well as I thought I was going to be. And when you get into that kind of performance slump where it's not like I had a bunch of consistently profitable track record to fall back on. For a lot of really good traders, if they run into a slump and have a bad month or, a bad couple of months, they have some previous period of consistency to fall back on. As a new trader, you don't have that. So it almost feels like you're drowning and you don't really know what works. You haven't figured that out, or maybe you don't put in the work hard enough. So for me, it just ended up being, I got to a point where I said to myself, okay, I need to completely change what I'm doing. I need to only focus on the best setups for me. I need to really diligently plan out what those are. I need to talk to my mentors more. I need to be more verbal about, what gets me triggered and what really gets me set up to be involved in the right stocks.
Okay, so one of the things you just said there is that you realized that you should focus more on your best setups. But that's also very difficult to do when you've been trading for 7 months and consistently losing money, because I guess you're not really too certain what your best setups are. How did you approach that? How did you start to think about which setups gave you the most edge in the market?
Yeah, so what I was finding was I knew that based off of what I had learned from, my mentor here at SMB and from Tom, I had a general idea of what specific types of setups worked. I was either taking a bunch of setups that weren't even in that playbook in the first place, as far as there were certain market conditions that I would look to get involved on, just for clarity's purposes. Like there's a big negative 1,000 tick in the futures, am I going to fade that move? Am I going to look to trade opening range breakouts in the market if we're above the overnight high? So like those specific details weren't really there, but I knew that if I only focused on those details and then started to try and build consistency from them and stop doing the things that didn't work, then things were going to get better. So really what I ended up doing is I would, at the end of the day, I would look at the chart of the best setup of the day. Like let's say Apple was the best stock to trade that day. I would look at it, go in and annotate and write specifically where I was looking to be involved, where I should have bought this breakout or where I should have bought this wedge or, could have bought this dip, this technical level, and was really diligently detailed about how I could have traded that symbol. And then over the course of several months had developed, a big book of all of these setups and had continued to take them in real time while also losing money doing other things. So for a while, when I first started out, I was losing money doing things that didn't work. Then I started losing money because I was trying to get way too oversized, looking for leverage, being too tight with my stops, and just missing moves because, I wasn't wide enough or something like that. And then all of a sudden I was losing money because I was trading those setups well, wasn't risking enough on those good setups, and was still taking all of the other trades that I knew didn't work. Was losing money in symbols that I was unfamiliar with, was losing money on feeler trades, losing money on ideas that didn't even deserve any risk in the first place because the stock had no volume. So it's kind of been this progression of, how do I get out of my own way? I know what works, but I'm not doing the things that work. I'm doing a bunch of other nonsense. And, it's funny to look back and think about how long it took for me to really figure that out. But once I got to the point where I had statistics where I knew that I traded high beta stocks well, I knew that I had a system for how I can trade these high beta stocks. If I don't do anything else and focus in on where I have edge, now things start to get a little bit more interesting. And all of a sudden, I'm having green day after green day, not having any big outsized losses anymore, starting to mentally fix my psychology. I'm feeling better about the prospect of being a trader. I'm feeling better about, my own capabilities. My confidence is coming back. And it took a long time to get to that point. And, I'm obviously, it's only been a year. I'm still struggling with that all the time.
Yeah, well, I mean, personally, I would say that 7 months isn't really that long.
It can feel like it, especially when you're losing money.
Absolutely, when you're there day in, day out. But you spoke about having a system now, or developing a system to trade these high beta stocks. That's kind of seems to be your specialty for the time being. Can you describe this system? Can you describe your playbook trade as it pertains to high beta stocks?
Yeah, so, a little bit more background on my system, I guess. Looking back at those stats, I was losing money at times when the market just really wasn't moving. My stats from 12 o'clock to 2 o'clock were abysmal, consistently losing money during that time, giving away my mornings, setting myself up for a poor afternoon. So I cut out trading in the middle of the day. And then I realized that the area that I had the most edge in was trading momentum moves off the open in the first hour of trade. And that's when, the institutions come in and they're pushing these high beta stocks, and, real volume that drives price is coming into the market. So that's when I started to really focus on, okay, most of my edge is happening off the open in the first hour in high beta stocks. Let's only do that. Let's develop some type of patterns that we like where, this works for me. I've seen this happen several times. I can get in for this momentum move, and this is how I'm going to make my money. So, for clarification purposes, let's say you have a high beta stock that, is gapping up on an upgrade and has a really tight pre-market range. Let's say its pre-market range, if it was Apple or Baba or Nvidia or a stock like that, has, 20 to 30 cent range. And right off the open, ton of volume comes in. They sweep and take out that pre-market low, rebid the pre-market levels, and break above the pre-market high. The old dip and rip. That is one of the setups that I love to trade. You see that a lot in high beta stocks. It's not always necessarily a very quick little peak below the pre-market range. There's obviously some sophistication to it and a little bit of nuance, and that's not the only setup I take. That's a good example of what type of momentum moves that I'm looking for in these high beta stocks.
If possible, we might dig up an example of this and put it in the show notes so someone listening to this has like a visual reference.
Yeah, sure.
Okay, great. You've hinted at psychology a couple times during our conversation here. And I know one of the things you've said in the past is that traders shouldn't underestimate the psychological aspect. How come?
Because I think that it's so easy to, get caught up in the idea that this is all systematic. It's all patterns. It's all, you buy these breakouts and you sell when you reach your target. You risk this amount per trade. You only take good setups at work. And none of that is really taking into account that you feel a certain way when you make or lose money. Anyone who denies that, I think, is fooling themselves. I feel a certain way when I have my best day ever. I feel a certain way when I have my worst day ever. And those emotions and psychological aspects that come into play aren't never going to go away. It's impossible to be robotic. Even the best traders at this firm, you read their reviews or you talk to them after a good day or a tough day. And it all comes down to, were they in the right frame of mind? Were they putting themselves in the mental state where they could perform at their best? Did they meditate? Are they taking regular breaks to, refresh themselves? Are they doing some type of best practice to take their temperature? That's a saying we have here at the firm. You take your temperature and at 15, 30-minute intervals on the day and say, okay, maybe I just took a loss really early. Why did I take that loss? Was I in this trade because, I was chasing the symbol, or I had a fear of missing out, or, it was a boredom trade because there's not really anything else going on today. All of those things are not really a product of your system, but they're a product of your personality and the way that you think about the day. And I think that if you don't really focus on the fact that it's impossible to completely devoid yourself of emotion unless you're a strictly algorithmic trader, it becomes not about fighting your emotions, but learning to use them in a way that is productive and leveraging your own personality and your strengths. You don't have to avoid your demons. Tom is pretty active on Twitter, and he'll always talk about how, there's certain things that make all of us tick. There's certain things that get us happy. There's certain things that get us excited, sad, frustrated, angry, overconfident. All of those things are going to play into the role of a performance-based job. And that's what this is. You can only be at your best if you put yourself in the right mental state. Dr. Steenbarger talks all the time about how there is an analogous relationship between us and professional athletes. Professional athletes, sure, you can focus on what are the plays that you need to run, lift, exercise, get your body in shape, have the talent, be at peak physical performance. But at the end of the day, there's a reason that field goal kickers miss the game-winning kick all the time. There's a reason that basketball players miss certain free throws that could be game winners. It comes down to, is the mental aspect of your game there? And trading is no different. You have to be able to put yourself into the mindset where you can perform at your best. And the longer you spend not thinking about that, the more likely it is that you can continue to make those same mistakes over and over again and not really understand what's actually making you do that.
Are there any tricks that have helped you as of late, or any practices you've been putting into place to help you with the psychological aspect that comes with trading?
Yeah, so I think the biggest thing that I do is, I'm not trading from 12 to 2. So during that time is when I reflect on the morning and prepare for the afternoon. So, did I do a bunch of nonsense in the morning that was I not involved in the right stocks, or was I involved in the right stocks and just executed improperly? Did something happen outside of work that has me, off my basis today? Do I need to really look at my entries and exits in the morning and figure out, what was going on? Am I tired? Do I have too much energy? Did I expect too much from the day? All of that for me is really done during that 2-hour block, where I can kind of refresh myself, go get some lunch, take a walk, prepare for the close, and really figure out where I'm at mentally. So that's one step of it. And the other 2 steps are, pre-market prep, relatively the same thing. I take my energy levels. I think about, am I tired? And how am I feeling? Did I get a good night's sleep? Did I eat well the day before? Taking physical journaling notes of all of that and keeping track of it. Doing the same thing on the close, reviewing every one of my trades. Again, taking my temperature at the end of the day. Am I happy with how the day went? Am I not happy with how the day went? Why? What can I put into practice the next day to change that? So it all really comes down to review. I do things outside of work as well. I exercise as much as I can. I try to go to the gym every day, keep myself in a good headspace. My girlfriend is always on me about eating better. I don't say I eat the best, but I do try. And that's all plays into getting yourself in, peak performance state.
You were talking just before about how you threw out the words best day and worst day.
Mm-hmm.
I thought it might be fun just to ask you if you could talk about, I presume you probably remember this fairly clearly, what has been your worst day, and then also what has been your best day? Can you talk about the specific trades which you made or led to you having your best and worst days?
Yeah, definitely. So what I'm actually going to do is, I have a computer right here in front of me. I'm actually going to bring that up just so I can be more detailed.
Great.
I'll start with my best day ever because it's fresh. It was actually just last week, and it was in Tesla. So we were kind of chatting about that previously. Okay, so coming in on the day, I had the idea in my head that, Tesla was going to provide this huge opportunity for me, and I wanted to be involved. I needed to develop some type of plan so that I could be involved. I didn't want to miss it. My mentor was talking about how this is the trade, like we have to be involved in this. This is the time when we can potentially make our months. It's an outsized risk-reward opportunity. We need to be here for this.
Why were you thinking this coming into the day?
Well, I guess if you for anyone at home listening, if you pull up the daily chart, you could see that Tesla had gone from, at this time, it had gone from basically 400 to 550 in a week and a half, pulled back to 500, and then was gapping up again almost to 600. So obviously it ended up going way more parabolic than any of us probably thought, just a few short weeks later. But at this time, when you have a stock that's gapping up and is so far extended, it's definitely in play. It has this crazy amount of volume every day. That's really what we're looking for at the firm. That's really where the firm makes the majority of its money, on these super in-play names. So I knew that it had the potential to be a huge opportunity coming in on the day. I knew that it deserved my focus. I knew that it could potentially run, 20, 30 points. And this is before the ranges really started to open up in it. Thinking about size-wise, anyone can do the math in your head. If you get 100 shares of a 20-point move, you can make $2,000. So was thinking in my head that there was a big opportunity in play. Didn't necessarily know how it was going to set up, but knew that I could be there for it. So what ends up happening is early on, it gaps up and sells off 15 points right away in the first 1 minute bar. And everybody's piling in short because they think it's going to gap and fail. So gaps up, dumps 15, 20 points. Then it starts to wedge underneath VWAP and really compress right around like 565. So this is on January 22nd. So it's really starting to compress and everybody's pressing short, looking for the breakdown. And as I'm watching this happen and, I'm seeing all the other traders at the firm, getting super short, I'm thinking in my head, like, the character of Tesla over the previous couple of days had kind of been, when you think it's going to break down, it's probably about to rip. Like, it's more than likely just going to do exactly what you don't think it's going to happen. And I kind of just said to myself, using, if-then statements, I said, if this is going to go parabolic today, and maybe today's the blow-off top where it goes to $600, if that's going to happen, it's probably going to wedge and break out from the wedge, get back above VWAP, and just rip. So I entered long 565, caught that next 15-point move, continued to build into a position for the next half hour or so, and then eventually told myself, okay, I've settled in from good prices. I'm going to see if it can go parabolic. And lo and behold, it ends up just absolutely ripping to 595, and I took it for the whole ride. I got out up where, like, somewhere around 590, and at that time, I hadn't been at my best day yet. At that time, I had made a good amount on it. I was excited about the day. It was up big for me, but, not my best day ever yet. But had in the back of my head, it just went parabolic. If there's a short in this later today and I nail that, then now maybe we're talking about best day ever material. So it's so easy to, like, get super excited when you develop some consistency because you do know that those days are going to come. Those days are going to come where you can have your biggest day if you prepare properly and hit the best opportunity. So, was out of it, didn't really do anything with it. was kind of sitting, waiting. And then towards the end of the day, it starts to break underneath the long consolidation that it put in the middle of the day. And my mentor and a bunch of the traders around were all saying, maybe it goes underneath 585 and starts to feed on itself. Maybe anyone who bought up there thinking it was going to gap up again, maybe it just starts to kind of collapse. And there's another 30-point trade on the table. So it starts to collapse. I wasn't really trusting it because, like I said, if you shorted Tesla in the hole, you're almost guaranteed to lose money for a long time, even now. It starts to roll. I shorted a little bit. And then it really just starts to accelerate and feeds on itself, dumps below VWAP. And next thing you know, I look at my P&L and it was the best day ever because I covered down there once it really started to get extended. I like to get out of trades on big explosions, like long extended volatile candles are usually a good idea to sell into strength or cover into weakness. So that was kind of the methodology going behind exiting that trade. But yeah, that ended up being my best day ever.
What do you mean when you say feed on itself?
So by feed on itself, I mean, the characteristic of Tesla at the time had been very difficult for the stock to go down. Dips were being bought feverishly. Any type of consolidations were breaking to the upside. And it was in the process of going parabolic on a daily time frame. So in my head, I'm thinking, the only way for this move really to stop is for there to be some type of big selling, some type of, big volume candle that comes in and breaks below, we like to use VWAP as, volume weighted average price as a confidence level, who's in control on the day. So a big red candle underneath that level is when all of a sudden we're starting to think, okay, let's get involved in this to the short side. And by feed on itself, I mean, other people are thinking that as well, because everybody's looking for the backside in this trade. Everybody's looking for Tesla to finally collapse. If it's going to feed on itself, more and more sellers are going to come in. They're going to continue to just hit the bids and bring the price down. And then what was originally a 5-point dropout that could have been, a dip buy turns into a real strong selling down move that leads to, breaking down to the lows of the day.
Okay. And do you have your worst day in front of you?
I do. Oddly enough, that was yesterday.
Oh, no.
And,
well, your best day and your worst day are within a couple days of each other.
Yeah. And that's definitely a product of, since I've gotten to a point of consistency, I'm in the process of sizing up my account. So we do it where essentially, every 2 weeks or so, every month or so that you're net positive, you get sized up, let's say 20%, 25%. So theoretically, I've been bumped up, I think 3 times. So that's all happened kind of rapidly since I got consistent, and the sizing increases, pretty quickly. So the losing days I have now are way bigger than the losing days I had over that first 7 months, which is all just a function of size.
Can I just interrupt you there? I didn't catch that. What do you need to do to get clipped up?
So it's kind of like a relative process, but we basically just establish it with our risk manager. For me, every 10 days that I'm net positive, I get bumped up across the board 25%. So my size increases 25%, my position sizes increase, and my daily stop limit increases 25%.
Okay.
So as a function of that, in recent times, losing days that I've had have been completely way bigger than that first 8 months because my size now is, 75% bigger.
Mm-hmm.
So as far as that day goes, reliving this so early. Everybody who's had a losing day like this knows how I'm feeling about it. I think what really ended up happening was it was kind of a function of, I had been looking for that top in Tesla. I had been looking to make that trade. I had been game planning at home in my head, what's it going to look like if I nail this? How am I going to have this huge, huge day? How am I going to beat that biggest day ever? What's it going to take? And kind of got caught up in that. And considering my best day ever had been in Tesla, I kind of started treating it like a friend, like an old friend, like, oh, I'm going to trade Tesla today. It's going to go great. And next thing you know, you realize that Tesla kind of just became a completely different beast when it started to go above like $600. So I'm coming in on the day. Tesla's my main focus. It ends up being the only thing I trade. And I essentially just battled it all day. Couldn't get my size right. Couldn't really get on the right side of the move. Was trying to short it while it was going up. Was getting squeezed too far. Just wasn't involved at the right times. The next thing you know, it opened up at 675 on this day. This was Monday. Opened up at 675. Basically went directly to 735. No bounce or no drops for you to scale out of risk. You basically just get completely smoked. So took a bunch of losses trying to short it there. Then it started going down and I started thinking about buying it. So it really went into those old habits of the things that, used to lose me money. And, like we said, 7 months, a year, that's not that long. I still fall into old habits all the time. And, that's what I have to battle day in and day out. But at the end of the day, something that my mentor always says that is a really nice way of spinning, taking a full stop day is you have that risk for a reason, right? You've earned throughout developing some type of consistency, you've earned that level of risk. So when you lose that amount of risk, you have to sit with that and feel what it's like to be responsible for that much money. Taking that loss is only going to make it that much easier to make more than that in the future. So I'm trying to make sure that makes sense. Like you have to feel what it's like to lose that money, to make that money, and really understand what it means to make that money. So I'm trying to spin it in a good way, especially now because it's so fresh. But yeah, that's really the background behind that. Just trying to be better and thinking really hard about what I was doing wrong and trying not to do it the next day.
Yeah, I like that. That's an interesting perspective and a nice way of looking at it. Last thing, let's talk about one thing you're trying to improve on at the moment, or if it's not one thing, maybe just sort of what things you're kind of prioritizing right now, and also what steps or what processes you have in place to ensure you have the best chance of improving on those things.
Yeah, I think the most important thing for me right now, considering I'm in the process of dealing with bigger size and going through, the mental give and takes of what it means to see those P&L numbers changing more rapidly than they ever have, is it comes down to I need to be more selective all the time. I need to know, why am I in this specific stock? Why am I not in it? Was I unprepared? Was there a specific reason that I wasn't involved? So selectivity is a nice, word to group in all of those feelings. And then also just being really diligent with the way that I manage my risk. As I get sized up, I need to think about things in proportions. I should still only be risking a third of my stop on these types of setups. I should only be risking a quarter of my stop on another type of setup. And not thinking so much about the money, thinking more about sticking to the process that got me the bump in the first place. Falling back on those really good habits, being diligent with how I'm placing my risk. Is this a playbook setup for me? Is this in my system? Does this trade deserve more risk? Is this just a feeler trade and maybe it doesn't deserve this much risk? So right now, my main focus is really like just ironing down specifically what trades deserve the risk that I've been allocated, and really looking to capitalize on those outsized risk reward opportunities, because those are the trades that lead you to your best days. A lot of the days can be grinding it out, but at the end of the day, my goal is to be prepared and ready to go when the market does hand us these once in a month opportunities. Because at the end of the day, some of the top traders here at the firm will talk about all the time where 3, 4, 5, 6 opportunities in the entire year are where they made the bulk of their money, because they're just incredible opportunities. So the goal for me is, to not lose, get out of those habits, make sure I don't return to some of the things I did in those first 7 months, stick to the things that got me to consistency, selectivity, patience, being focused on my mindset and my process, sticking to specific setups, speaking to my mentors, and just being very process oriented. That's, and the goal, and that goal really will just keep me centered and let me handle, taking those worst days ever, because you can fall back on that process and those good habits.
Excellent, man. Let's leave it there. Ryan, if someone listening to this podcast is keen to follow you on Twitter, can you please share your handle?
Yeah, my handle is Trost Trades, TROST TRADES.
Okay, good stuff. All right, Ryan, really appreciate it, man. Thank you so much. You've been excellent to speak with, and I think there's a lot packed into this one for anyone who's just starting out. I'm sure they'll pick up a few tricks from going back and listening over this, maybe even a couple times. So, again, man, thank you very much.
No problem. It's been a pleasure.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey all, and welcome. Hope you are doing fine. This is episode 197. Featuring on this episode is Haim Ben-Ami. He's the CEO of Raft Technologies. Having constructed shortwave radio towers in Chicago, Frankfurt, and more recently, London, Raft have established an ultra-low latency connection between various exchanges, which is then leased to algorithmic trading firms who seek a speed advantage. In talking with Haim, we get into why some traders are prepared to pay big bucks in order to be just a few milliseconds quicker than other market participants. We also discuss and compare the various technologies used to transmit data, shortwave, microwave, and fiber optic cable, and going beyond the connection, how firms further optimize for speed, plus what's next in the race to zero. And here's a fun fact. Many, most likely futures traders, will be familiar with the trading software Bookmap for visualizing market depth. Well, Haim was actually one of the creators. Before Raft, Haim led an algorithmic trading firm which had developed Bookmap as a tool for internal use before later on releasing it as a commercial product for public use. Lastly, the movie and blog Haim references during the interview. Links for both can be found in the show notes at chatwithtraders.com /197. And now, coming to you from Israel, here is Chaim Ben-Ami. In order to have the know-how of building the company you have today, obviously I'm referring to Raft Technologies, just briefly, what is your background?
My background is both from the physics side and algo trading. So I started my career as a physicist in a high-tech company in Israel. Later on, I co-founded an algo trading company. We took an algorithm that its target was to predict threats that trying to connect into IT systems, and we tested its prediction ability. And this is how we started Velox Pro with the two additional partners. So I have around background of 5 to 7 years of active algo trading. We started on trading in a New York Stock Exchange, mainly ETF, and then we moved to trade futures. Everything was high frequency trading. Future was in Chicago. So this is in general the background. By the way, this company later on developed the product that we call today Bookmap. Bookmap was actually a development of our simulator. I'm sure that you know and you're familiar that when you develop a trading algorithm, you are testing it in simulation, then you trade. While you are trading, you are recording the market data, and then you replay it and compare between the simulation and the real trade. So all the partners, we had an Air Force background, so we had a very sweet spot for debriefing. So this is how Bookmap started. It was actually a development of our simulator. Today, it's actually a trading platform that thousands of traders are using it globally. So this is the trading background. Later on, I moved to manage a company named Intelligent. It's a wireless connectivity company that gives service to large and small companies in the field of wireless. And here I gain more and more experience on the fields of RF, actually, radio frequency. So this brought me very well these two fields that I touched. Algo trading and wireless connectivity was a very good match to Raft. And when they called and offered me the position as a CEO, I was very happy to bring together these two fields that I like very much. And here I am after. I joined Raft 2.5 years ago, roughly.
So what you mentioned there about Bookmap, and I'm sure many people who are listening to this podcast have heard of it or maybe even trialed it, maybe even use it. It's quite interesting that you released that to the public. I mean, it's kind of cool that it was something you developed at your algorithmic trading firm, which you had, and then released it to the public. I mean, that's not very common. How come you made that decision to make it available to others?
It was a slow process. We felt in love with this product, and we started actually to even start to trade it ourselves to our own book, regardless of the automated trading. And we did several cooperation with other traders that advised to us on algo trading. And when they saw it, they asked to use it themselves. And we found ourselves developing this product and start to charge for using it. And slowly, it became a major income to the company. So this was the process. And eventually, we decided that it will be the main focus of the company.
Right. And on the trading side, what sort of success did you see as a company?
There was different periods during the 2007 to the beginning of 2008. The trading was very, very profitable. Later on, when volatility went down, it was harder and harder to do it. And another thing that we felt is that more and more competition came into the market, and we found ourselves requiring to invest more and more money in building infrastructure or acquiring infrastructure. So it's not simple or not easy for algo traders, mainly small companies like we were, to keep up with the past. So this, of course, was in the background of this decision.
What year did you start Velox? Like, you must have been pretty sort of one of the, maybe not the first, but you were pretty early to the HFT game.
We started examining the algorithm at the end of 2006, and we established Velox at the beginning of 2007. This was roughly the timeline.
So moving away from that and focusing on current events and what you're doing today, your whole business helping traders to be more speedy. Why does speed matter so much?
In general, speed is important for any kind of trade. For example, imagine yourself that you are a real estate agent and you find a good deal. These good deals tends to be less time in the market because it's only a matter of time until someone else will recognize the opportunity and will take it. So time is important. Now, most of the global trading today is being done by and between computers. The exchange themselves, the matching agents, are computers. So when we are talking on speed here, we are talking very, very fast. We're talking milliseconds or even nanoseconds. So, for example, nanoseconds is 9 zeros after the decimal point. Okay, milliseconds, it's 3 points. So for computers, it's a lot of time. But for us, it looks like nothing. But for the computers that trading today, such an advantage can make all the difference. So this is one point. Another point, the nature of the opportunities is that they are very, very small. It's small variations from balance that occurs in very high frequency. But since the opportunity is small, the first trader or several traders to arrive to the opportunity has the ability to take it all. So they don't leave anything to the third, fourth, or even second. So it's a winners take it all kind of game. This is why speed is so important. If you are not among the fastest one, you will live with nothing. This is why speed is important.
So I guess just to go into that a little deeper, everyone who's a trader can understand on some level why speed is important. But perhaps to more novice traders who don't quite understand what goes on behind the scenes quite so well, explain why traders are willing to pay so much for a speed advantage. Because we're talking, and when I say a speed advantage, generally what that is just a few milliseconds, right?
Yes, you are correct. The reason here is that, let's say that you want to shave 1 minute or 2 minutes of advantage. It will be relatively easy if you want to shave several milliseconds or even seconds. So you need to replace your internet connection, okay? Later on, if you want to have better performances, you need to start to invest more money and in more infrastructure. To save, for example, a microsecond is much more expensive and takes a lot of effort in today's competition, comparing to save another several minutes, which is much easier. So the more you are going further to the small figures, you need to invest more in order to be ahead of competitions. Let me give you several examples, okay? Hibernia, 5 years ago, put a new sub-ocean cable between New Jersey to London with an investment of $300 million. It saved 2 to 3 milliseconds cross ocean with a huge investment. Okay, but no one could have done it if it wasn't for such an investment. Another example that I can give, if the audience or you, if you saw the Hummingbird Project movie, it's a Hollywood movie that was presented went out last year. It's explained the competition between a company that put a ultra low latency fiber straight and very in the shortest available distance between Chicago to New York, versus the competition of putting microwave on the same route. They beat each other by half a millisecond. Okay, but as they said in this movie, it worth $500 million per year of trading, simply by arriving first between Chicago to New York. So, and again, you can imagine yourself that such a project cost around $100 million to build. But again, you're first and you can take all the low-hanging fruits. So this is just an example to give a picture to the audience what it takes to be first and why it's important.
On that point, that's just so incredible. How long did it take to lay a direct line between New Jersey, I think it was, New York to Chicago? That just seems like such a massive undertaking.
Mm-hmm. It's the construction itself, it's a matter of months if you have the fund and the money. But before it, it's years of planning, of receiving the right licensings from the authorizations, to go and to negotiate with landlords through which the fiber or the microwave will go through. So it's a lot of preparation work. The construction itself, I assume it's less than a year once you have the fund and you have the money.
But this was a direct line and it ran under the ground, didn't it?
Yes, the fiber went under the ground. The microwave is a wireless technology that take advantage of the speed of light in air. The reason that algo traders or anyone that low latency is important for him wants to go through air and not through fiber is simply because the speed of light in air is much higher than the speed of light in glass. Okay, air or information travels at the speed of 300,000 kilometers per second when it travels through air. When you get it through glass, it travels at the speed of 200,000 kilometers per second. Now, anyway, both speeds are very high for us. But imagine yourself, this difference in speed can be translated to 1 millisecond advantage every 1,000 kilometers. And between Chicago to New Jersey, it's 1,300 kilometers. So you can save 1.3 milliseconds in theory, okay? Which is huge advantage. It's if I will tell you that you can predict 100 years ahead of the market what will be the real estate prices in any neighborhoods you want to know. It's a huge advantage for the computers.
So what you're saying, though, is this line was installed prior to using microwave technologies.
Yes. Fiber was before the microwave, yes, and roughly 13 years ago, microwave started to emerge as the new technology for low latency algo trading.
Okay, so shortly after this line was installed, it pretty much quickly became redundant.
Yeah, but there is a bit more to that. There were several fibers installed, so the competition was at the beginning between different fibers, who is going through the shorter distance. And then microwave came along, and today the competition is between microwave, okay, who position himself better along the route and can save additional latency.
Okay. Sorry, we'll move off this direct line in just a moment. I just find it really interesting.
Sure.
Who installed it? Like, was it a trading firm or was it a third-party company who just had this brilliant idea at the time to install this line and then lease it to a trading firm or maybe multiple trading firms? I'm not sure how many people were using it.
So for my knowledge, it was a combination. So the fiber, if I'm not mistaken, was first by a corporation that offered it to algo traders. But when the microwave kicked in, it was started with algo trading companies that started to build it. Then came along more or less at the same time service companies that build microwave and offered it to algo traders. Naturally, when an algo trading company is build a link, it uses it for its own needs. It doesn't offer it to the market because it wants to keep the advantage to itself. This is usually what happens. But it's a free market, and service company are offering themselves and their service. So this is what's happening today.
Yeah. So if we look at what you've built, now your company has towers in Chicago and Frankfurt.
Yes.
How come those two locations?
Both venues are very large in trading volumes. Chicago is trading around $25 trillion per year, and Frankfurt is around $12 trillion per year. So those are very big trading venues. Plus, they have many correlated instruments between them. Of course, the S&P future, ES, or NASDAQ, NQ, influence the equities futures in Frankfurt and in general stocks over there. There are futures on gold, oil, and so forth that customer can take, not necessarily to trade in Frankfurt, but to forward it to other venues. So there's a lot of correlation on different instruments between these two markets, which can create good trading opportunities for companies.
Okay, just in simple terms, could you explain just a very basic example of what a potential trading opportunity might be, given that you've got the ability to very quickly see price updates and new information between Chicago and Frankfurt exchanges?
So, for example, we can take two equity future, ES, that is traded in Chicago, and DAX, for example, in Frankfurt, and they have a certain level of correlation between them. Meaning that when one future in Chicago is moving, it's influence the future in Frankfurt. Okay, this can use as an indicator for trading. Okay, it's not necessarily says that it's a pure arbitrage because these two futures are a bit different than each other. Okay, but still, the movement in the ES future in Chicago can be a very strong signal that enables you to predict what the equity future in Frankfurt will do. And based on this indicator, you can take a trading decision, either to perform a trade or to exit from a trade, for example. Basically, this is an indicator that you can use.
Do you have any customers who just purely trade, let's say, CME or Chicago, for example? So they're not really too concerned what's going on in Frankfurt. Is there any advantage in going through your infrastructure, using your connections, if a trader is somewhere in the US and only trading CME? Like, do they still get a speed advantage in one way or another?
No. If you don't need an indicator from an outside exchange, you don't need our service. Most of the traders today utilize and use indicators or information from outside exchanges, outside of their target exchange. So let's say that they are trading in Chicago. Of course, they will use the market data from the Chicago itself. But most of them are as well receiving market data from New York, for example, from Frankfurt, from London, from Tokyo, in order to price the instrument that they want to trade and take a trading decisions.
And most of this might be a little bit difficult to answer, but most of the clients or the trading firms that use your service or your connections, what sort of strategies are they running? Like, are they purely market-making firms? Are they running sort of aggressive taking strategies? What's generally
Again, we are supplying the service or the link. We don't necessarily know what exactly they are doing or what exactly the strategies, but in general terms, what we understand that they are doing, there are two ways to utilize such a latency advantage. When I'm saying a latency advantage, it's a 4 milliseconds advantage. Today, in order to transfer a signal from Chicago to Frankfurt, the best combination of microwave and fiber give you around 36 milliseconds. Our service give you 32 milliseconds. So 4 millisecond advantage, which is huge. Our customers using this advantage in order to either take an opportunity before it's taken by other traders, or to run away, meaning if they are doing, for example, market making and they are quoting the market, they can use the advantage in information in order not to perform a trade, either for risk hedging or to simply to put their order further into the book and away from the best bid ask.
Tell me about what went into establishing your connection. Like, for example, I presume you had to buy some land. There's obviously constructing the towers, laying cables to the exchanges or to some sort of data center. Tell me a little bit about what was involved in setting all of this up.
So first of all, our mission was to develop low latency modem that is tailored to the shortwave frequencies. Shortwave is a nickname of the frequencies between 3 megahertz to 30 megahertz. There's a unique phenomena that happens only for these frequencies. For them, the atmosphere of Earth is like a mirror. And this physical phenomena allows one to transfer signal through a very, very long distance without using satellite, without using fiber. So as you said, we have one antenna in Chicago and one antenna in Frankfurt. That's it. Nothing in between. It is 7,000 kilometers that we transfer our signal through air. So this is the basic components of the infrastructure. As you said, we need to acquire the land or lease the land. The location is very important. It should be very close to the exchange. And there are several considerations of receive and transmit. Of course, we need and we apply and we receive license to do it from the local government. This is another important ingredient. And then there is the connection to the exchange itself. Our customers put in their trading machines in co-location, in proximity to the exchange. And we put our switch at the same co-location. So although it sounds like a very complex system, at the end of the day, we give a point-to-point service. So our customers need only to cross-connect to us at the co-location, They are writing to our API, which is a simple interface, and that's it. They are good to go.
Okay, so when you say they just need to cross-connect, what that means is they have a server at the exchange already,
Yes.
and then that just plugs into your server at the exchange too.
Yes, to our switch. Yes, exactly.
Okay.
It's a cable. That's it.
So how close to the exchanges is the land which you've built these antennas on?
It outside of the city, it can be anything between 3 mile to 6 mile. If you saw, for example, I don't know if the audience are familiar with the Sniper of Mawa blog, which explain and describe, it was back at 2018, if I'm not mistaken, when first news on this new technology started to emerge. And this was the first time that information was started to be to go public. So the antenna is outside of the city, the main receive or transmit antenna. And we are connecting with something we call last mile, which can be simple microwave, into the co-location.
Are there any regulations around or to the exchange stipulate any rules for how close your tower can be to the exchange, or is it purely up to you about what land you can lease or purchase in the closest distance?
No, there's no specific regulation. It's the same like anything that you want to build, either be it microwave or fiber or a simple internet connection. It's merely another communication that comes into this building with the regular regulations.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
You spoke about shortwave. Now, just a question around terminology here.
Mm-hmm.
What's the difference between microwave and shortwave? Is that the same thing, or are they slightly different?
The physical phenomena itself, it's the same physical phenomena. It's a radio frequency. But this is different frequencies of the radio frequency. So shortwave is the frequencies between 3 megahertz to 30 megahertz, and microwave is around 10 gigahertz. So 1 and then 9 zeros after it. So it's much, much higher frequencies.
Okay, so what's ideal for trading? Obviously, shortwave.
It depends on the applications, because microwave can travel up to 15 mile, and then you need a repeater. Okay, but while shortwave can travel thousands of kilometers without requiring any repeater. The physics implication of higher or lower frequencies allow shortwave to travel long distance without scattering through the atmosphere, while microwave, for physical reasons, scatters much faster and actually disperse after up to 15 miles, something like this. So this is the difference. So if you want, for example, to connect two trading centers in the vicinity of New York, use microwave. If you need long distance and if you need to cross an ocean, use shortwave. So it depends on the application.
Okay. When did shortwave begin to be utilized by trading companies? Like, is this it's a fairly new-ish technology?
Shortwave was with us started to be used by as a technology 150 years ago, mainly to connect long distance UK colonies. This was the start of this technology. It was never tailored to low latency. It was never very important for example, armies that use this technology, if they receive it, how fast they receive the transmission. But once it was started to be used for algo traders, then the low latency became an issue. And this was one of the main challenges of Raft, to take this phenomena, to take this technology, but to add the challenge of low latency. From my experience knowledge, the first time that any firm tried to develop such technology was back in 2011, but it was only first bird, and it was taken more seriously from 2013, 2014, when several, from my personal knowledge, started to try to develop this kind of technology. This was when Raft Technologies was established as well. And as we said, it was around in a stealth mode until last year, actually, and since mid of 2018. Yeah.
So is it fair to say that shortwave technology is pretty much industry standard today when crossing an ocean is necessary?
It's not yet. The industry today understand, the financial industry, the algo traders understand that this is the DEX technology that is defining a new benchmark of latency. But it's still a premium service. I assume that it will take another 5 years until it will become a standard. And from what I see, algo traders understand that they will need to use this technology. The question is more when, not if.
So what are other trading firms which are dependent on reducing latency as much as possible? How are they transmitting data between exchanges overseas if they're not using shortwave? Because you mentioned microwave needs like a repeater or an extender every. I'm not sure how.
It's every 20 up to 20 kilometers, something like this.
Okay, so what are they doing if they're not using shortwave?
They are using fiber optic.
Which runs under the ocean.
Exactly. There are different types of fiber, different technologies. For example, there are around 10 fiber optics that are crossing the Atlantic. Each one is in a different grade of technology, different distance, and of course, prices are accordingly. So each trading firm can decide how much it's willing to pay for each service that is being offered.
Just a question around this and sort of more, I guess, a business-related question. If you're offering this technology as a service to multiple firms, so anyone who's willing to pay the price, how is one firm getting an advantage over the other? Like, I understand they're not all trading the exact same strategy, but I presume they're probably correlated to a certain extent. How would you answer that?
So, first of all, every firm has its own secret sauce, as you said, regarding its algorithms. It's a combination of how to define indicators. It's a combination of what to trade and when, how to manage your risk. There is a lot of knowledge and advantage in this part of the algorithms. On terms of of the infrastructure itself, we as a company, we don't offer different latencies to different companies. We are offering the same service and the same parameters to all our clients. So when a firm comes to and ask itself how it can gain a latency advantage, when it comes to infrastructure, it's a question of either to use it or not to use it. If you will use our infrastructure, you will gain a huge advantage on anyone that doesn't use it. But you will not gain an advantage on our other clients. It's not something that we offer, even for a higher price. We believe that as a service company, we need to offer the market the same deal. This is the idea. So the algo trading companies need to decide if they adopt a technology, be it shortwave, be it microwave, be it FPGA, for example, that most of the algo trading companies are using and utilizing today. So this is the question that they need to ask themselves in regards to infrastructure.
Can you just explain what you mean by FPGA a little further? And I guess this leads into naturally what would be my next question is, so beyond the connection, what efforts are these firms going to further reduce latency, like beyond just the connection? So you mentioned FPGA. Can you just describe that a little more and any other examples which you're aware of?
FPGA is the initial of Field Programmable Gate Array. It's actually a kind of chip like we have in our computers. But the difference is that you can program this chip, meaning you don't simply produce it in its thousands and make it in a way that it can't be changed. Okay? FPGA is a chip that you can install in your trading system and translate part of your algorithms into the FPGA. Since FPGA it's a chip, it's a hardware, it works much faster than software. So once an algo trading firm start to use FPGA and transfer its software coded algorithm into hardware coded FPGA, it gains additional advantage in latency. I'm talking around several hundreds of micros. This is the advantage. Micro is 6 zeros after the decimal point, just to put the audience in context. This is the advantage that you can gain.
So you're talking about millionths of a second?
Exactly. Exactly.
Okay.
Exactly.
The whole FPGA chip thing just totally blows my mind. How sophisticated can the algos be, which are, I guess, FPGA chips? Like, do they just do very simple operations, or are some of them quite sophisticated strategies?
Usually, FPGA is being utilized mainly to disseminate the market data. Imagine yourself that you need to digest huge amounts of data in order to extract the unique indicators that you want to install into your algorithms. Digesting such huge amounts of data from different sources takes a lot of time in software. So this is one of the main motivation to use FPGA. The trading algorithm itself can be coded on FPGA again as well. But it doesn't necessarily need to say that it's complex or simple.
Wilhelm, you've been in this game for a while now, and I'm sure you've seen a lot of changes as it's forever evolving. Do you have any ideas about how the race to zero might evolve further?
Yes, I think that I see two dimensions to the race to zero. One is on the technological level, or bringing together several technologies. For example, on the route between Chicago to London, that we now offering Chicago to London, not only Chicago to Frankfurt. From 6 months from today, we will offer Chicago to Tokyo, 10,000 kilometers with shortwave. So first you need to evaluate the race on a specific link. Okay, so let's take Chicago to London. As an algo trading firms, you can use or combine several technologies together, put your computers in co-location, use FPGA, use shortwave, and so forth. Okay, so this is on the technological level. On the geographical level, I expect that we will see a repetition of it happening on different routes. For example, the first microwave was built between Chicago to New Jersey. Next followed inside the New York metropolitan, London metropolitan, then London to Frankfurt. Okay, so once a technology is established, gradually it's taking or it's conquering more and more links. By the way, same happened when the exchange become computerized. I mean, it didn't happen everything overnight. It started with the United States, moved to Europe, and hence go forward. So the same will happen with shortwave and will keep on happening with microwave. So as we feel in all the field of our lives, the idea is to keep on adopting the new technologies. This is the idea, and this is what I think lay the basis of keep on being a successful trader. Keep on evolve, keep on search and hear about new technologies. Keep your mind open, okay? And you don't necessarily need to adopt a certain technology in a certain exchange. You can wait it to arrive to exchange that you are already familiar with, for example. So this is the two levels that I see.
Do you foresee a time where a technology may supersede shortwave?
From physical point of view, we arrive to the limit. Einstein proved to us that there's nothing faster than the speed of light in air. So we arrived to the physical limit of speed. By the way, microwave has the same speed of light that shortwave has. The only difference is that shortwave can do it for 10,000 kilometers and microwave to 20 kilometers, for example. So from theoretical point of view, we arrive to the physical limit. This is why I'm saying that the future lays on combinations of different technologies. Another thing that we'll see happen is like we experience with internet or with cellular, that we see newer and newer generations allows us to transfer more and more data over these links. This is the same happens in microwave and same happens in shortwave. So this technology itself will keep on to evolve.
Just as you were talking there and you spoke about expanding to set up in London and Tokyo as well, I think.
Yes.
Are there firms already, like some of the dominant players in HFT, which already are utilizing this technology? They might have antennas which run from Chicago to London already using shortwave technology, but just like obviously not sharing it with others. Very different situation to you where you're just building the infrastructure and then, people can lease it from you. Is it the case that some of these big players, and, maybe some of them are your clients, I'm not sure, but is it the case where they just go out and build their own towers?
My estimation is that there are. I can tell you if it's 1, 2, or 10. I assume it's very, very few. Again, but this is my knowledge and my intuition. Of course, it's not something that they talk with me about. It's not something that they are sharing because, as you said, they are keeping it to themselves. From our point of view, it doesn't make a lot of difference because let's say that even one company has one link, it not necessarily says that it will not use or utilize our link, either because it doesn't has it yet or at all doesn't plan to do it, or it decides that from cost-effective point of view, it's better to them to buy a good service rather to maintain a technology, because to develop and maintain such technology costs a lot of money. Or they simply want more bandwidth on the same route. We as a service company, we offer it to all the markets, and we don't care if you already have this technology or not. This is our position.
All right, Haim, well, let's wrap it up on that note. If someone wants to find out more info about what you do, where is the best place to go?
Simply go to our website, Raft, RAFT, _tech.com, and send us an email to our info. This is how many of our customers arrive to us. Simply search into shortwave or WAF technologies and send us an email. So it will be very easy to do.
Very good. And are you on Twitter?
I'm on Twitter. Yes, it's Haim Ben-Ami, @Haim Ben-Ami. That's it. This is where I am.
Okay. Very good. Well, I appreciate your time, Haim. It's been an interesting conversation, and I find this nerdy stuff very interesting. So, thanks once again, and let's chat soon.
Thank you very much, Aaron. Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Boys and girls, what is up? Welcome to episode 198. On this episode is a special guest and someone who in 2018 landed a spot on Forbes 30 Under 30 of Finance, Christina Chi. In her early 20s, after graduating from MIT, Christina and two classmates, Luca Lin and Jonathan Wang, who had collectively been trading futures from a campus dorm room, founded Domeyard. It was 2012, and Domeyard was to be one of the few high-frequency trading hedge funds. This is a little unique because the majority of HFTs operate as proprietary trading companies. As Christina states during the interview, by all means we should have failed, given the three of them had little trading experience and minimal insight to the hedge fund industry. Not to mention the three had almost no money. So Domeyard is also one of the few hedge funds that went out and raised money from VCs, such as SoftBank and a Rentec co-founder, as a necessary means to launch. Now, 8 years on, the Boston-based fund is well established and well past the startup phase. Domeyard trades thousands of times daily, sometimes exceeding 10,000 trades across various futures products. And during its biggest single day this year, the fund did turnover in excess of $7 billion. This episode includes talk of raising capital, building infrastructure, early hurdles, trading strategies, generating alpha, and plenty more. It was a real pleasure to speak with Christina and even inspiring to hear what her and her team have built from scratch. It's just incredible. So please enjoy. Here is my interview with Christina Chi for episode 198. I understand it. You had been trading European futures in the night with two other classmates while you were in college or university. How did this turn into the bold idea of starting a hedge fund?
That's a really great question. We were trading from a dorm room, and it was interesting because we were surprisingly doing pretty well for a dorm room strategy, I guess. I mean, we would make. We were only, I think, one of my co-founders, he was at Harvard at the time, and his roommate there, Harvard has all these rich kids apparently, and apparently one of his roommates, his family runs a hedge fund actually, and they were able to give us a little bit of capital initially to trade, and it wasn't a lot, it was like $100,000 or something, but we were able to make about $40,000, take home $40,000 basically at the end of the day, which was a lot for a bunch of little kids in a dorm room. And then we realized, this could, for him, he was like, oh, wow, this could be, a really cool thing to do, and would be really exciting, something that keeps you going and keeps you, waking up in the morning. And for me, the reasoning was more because I had interned in finance, and I had a couple of one particularly poor experience in the industry where there was a lot of politics, despite being a trading floor, and most of the results were based on, you're judged based on your performance, but there was still a ton of politics, surprisingly. It's amazing how much politics is in every industry. So I was really bothered by the culture and the atmosphere there, the way they treated their younger people on the team, as well as some of the minorities on the team, some of the women and minorities, and I just didn't feel comfortable in that environment, and ended up, for me, that was a big part of the reason why I wanted to start off on my own. I don't think I've ever said that in quite that detail before, but there was a lot of hazing and a lot of behaviors that I just, didn't want in a company, and didn't want in a daily environment. So decided to start off on our own. I wish I could tell you, Aaron, I wish I could tell you like, oh, this was the best industry for me. I had researched and read so many books and did all this stuff. Like, no, I didn't. I didn't read any. I was not an expert in machine learning or high frequency trading or finance at all at the time. It was just purely driven by a desire to have a company with a better culture on my end and a better, healthier environment. And people always think it's ironic, you're high frequency trading. How can you be ethical and moral? And it's like, well, we've had a really great environment for the people on the team, at least. And we can definitely talk about that more as well. So,
yeah. So you interned at a couple different places. You weren't a fan of this. You have two other co-founders at DomeYard. Did they have somewhat similar experiences to you?
We all came from different backgrounds. We actually weren't friends before starting the company together, but we did have one thing in common, which is the same career goals in mind. We all wanted to do something, related to finance or fintech, and all cared about the startup industry as well. So we did have different backgrounds. So one of them had a more math and physics background, and the other one was a computer scientist. And but we were all young, we were all inexperienced. So it definitely, was helpful in certain ways in that we had different skill sets and backgrounds, but also unhelpful in that our founding team, we didn't have someone like a thought leader in the space, or someone with any amount of experience. So it was really an unknown path that we were kind of going down that we had never been down before.
Mm. So this capital which you had initially that you were trading around with, how were you trading that? Were you using algorithms right from the get-go, or was it kind of click trading? How were you making trades in European futures?
Oh, it's a great question. I mean, we were literally using like interactive brokers. We had set up some, very wonky quantitative-based strategies. They were still systematic. They still had certain triggers that we would use. We might do a basic mean reversion strategy, or a basic momentum strategy, just things that you can implement relatively quickly and easily. The holding, were we intraday? Yeah, we were actually intraday by that time already, but they weren't high frequency in terms of the amount of times they would trigger. It's not that much during the day. So, it's impossible to create an HFT business overnight or in a dorm room. It's impossible. But we realized that the faster we were, the more of an advantage we would have. And surprisingly, the more fair of a playing field it was for us, which I know sounds ironic, but, the fact that the only thing hindering us was just being a little bit faster, and that we didn't need any, we didn't need any insider information. We didn't need any, kind of broader sources of data rather than just market data. That's all we needed. And so that was really great to kind of see. And we decided, why not continue making this, seeing what we can do on the technology side to improve the latencies we had. And back then, we didn't even know. I mean, we knew it was high frequency trading, but this was before Flash Boys came out, by the way. So this is before the reputation of the industry tanked. So it was a different time period, altogether. And we weren't driven by, really anything that was written in the book, because the book hadn't been published yet.
As you've pointed out, you had minimal experience trading and in finance. Like, yeah, sure, you had a little bit. You also weren't well capitalized, but you had this idea to launch a hedge fund. How did you actually set out to get this off the ground?
You're right. We had no money. I also had no credibility and no connections at the time, which was not very helpful whatsoever. By all statistics, by all means, we should have failed. I think we were just driven by passion. Really, was the biggest thing. We woke up every day very early and set about doing this, and I'd work every waking minute, and that's really what drove me to get somewhere. I think there are a couple things we did do differently to make sure that we would either have an edge or we could at least maintain some operating runway. One was raising venture capital, which for a hedge fund is still almost unheard of, but it's becoming a little more common. There's funds like Quantopian, for instance, back when they had a hedge fund, they also raised venture capital as well to fuel their unique fund. We've also done the same thing. We raised venture capital as well from some great folks in the industry who believed in us and wanted to maybe pass the baton or see what we were made of, whatever it was. But that support was fantastic. It also gave us the credibility that we didn't have at the time, but desperately needed. So that was one way that we went about things. The other was building all of our technologies from scratch as well, which is both good and bad. I don't know if I could really recommend that to anybody today because the world is a different place than it was even 5 years ago or 8 years ago. It's a different scene today in terms of what the technology landscape looks like. But there was not a lot of high frequency technology out there today. There's not a lot of open source either. So all we could really do is scrap it together, which meant actually the side effect of that is we have our own IP. We have a lot of valuable stuff in-house that we could always capitalize on one day, or maybe we could decide to sell it one day if we wanted to. So that was really great. And also, if something goes wrong, we can go in and fix it ourselves. I don't have to call a hotline and wait on the line and stuff. So that was great. But the downside of it is it takes forever. I mean, it was an unknown timeline, an unknown path and an unknown timeline, which is scary. It's like the last thing that you want to do is not know when you're going to launch, as a hedge fund. And it's extremely frustrating. Happy to elaborate on that if you'd like to.
Yeah, I'd love to ask you some questions around raising capital and also building out your infrastructure. Just before we do, though, I have a question about why you were fixated on high-frequency trading from the outset.
I wanted to combine finance and technology, and didn't even know what fintech probably wasn't a thing back then. But I have a more technical background. Same with my co-founders, and during some of my internships, we would basically make guesses onto whether, let's say, we'd guess whether Google stock would go up or down tomorrow, and I knew that wasn't the type of strategy I wanted to do. I wanted to be a little bit more mathematical, and that's when you figure out, there's, you could do some market making and stat R based strategies and have a more systematic approach to those strategies. And so that was the biggest impetus of doing, I guess, quant. And then when we were doing quant, we're like, oh, wait, the faster, the more money we made. And I know that sounds like to some people, it's a really selfish reason, but that was really the biggest thing was, wow, we could really do this. And being faster, we could really start to compete against the big guys in our space and, make a name for ourselves, hopefully one day. So that was the naive goal back then.
Okay. Now, on the subject of raising capital, I guess you kind of explained it a little bit, but I'll just ask you again. Why did you need to raise capital? And was that capital, like the investors' funds, were they intended for building out your infrastructure and building out the actual fund, or were those funds intended to be used as trading capital?
So I'll answer your second question first, which is this is meant purely for operations. So management company operations like paying for employees, buying software, getting data licenses, paying for data feeds, all those expenses that and legal fees and whatever service providers, any kind of expenses that lead up to the launch of the fund itself. I think the other thing is if we could have raised enough money in the hedge fund on day one, maybe we wouldn't have to raise venture capital to begin with and sell. Why sell a chunk of your company, right? That's a pretty risky thing to do. But we knew that on day one, given our backgrounds, we weren't even qualified or capable of raising enough money in the hedge fund, and so. The biggest thing we needed to do, because we're high frequency trading as well, we couldn't just launch the fund overnight. We decided, to build the order management system, feed handlers, execution gateways, market engine simulators, like all those different tools pretty much from scratch. And so that was going to take a lot of time. And that's why we needed venture capital. We told them we were going to use it to build those technologies and then eventually, get to a stage where we can launch the fund and raise a separate amount of money for the fund. The investors are actually largely separate. There is a little bit of overlap. There's some investors from, like maybe firms like Renaissance or somewhere where they are both angel investors and also, hedge fund investors too. So they might serve two roles. But for the most part, our hedge fund allocators are a very different group of, they're fund of funds or family offices, very different group than the, traditional VCs and, other high net worth individuals that we raised from on the operating side. So we did do that. And then I forgot your first question.
You pretty much explained it. It was just, why did you need to raise capital?
Oh yeah, I mean, desperate. We were just desperate for money, right? In times like this, when everyone's in a crisis too, right? It's like if you need the money, would I rather own 100% of a tiny pie, or would I want to expand that pie and own a small slice of a big pie? And I was like, well, for my career path right now, I'm not that greedy, and I'm just starting, so I was willing to own a small slice of a big pie if that meant stability for the next couple of years.
That's really interesting how there's kind of two classes of investors which are invested in your business. So you've got the venture capitalists, which were involved in helping to launch the business, and then you've got your more traditional type investors who are invested in your trading performance. Is that correct?
Right. That's correct. Yeah.
Okay.
So we had two different types of investors. We had the long-term venture capitalists who were in it for the, it's like, feels like a marriage, right? Because they're in it for like the 10-year, 6 to 10 year haul, basically. And then there's the kind of shorter term investors on the fund side where, they could redeem anytime they wanted to, essentially.
Okay. Can I ask you how you secured your first investor? And investor here, I'm talking about the VC side of it. Given you had very little track record and, to be honest, not much to show, how were you able to get someone on board?
On the venture side, it's actually easier to answer because the venture side, literally, you just go to these startup events and pitch, at those events. Usually at the angel and seed stage, people invest in people, right? They shouldn't be investing in numbers like revenue figures because you shouldn't really have any. And if they do judge you by that, it's a very inaccurate indicator of future success because most companies, you look at like Twitter or I don't know, Uber, certain companies like that, they didn't have any revenue until much later on. And some of them haven't even, a lot of firms haven't broken even yet, even though they've gotten billions of dollars in funding. So it's based on people at that stage, which was great. But then when it came down to raising money for the fund, it was a different story. It's almost like separate strategy in terms of, it was a little bit more about showing some numbers, and we couldn't really, because we didn't have any numbers at the time to really show for high frequency strategies. We had to really just do what we can. So like we would show like some back tests, for instance, and then have to have a ton of disclaimers about like, we only did one back test, we don't overfit. We're not trying to, show you the best one. And although most investors probably didn't believe it anyway, they're like, they've never seen a bad back test before, right? So it's pretty much useless. But we still, tried to explain our methodology. We explained what we were doing. We did offer day one investors lower fees and higher controls, so more liquidity. And that helped a lot too. And also, higher communication channels in terms of maybe I would send weekly emails to certain investors so they would feel more, feel better about, what was happening, or at least understand that, what we were doing that week. And then, obviously offering them a discount on the fees and lower, better liquidity terms so they could maybe redeem at any point in time, maybe get rid of the lockup period, things like that. That helped a lot. And one thing we realized is even if we got rid of the lockup period, not a single investor redeemed, within, let's say, 1 or 2 months, or even within a year. Usually when an investor makes a decision like that, if they're a good allocator, they're in it for the long haul, but they just like having that free option available in case there's a pandemic, in case there's some event where they actually absolutely need the liquidity. So, but yeah, that was really helpful from day one to kind of get that. And then there are also, what's interesting, Aaron, is there also are quite a few investors out there that particularly allocate to day one funds, and they do expect the kind of lower fees and they expect, maybe a side letter or whatever. But the purpose is that they are interested in taking that risk with newer managers, and they might be interested, especially in the quant space. I'd say a lot of they're interested in that new wave of quant managers who they view as kind of geniuses from a dorm room, basically. So hopefully people like us, and I wouldn't call us geniuses, but just folks from that kind of background, and give them a shot and see if they have that next big thing.
It might be a little bit hard for you to compare, but did you find there was perhaps some additional interest in your offering, given that there are very few funds out there which actually offer investors exposure to HFT strategies?
It's a good question. Absolutely, yeah. Especially, surprisingly, I would say after Flash Boys came out, that was when we got the most amount of interest. Ironically, there were a lot of allocators who had read the book and they were like, wow, let's Google this. What are the high frequency trading funds out there? And it turns out the big high frequency trading funds, they all changed their language on their website. Now they'll say electronic market making or low latency trading. They'll try to get rid of that bad reputation and image associated with high frequency. We were the only firm that wasn't afraid at the time to just proudly say, look, we're high frequency trading. I've never bought order flow or front run or back run, middle run, a single person out there. But we do high frequency trading. We're exactly the definition that you would expect of what high frequency trading is, because we're trading literally in the nanosecond resolution here, getting data at that at the high speeds, and then trading thousands and thousands of times per day. Recently, like this year, the highest we reached in terms of volume per day was 7.1 billion. So that is pretty much the definition of what high frequency trading is. And so we were doing that. We were like, we're HFT. So people Google us. We show up, SEO. We would show up at the very top without really trying. And people would just reach out to us and be like, hey, we heard about you. Can we schedule a phone call? So that happened as well after a certain point in time, and was relatively, nice and helpful. I mean, obviously people would always have concerns like, hey, what do you front run? And like, how do you handle order flow and things like that? And we would just simply say like, we don't buy order flow at all. And it's just not the type of trading that we do. And we don't, do what they described in Flash Boys, where they're blasting holes, through mountains, under the river, whatever, to try to wire between different exchanges. Back then, we literally were just trading within a single exchange, actually. So we didn't need the speeds between, transatlantic cables or whatever. We didn't need any of that kind of stuff. So it made it a lot easier back then. And then, over time as well, I think a lot of the myths in the book have been debunked or explained by folks over time. So most of the investors have gotten a lot more, educated about our field, which has been helpful too.
I'd like to spend a little time speaking about how you built out the infrastructure. So you mentioned earlier that you built everything from the ground up, from scratch, internally. Is this unique for a HFT fund to do so?
I wouldn't say it's unique. It's something that, especially if you're starting out in an industry that's relatively still relatively new at the time, or just hasn't quite been commodified yet. It's something that you kind of just have to do to get up and running. I will say today, because after Flash Boys came around, actually there were a lot more startups that started doing HFT technology. Maybe like feed handlers for HFT, or thinking about open sourced kind of tools like that as well. So that has made it a lot easier to get to launch for a lot of folks. And usually today, when startups have a small budget, I just recommend look out there, see what you can use that's either cheap or free or open source. And surprisingly, there's a lot of stuff out there. So it's that, I guess, centuries old question of buy versus build. To be honest, it felt like we didn't really have a choice, but we couldn't, even if we wanted to buy, we couldn't afford it. So build it was on our end.
Right. I mean, yeah, it was probably a lot of cost up front and a lot of time spent, but does it feel like that's kind of optimal for you now? Like that's the ideal scenario, is that you own all your own software now?
It's great today. It was really awful before we launched. I mean, there were many frustrating days because we just had such an unknown timeline of like, we had roadmaps. We tried to map it out. Our investors demanded to see roadmaps and budgets and things like that. And we could try our best to do the roadmap. And then it felt like, I don't know if you know, like Zeno's paradox, maybe, I don't know. It was like one of those paradoxes we fell into where one task turned into two turned into four, and it just kind of grew and grew. And, you would think a trading system sounds so simple. And then you look at all the nuances and details and all the data sets and every single nuance in every data set and just all this stuff. And it was quite a lot to deal with for, a small team at the time. So it was definitely unexpected and quite frustrating, to be honest, before getting to launch. I think every company underestimates how much time it takes to get to launch, unless you're like, if you're non-quantitative or if you already know what technologies you're using, then sure, maybe you can hook it up overnight and, start trading. But even then, it still takes time. You got to set up the legal structure of the fund. You got to figure out, who your auditors, administrators, et cetera, and they all have to be ready to turn it on with you at the same time. So all those things combined made it quite a lot of work on our end, and pretty frustrating 2.5 years before we got to launch.
Yeah. Now, this might sound like a bit of a naive question, but just for anyone who might not understand, what's the right word here, might not understand what goes into building an HFT business, which is probably a lot of folks. What did you have to build? Like, what took 2.5 years? What were all the different components that had to be developed?
There's so many. It's like pretty much a type of, we had to build the entire trading system and ecosystem from scratch. So everything from, because we need direct market access, right? So we're literally placing trades ourselves at the exchange level. And so because of that, we had to build a system, order management system, basically system to be able to place orders, to see orders, to track orders, to figure out what's going on, to cancel things. And that also included risk management tools that we had to get basically verified by all the different, brokers, exchanges, et cetera. Everyone had to make sure that our risk checks were enough and that they were stable, and that if there was some, a crazy event that happened, that our systems wouldn't go rogue. And so we had different ways to check those types of strategies as well, to make sure that we didn't accidentally tank the markets ourselves single-handedly or make any big errors or mistakes on that end. So that requires quite a lot of work. It's very different from a tech startup, by the way. And that's one thing I've noticed was, with tech startups, you can launch an MVP and it can be bare bones, it can be broken, it can be pretty bad. And that's okay. Your clients, early stage day one clients, should forgive you for that because they know you're a startup. When you're trading, it has to be perfect. You can't have any error, any room for error at that level, because you're literally, if you mess up, you're done for. You don't have a second chance in this space. So that kind of process of making sure everything was perfect definitely took a lot of patience and energy and effort, and a lot of checks, making sure all the checks, balances, whatever else was in place as well. So that was a big thing. And then how do you process data, right? It's another big question of how do you get the data that we wanted? We had data directly from the exchanges, but then how do you process that data and turn that data into an actionable, some kind of value that we could extract from it? And so how do you do that as well? So that took a lot of time to figure out and to process and then, data pipelines, they would always break. We would always have some kind of issue that happened. And so figuring out how do we timestamp that data, how do we process that data, was also a big question that we would have in mind as well. Yeah, in general, it's quite a nuanced process, and it just had to all be relatively perfect on day one, or else, no, hedge funds rarely get second chances, I would say, unless you're famous and your name is already known, or you try to make yourself known. But back then we weren't, so we literally just had one shot and knew that we couldn't mess it up. So a little kind of scary, but we do feel fortunate and lucky to have made it this far today.
In saying that, what gave you the confidence, after 2.5 years of building this out, that when it came time to switch everything on, what gave you the confidence that the strategies were actually going to be profitable?
Oh man, to be honest, we didn't. It's hard to say. You can do as many back tests as you want. We had a simulator as well. We could simulate, strategies and orders and fills basically in the live environment too, which was great. But even then, it's hard to replicate 100% what's going to happen in reality. So we did as much as we could, test as much as we could, and then one day, I remember the first day we launched, we were just kind of like, you know what, screw it, let's just trade, let's just do it. We got to we were very risk averse at the time too, and we're scared, to do something we've never done, and we're just like, you know what, let's just try it, turn it on, see what happens, and hope for the best. And that's literally, what we did. And thankfully, things didn't blow up on day one. Thankfully, nothing, crazy happened, and we were like, okay, this is great. Actually, we could, we figured out, we needed that kind of feedback from the markets, and we're able to fine tune the strategies even more, and just continued going from there. So, but yeah, it was definitely a relief to finally have launched and to be able to tell people, okay, we finally launched. We're no longer, felt like I was a fraud all the way up until we launched. And so we're like, oh, we're finally a real hedge fund, and we can have a real track record to show people, which was fantastic.
You're in business, yeah.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news. With Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, and even the newest IPOs. And short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. It's a game changer. Create your account and start trading real shares within minutes. No subscriptions, no minimum deposits, just a one-time evaluation fee starting at $47. That's it. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you ever pay a cent. Every decade, the market reinvents itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pool's capital.
Just recapping those first few years, looking back on it, what would you say were some of the breakthrough moments which you had, and also some of the unexpected challenges which you came up against?
Oh, there's so many. I don't even know where to start. I would say, like, when we first started the business, we wrote down, some of the things that we wanted to save money on and some of the things that we wanted to spend more money on before getting to launch, because we had such a limited budget. But there were some things that were worth, hopefully, we thought were worth spending some money on, like a good lawyer is a good example, or maybe finding a good broker, like someone with a reputation as well, auditors, et cetera. We could splurge on. And then, things that we valued, like we wanted to be a flat organization. Back then, everyone was called partner. And, and then it actually did not go too well. And I have so many reasons for that. And we wanted to have perks, almost like, I don't know, we're a bunch of naive kids, right? So we literally thought about, like, let's make this like Google, like a Silicon Valley company with like free food and unlimited vacation and all these great perks. And we quickly realized, like, that those were both really bad ideas on the organizational side. You don't want to call someone. We hired literally head of HFT from firms like Citadel and Getco back then, and other firms, and a KCG back in the day as well. And they would come in and they'd be like, wait a second, why do I have the same title as this kid who graduated? Not necessarily me, but like, what about this kid you just hired, right? Who just came out of school? Why is he or she called a partner? And we were like, oh gosh, you're right. We realized that people actually felt less equal because of that rather than more equal, which was pretty bad. And then in terms of perks as well. It just didn't work out. People abused the perks like crazy, and it was kind of unfair. It made it more unfair and gave people kind of almost giving people too much choice sometimes is a bad thing. So things like that. And then, also splurging on things like lawyers and brokers and stuff. We realized quickly that it also wasn't worth it to hire just the biggest companies out there. That it's okay to go for a small hedge fund, that, it's okay. Your investors aren't going to look down on you for hiring a smaller lawyer, so long as they are still qualified to do their job, right? So just things like that, we made a lot of mistakes on. Trying to think of what else we did so much wrong that it's just hard to even begin to imagine. So I'm just trying to think of what else there was. Oh, I mean, we had to settle. We started off in my apartment actually after graduation. We worked in my apartment for some time until we were kicked out. We were evicted. And the reason why we were evicted was actually kind of a random reason. Well, the cops knocked on my door late at night. But what happened was we had built our server cabinets literally in the closet of one of the master bedroom, basically. And we rigged our own electric, basically we rewired the electric system and built our own box and stuff. And I think Jay Wang, one of my co-founders, he actually electrocuted himself in the process. So we were clearly not experienced at all. We should have hired a unionized, person, right, to do this. So we were doing some pretty sketchy things. We ended up, we're trading so much. We had so much going on the server side that we were literally using up all the electricity in the building. And you could also, people thought that we had a marijuana farm or something. Like literally people thought we were running some kind of marijuana farm. And so that's why the cops knocked on our door thinking like they were expecting to find us growing pot or something, or, harvesting drugs, whatever it was. And they came in, they're like, wait, what is this? And they saw there's computers and monitors everywhere. And they're like, what? Are you guys some genius hackers? Like they thought we were hackers. And we were like, no, this is a small business here. And, I did live in the other bedroom. So technically it's my home business. Right. And they were like, no, this is not going to work. You gotta get out of there and get a real office. And then the next day we literally packed up and moved to WeWork. Back when WeWork first opened in Boston at the time, our rent shot up. We used to pay $4,000 per month for rent. And then at WeWork, it was $12,000 per month. And so it's 3 times as much. And the room we were stuck in, WeWork, they pack you like sardines in these tiny little rooms. And literally, it was the size of the server closet that we had at the apartment. So it was just, what a crazy, just a turn of events like that, that really changed the environment and stuff. But lots of adventures like that we were willing to go through. And, finally, we're very lucky to finally get to a point where we could launch, I guess.
What a story. That's hilarious. If we look at DomeYard where it is today, I'd love to just ask you a few questions around kind of some trading metrics, if you will. So can you tell me how many trades do you average per day currently? Of course, it varies, but just on average.
Yeah. Recently, 2,500-ish, a little under 2,500 trades per day, which recently has not been a lot. We've done more in the past, depending on the market environment and stuff like that. But in general, it's up in the thousands, and completely automated. People are always like, are you really high frequency trading? Yeah, this is high frequency trading. They're all intraday and holding periods anywhere between. I mean, I know this sounds like I'm not marketing and we're not fundraising. I'm just going to clarify that right now so that people don't, SEC doesn't come after me again. So I'm just saying we're not fundraising, but we are holding period wise anywhere between, less than a second, microseconds, all the way up to hours these days. And we consider the hourly, holding periods, we call them midterm strategies, but to every single one of our investors, that's still high frequency to them, because mid frequency is like weeks. So days, it's a different, we live in kind of different universes, it feels like a little bit, but yeah, happy to answer any questions as much as I can without getting in trouble.
Okay, so are you flat at the end of each day, like you don't carry anything overnight?
We are. We used to do some overnight stuff, but realized that our niche was still in the high frequency, intraday type of strategies, and we also figured that the additional edge we would get from holding overnight wouldn't. It was mainly a constraint that we put on ourselves to be flat, but it's just something we've gotten used to over time. I would say there's really, these days, we could technically do overnight strategies again, but it's just something that we haven't really done yet for various reasons of, just profitability, risk, all those different factors that we need to keep in mind if we did that.
Okay. That number you gave before, 2,500, I actually, for some reason, thought that number would be a bit higher.
Oh, yeah. It could be up to, I don't know how much, 10,000, 25,000.
Okay.
It really depends on what we're trading and how the markets are reacting and how much, what the liquidity profiles look like and all the other things like that too. So, sometimes it's just, actually during the virus, the volumes did shoot up quite a lot because there's, lots of speculators, lots of day traders and a lot of institutions. Everyone's just very active right now. So it did shoot up a little bit, but for now, it's down to the 2000s.
Okay. The number of trades you make, is that somewhat correlated to the volatility of the market?
Good question. Kind of yes and no. Depends again on what kind of strategy we're implementing. Usually during very high volatile, periods like this, basically, we tend to have a lot higher volume, and the hope is that we perform better and can maintain some kind of neutrality to the markets. So that's definitely the case for, I would say, actually most high frequency trading firms as well, as just during periods of higher volatility. There tends to be just naturally more opportunities out there for folks to see and utilize.
Right. And are you able to share your win rate?
Oh man, I actually did not. That's one thing I did not ask the lawyers about. But in general, I will say, we're really happy with our performance this year. We did have like 2 very particularly disappointing months in general, but overall, we're definitely still by a huge margin beating, all of our benchmarks. So it's been a great time for us to, and also because this is also the first recession we've been through too, because we didn't go through '08. I was still in school. So so that was the other thing, is because of this, we were able to prove ourselves and be like, you see, we can finally show we've been through, the ringer. We've been through this these crazy times, and that we can show that we can, go through those and more. So, we've had some disappointing months, but in general, it's been all right.
Okay. And how about average daily turnover? Of course, that would vary with the number of trades, but just broadly speaking.
Oh man, just turning over so much. It can really add up to quite a lot. I mean, we would trade like recently, again, like the most was 7.1 billion, I think, per day this year. So we've gotten quite high and substantial in terms of the volume and turnover rates. And it'll probably continue like that hopefully for some time.
Right. And given that you're trading so much, and I don't know your win rate, but I presume it's above 50%. Are you profitable at the end of each day? Like, I presume a losing day would be pretty rare.
So we are not necessarily profitable at the end of each day. And I think that's something, unfortunately, for us and maybe even for other firms as well, it's become a lot more common. Like, I know we read articles about Virtu, not having a single losing day in years, right? And you're like, wow, is that standard for the industry? I'll say probably not. Most HFT firms, we can end the day losing, having a negative, much less money than like the day before. That does happen as well. So, the goal is though that we do aim for 100% winning days nonetheless. And, when a losing day happens, that's okay. We try to deal with it. Usually what happens on our end is like, we might have 29 winning days and then one big losing day that just wipes out everything we made during those 29 days. Sometimes that kind of stuff, does happen to all companies, all firms, but it's life, right? And we've learned how to deal with those types of days, how to mitigate those risks and learn from those, crazy experiences.
Okay. And now I haven't asked you what products you're actually trading. Like, what markets are you most active in?
Pretty much almost everything. We're not as active in we're active in primarily U.S. markets right now, but U.S. equities is probably the one big market that we're not as active in at this point in time. We've traded before in the past, but at this point in time, it's just not the market for us. Most of our strategies are concentrated in futures. And we have a lot of FX at this point in time as well. We do have some option strategies that we're utilizing at this point too. So, a lot of, Delta One strategies and not a lot of equities, although it's something that, we've every year, every month, we consider like, oh, maybe we should go back into equities again and try it out. It really just depends on the conditions and, what we're testing. We're constantly testing things behind the scenes and figuring out whether or not it's the right time to pursue something.
Okay. And is that all futures in the US, or not all of them, but is it, or are you more focused on like indice futures or commodity futures, or pretty much the whole mix?
It's the whole mix. Yeah, we're pretty agnostic within the future space at this point in time. They do have to be products that are, relatively frequently traded, or else it would, not be worth it for us to deploy a strategy within. So they're heavily traded products that we can hopefully take up, a chunk of the ADV. Not a lot, maybe like, aim for 1 to 3% of the average daily volume of that product. But so we do look for things like that. But in general, we try to be agnostic in terms of sector.
Okay. Now, this might be a bit of a broad question, but just on your strategies, in such a highly competitive area of the market that you compete in, how do you seek to generate alpha?
In terms of generating alpha, there's a lot of different things to kind of keep in mind on the parameter side. So I think the biggest thing is figuring out what are some niche areas that we can really take advantage of. What are some products that, we can kind of be able to map out and be able to make predictions on. So a lot of it's based on, small predictions, maybe a few seconds ahead of time on where different trades and products will go. So that's a big portion of it. But then also looking at I'm trying to think of other things we do on this side. Let's see, just mapping out in general, hundreds of different signals and like finding the different signals that we can trade, mapping those all out. And then we actually do use a layer of machine learning as well to do some signal selection throughout the day as well. So figuring out, what those signals are and what's going to make the most money during this certain environment. And then when the environment changes, what kind of strategies we want to pull back and what do we want to deploy. So that's always a really tough question. But it's surprising because most HFT firms, I would never say that we're an AI-driven machine learning-based firm, but we do use just a little bit to do some, basic strategy selection type processes on our end.
What data drives the majority of your trading signals? Is it order book alone, like looking at the market depth, or is there additional input from other data sources too?
It's mainly market depth, yeah. So just order book data is extremely helpful for us. We do have a little bit of what we call metadata. You might call it alternative data in different types of areas too. Whether that's usually it's like things like calendar data, right? Like every high frequency trading firm needs to know when bank holidays are and things like that, or maybe things like SEC filings or big economic, announcements or, Fed meetings, things like that. That kind of stuff does need to be factored into, the strategy as well. So we can't just be completely focused on the market data, but we just also keeping in mind all the other components of data as well. So yeah, in general, though, I think the biggest source is still, just market data. That's the bread and butter we need to kind of survive. And then from there, it's almost like a bonus if we can get other sources of alternative data that could help us out here and there as well.
Okay. Can you speak to almost like the strategy survival rate or the signal survival rate? Like, what's the edge decay like on these signals? Like, are you continually, innovating and revising your signals, or do most of them kind of last for a long period of time? I mean, I perhaps didn't really word that question very well, but I think you probably understand what I'm asking here.
Yeah, absolutely. I mean, the half-life of these strategies, can be relatively short. It could be a month, 1.5 months. and then within 3 months, the strategy is, pretty much almost worthless at that point in time. And so it's a process of constantly revising those strategies, a process of constantly finding new strategies as well, and modeling those strategies in different environments to see, how they would do. And then also figuring out why did the strategy die, and they could die for so many different reasons. A lot of it's because competition has caught up, or maybe because the environment's changed and the signals that you're looking at just are no longer valid for whatever reason that happens too. So there's all kinds of different reasons, but it's just important to be able to figure out when it happens and why, and be able to move on quickly and not get too attached to one or two strategies. But we have like hundreds and hundreds of different types of signals to potentially deploy and take a look at. So just making sure we're careful there. I know there's stories about, like, I don't know if you've heard, there's stories of like Renaissance, for instance, and other types of funds where, when people leave those types of firms that are doing really well, one of the biggest reasons why it's hard to spin out of certain, successful HFT firms and to just do your own thing and be more successful is a lot of it's because they're constantly revising their strategies over at Renaissance as well, I'm sure. When you steal a strategy, by the time you get to launch 3 months later, that strategy is already dead and it's just no longer effective. So that's definitely something that we do as well on our end. Is just, it's not on purpose, but just the nature of high frequency trading is just that the opportunities you find may not necessarily last for a very long period of time, and they might be really niche. So once we find it, and once that niche kind of goes away, then we're on to, hopefully the next thing.
During the trading day, what level of human input or decision making is there? Obviously, the trades are all automated, but is there any human intervention during the trading session?
Oh, it's a really interesting question. Well, first, I will say, like, a lot of people have this vision of high frequency trading being, a bunch of robots taking over the world, or, machines, and, that are out of control with, humans not being able to really understand what's going on in this black box. And that's really not the reality at all. These trades are being heavily monitored and, by humans throughout the day when we're trading. And, really just gathering all kinds of data about what we're doing and stuff like that. There's a huge human, obviously we're not having a human sit there and click to make those trades. It's just being placed automatically. But there's always a human behind the scenes to tweak the strategies, or to tweak some parameters, or, change some of the risk parameters, things like that. And a lot of it's in code, but just kind of changing that coding of what the strategy might look like. So yeah, there's a surprisingly large human element in terms of what we do. And, the strategies also, they're only as dumb as the humans who are, creating them. Hopefully as smart, but, I always say that they're as dumb as the person who created it. So absolutely, we need that human intervention constantly to make sure that nothing goes rogue or, crazy. The other thing is, like, I'm trying to think of, the markets as well, right? Because this isn't like a closed loop game. It's not like a game of Go or, I don't know, chess, where there's rules and everyone's going for the same goal. In the financial markets, things are constantly changing to the point where even today, right, we see a lot of things like oil going negative, things that economically, like in your textbook, you would never, it just makes no sense, and that happens all the time. And a lot of that might be it's just driven by very human behaviors. And so you need to have a human behind the scenes to understand those behaviors in order for your strategy to do well. You can't just have a strategy that, you can, even if it's some kind of deep learning model, or, if it's learning by itself from its own inputs and stuff like that. Like that's great. But again, you can't quite model the financial markets. And we've seen startup after startup, including Watson as well, IBM Watson trying to model the markets with their ETF, and you look at how they're performing, and it's just not the best start to the ETF AI driven, stuff. Yeah, absolutely. My personal opinion as a high frequency, ironically as a high frequency trader, is that there is an important human element that, we can't forget behind the scenes.
Now, as you are a high frequency trading fund, obviously speed and reducing latency is a big factor in what you do. What measures do you take to reduce latency, both internally and externally?
the biggest thing people always imagine is like, oh, you're doing, what they did in Flash Boys, but we don't do any of that. Biggest things on our end is purely pretty much, just internally making sure, okay, let's, gather data the fastest we can. Let's make sure that once the data is in place, between getting raw data and processing that and turning it into an actionable strategy, that we can reduce the amount of time it takes to be able to do that. And then also be able to run that strategy, on live data and be able to, place those trades as fast as you can. And for latency, it's basically, as soon as we discover a decision we want to make, the time between that decision and actually implementing it, that kind of that time we do try and reduce as much as we can. Whether that's just through direct market access, with the exchange, or making sure that our order management system is structured in a way that is fast and efficient and can process a bunch of orders at the same time without having too much lag. I know I'm trying to think of we've had some, I know on the development side, like we'll maybe consider like even just things like shortening names of stuff might help a little bit too. So just making sure that our names are a little bit shorter so that computer-wise, it takes a little less time to process. So stuff like that might work as well. And then making sure that we optimize for different strategies on the latency side, the strategies themselves. So making sure that we're optimizing on that front so that they can be, code-wise, right, to be a little bit faster and take a little less processing time in order to complete. So that's definitely important as well. I will say one other thing though is, I know everyone obviously talks about speed and thinks about speed when it comes to high frequency trading, but on our end, I think we found our niche in terms of, we're not trying to aim for being like the top fastest high frequency firm out there. And I think most firms are like that these days where, we don't play the hardware game actually. So we used to assemble our own hardware, buy the best thing out there. And then we realized every year they're going to release a better, FPGA, a better, piece of hardware somewhere out there. And do we really want to pay an extra $1 million? Is it really worth it? Well, you just realized it just wasn't at some point, and there were lower hanging fruit in different areas. A big reason, by the way, is also because at the exchange level, if their latencies are slow and there's a lot of jitter happening at the exchange level, then even if we did place an order really fast, the decay, there's still a little bit of a decay in terms of the timing it takes and the alpha that we end up getting. And so we were like, well, why don't we just figure out, we call it lower hanging fruit in terms of maybe better signals or looking at better products out there that, we could take more advantage of without having to compete at the microsecond level all the time. So that's, going for strategies that are have longer holding periods as well, and may not be, what you would typically expect of high frequency trading, just trying to be fast.
Now, one of the things which I understand about HFT strategies is that they have capacity constraints. And that's what's kind of interesting about what you guys do is you are a fund where most traders who are running HFT strategies are mostly prop model, whereas you're a fund. And I guess that's one of the reasons is because HFT strategies typically have constraint capacities. How do you deal with that aspect of it?
That was a great question. It's one of the biggest things that keeps me up at night, actually, is, HFT is, although people always assume it's this menacing thing, we're not a scalable business. The industry is just not scalable given the nature of what HFT is, and that's fine. I think that could be a fair thing. And, it's just how things are. The capacity constraints, the reason why we're a hedge fund to begin with was we didn't even have $1 million or $100,000. We were literally negative money because we were in debt. So we didn't have any money at the time to trade. And we supposed, well, even if we could start a small fund in the meantime, it would be better than nothing and at least give us enough of a boost in our early stage careers to, have to know the industry better and also to hopefully, learn a thing or two. So, so that was the big thing there. But, if we could, let's say if we could start today, yeah, we would probably be a prop shop instead of a hedge fund structure. Because the hedge fund structure, it's great in that, yeah, you have all these external investors coming in, and that's good for us to get to know the industry better and to see what's happening out there and to meet some great investors. The bad part is obviously it's just, it's a lot of extra work, to have to do the weekly, sending newsletters out or sending emails and, answering questions and stuff, but also regulatory wise too, registering with all the different, SEC, NFA, whatever other countries and jurisdictions that we want to be involved with. So that is, just a lot of administrative work, costs you time and money. Having a director in the fund, thinking about the legal setup of the fund structure, all this other kind of stuff, like that costs surprisingly a lot of money even before getting to launch. And so yeah, that was kind of the trade-off that we had to make, I guess, in order to start the hedge fund structure.
Right. Now, Christina, just one last question before we close it out here. Is high frequency trading as profitable as everyone understands it to be? I'm not sure if this is public information or if you're able to share it, but if so, are you able to share some performance numbers?
Yeah, absolutely. So I would say it depends on who you are, because some people imagine that HFT is just this money-making, cranking machine that never loses and stuff like that. And that's definitely not the case at all. It's a very it's fallible. It has issues, and that's the reason why a lot of HFT firms, that existed 10 years ago are no longer around today, right? It's because they still died for one reason or another, or they got acquired, or they just were no longer the profitability that they used to be. I think a good analogy, by the way, is like in the crypto space as well, where if you started a crypto hedge fund, I don't know, back in 2012 or 13, yeah, maybe you were great, you're good. Congrats on being one of the, earlier funds, right, in that space. But if you started a crypto fund today, most of the alpha is going to be pretty much gone, so it's kind of a similar thing where it gets harder and harder to compete as more people flood the industry like that. But I will say, like, it was really surprising for me because we had spent 2.5 years literally making no money at all, which is, for any startup, that's extremely frustrating and, almost like heartbreaking to see. And then the day that we started launching the strategies and stuff, we were super nervous. And I remember turning it on and literally there was nothing. Like, we weren't trading at all and just nothing was happening. And we're just waiting around the table, in our office, just huddled there being like, what's going on? Why isn't anything happening? And then we just kind of gave up. By the end of the day, I just went to go grab, I think I went to go, eat some ramen or something. And then someone called me over there like, Christina, no, come back. It's starting to trade. And I was like, oh my gosh, the market's right about to close. And we literally started trading at the close and we checked our balance and we had made $70,000, in like a minute. And we were like, oh my gosh, that's more money than my parents make combined in a year. And that feeling of like, oh my gosh, have the tables turned, and hopefully we won't lose, hopefully we won't lose the money, but that kind of feeling of, oh my gosh. And then thankfully that, continued for some time. And we felt very, just like, holy crap, the wait was worth it.
And what about like annualized returns, that type of thing? Are you able to share that info?
Unfortunately, I can't because we've gotten in trouble for sharing it in the past. For like, it's considered marketing, and it just does not go well with. We were audited quite extensively in the past couple of years or so, and this was always one of the things that they always get us on is they'll listen to the podcast and be like, oh, why did you say that, and why did you have this tone when you said it, and like this could be construed as marketing in one way or another. So unfortunately, we're not allowed to market. I would love to though, because I'm so proud of, what we've done. Unfortunately, we're not the type of fund that can market that kind of information.
Understood. That makes sense. I mean, the last thing you want is legal hassles. So totally understand. Well, Christina, just such an amazing job. It's really inspiring to see what you and your co-founders have done and what you've achieved over the past, I think it's 8 or 9 years now. So, especially having started from scratch, like built everything from the ground up, it's just incredible. Awesome talking with you. I'm very grateful for your time. And I know we've been trying to set this up for a little while, so I'm glad we could make it happen. If somebody wants to find out more about you, I know you've given a few talks and that type of thing, which are available on YouTube. You're also on Twitter. Can you please share your Twitter handle?
Sure. It's just my name. It's at Christina Chi, which is spelled QI. Yeah, please feel free to check it out. I'm a little crazy on Twitter, which a lot of people don't like, but I think there needs to be more loud vocal voices in this industry. So, and hopefully I have some reason in terms of most of the stuff I say, and am not just completely crazy like some other folks in this industry, which is fine. But everyone has a different personality, so feel free to check that out. And then also recently I've been working on a data venture as well. So if you guys are interested in market data and infrastructure co-location, that kind of stuff, definitely feel free to reach out as well, because we do some really cool stuff on that front too.
I did mean to ask you about that, actually. I mean, if you have time, do you want to just give a quick summary of what you're working on there?
Sure. Basically, one of the biggest challenges we faced when we were launching the hedge fund was we had spent over $1 million, it's a shameful amount of money, over $1 million on data and infrastructure. And we feel like that barrier to entry is way too high. We want to lower that barrier for other folks out there. And just so you know, this has nothing to do with DomeYard. We're completely unaffiliated. We're not front running. DomeYard's not taking that data at all from anybody. So it's a completely different venture. But basically just offering, data that's a lot. It's the quality that we expect from institution quality data, but we sell it a la carte, so it's broken down. You can buy literally just one security if you wanted to, or the entire thing if you wanted to. But the goal is we make it a lot cheaper for folks and lower that barrier to entry. So it's called Data Bento, if anyone's ever curious, like bento as in the bento box. And the goal is people can purchase data from various different sources. And we do live and historical. So you can have live data feeds from various different sources, but in smaller chunks than what we typically see in the market. So it's been fun to work on that. For me, it's meaningful because, I've been spending, people always ask me questions about morality, you're an HFT, right? How immoral can you be? And I've always wanted to do something that hopefully would bring some value to the industry and have some meaning. And so for me, Data Bento has been fantastic in terms of bringing that kind of value. And I'm very lucky to, be able to have, to have the hedge fund reach a stage where I can be more hands-off now, and that we have a team, and that, the team is fantastic to kind of take over a lot of the day-to-day operations and things that I didn't want to do as much. So that's been very lucky. And then, to be able to start this data venture and hopefully help people out, that's been a dream come true for me.
Yeah, that's cool. That's really cool. I'll make sure to include a link to that in the show notes. And if someone wants to find out more about DomeYard, what's the website?
It's just domeyard.com.
Okay, nice and easy.
Yeah, just so people know, we were named after the MIT Dome and Harvard Yard back then. We didn't want to name the fund after ourselves, and then by coincidence, the .com was pretty much free, so we were able to snag that pretty quickly and got pretty lucky with the name.
Nice. Well, Christina, very grateful for your time. Really appreciate you doing this. Thank you very much, and we'll talk again soon.
Thank you, Aaron. It's been an honor.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade large positions and scale your strategies without risking your own savings. It's time to trade with more capital, actually worth more of your time and effort. Ready to trade the pool? Click the link in the description and join Stock Trading Revolution today. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hi traders, and welcome to episode 199. This here is another compilation episode, so just like the best of risk management episodes from a few months back, except this time I've compiled some of the best clips on trading psychology. Again, I dug up way too much from the back catalogue of almost 200 episodes to pack into one episode, so this is only part one. A part two will follow shortly. Besides creating a go-to trading psychology resource, I hope this might also highlight some past episodes that you've not yet heard. So before each clip, you'll hear I mention the episode number in case you want to go back and listen to the full interview. Plus, all episodes can be easily located in the show notes at chatwithtraders.com/199. Now, to get things started, this first clip is a gem from the very early days of Chat with Traders. It's taken from episode 8, and it's options madman Anand Sanghvi, aka Lucci. Lucci has been on the podcast a couple times, and given some of the large P&L swings he experiences, it's always a treat to hear him talking psychology. What are some of your best tips to sort of keep a handle on your emotions? Do you have any sort of advice on the subject that you wish someone shared with you when you're starting out?
Yeah. And that's the thing. Like, you go through so many different emotional stages of your life, you know? So you got to remember, like, whatever environment that you have around you, that's what's going to influence your decisions, and that's what's going to influence your emotions. So, for example, when I was 23, 24, you know, I just had a baby. You know, my thing was all about, you know, how do I make sure I got rent and all that kind of stuff covered every single day. You know, so when I went about trading, it was all about, okay, how do I make $4,000 a month? How do I make $4,000 a month? How do I make, how do I make this kind of money a month? And I wasn't looking at the big picture. I was never looking at the big picture, simply because, like, what my environment decided how I was going to live, how I was going to make decisions. So whatever you're going through at the time, you always have to be bigger than that. You know, you always have to take a step outside and look at what you're going through and realize that in trading, none of that shit matters. None of it matters. And it's so difficult to do this. It's so difficult to do this, to step away from having to make money, to step away from, living a certain lifestyle or requiring a certain lifestyle. It's so difficult to step away from all this stuff. And I would say the one most important thing that I wish somebody told me was that to not think about the money when I'm trading, you know? And again, you know, this is not something that you learn overnight, but it's something that if you have it in the back of your head when you're starting, you know, you're closer to the bigger picture than I was, you know, so it took me years to figure that out, you know, and it was always about your lifestyle. Like, trading can consume you and does consume a lot of people to the point where they don't leave their houses, you know, they don't go out, they don't talk to people. You know, they become very secluded and lonely and loners, you know, simply because, like, they're slaves to their P&L every single freaking day, you know, and that's all it's about. And that's not what it's about, you know. So living a healthy lifestyle and you know, enjoying time with friends, whether you're down on your account or down on the year or you're up or whatever, you know, having a life is so important to being on an even keel when you're sitting there in front of the computer, in front of the trading screen, so always thinking about that big picture, which again, most people stop thinking about it the second they have problems trading, or the second they have problems in their environment that they have to deal with. And then subsequently, those problems affect their trading decisions. And that's all it is. Most of the bad decisions that you make are a direct result of your environment, or you projecting the problems that you're having in your environment or in your life onto the market, onto a market which doesn't give a shit about it. We're just talking pure probabilities. Market doesn't care if you got issues. It doesn't give a damn. But you're going to project that onto the market simply because that's what's going on in your life. That's what you're thinking about. You're thinking about rent. You're thinking about this. You're thinking about, how shitty your life is maybe at that time, or how great your life is at that time. You're thinking about all those things, and you're projecting this onto a probability mechanism, a market which doesn't give a shit. So that's the biggest thing I could say. Keep thinking about the big picture. Don't fall into the day-to-day, hustle and bustle of the market all the time. Realize that the market's not going anywhere. There's going to be money to make tomorrow, the next day, the day after that. So don't get too wrapped up in every tick of the markets.
Still tying in with that emotions and psychology sort of thing. How do you keep the confidence up to push on and pull the trigger after a run of losing trades?
This one's tough, man. It's tough. It's like taking a bad beat. It's always like taking a bad beat. It takes time. Everything is about time. So let's say you get a run of bad cards, or you get a couple shitty months where you take a bunch of losses. It just takes time. It takes time for you to step back and realize what happened. And then it takes time for you to stop being depressed. Like, humans have this innate sort of ability to what is the word I'm thinking of? Self-doubt, or to beat themselves up. After something bad happens, like, humans always go through a period of time where they beat themselves up about it. They're like, dude, I shouldn't have done this. I shouldn't have done this. I shouldn't have done this. Right? They kick themselves in their ass too hard. And it takes a while to work out of that process, and to start feeling more confident about yourself, to start feeling, like you actually can do this. You know what I mean? I mean, during a period of bad losers, there's nothing in the world that feels as bad. I mean, again, obviously there's worse situations everywhere, but it's a horrible feeling in the pit of your stomach. You're just like, dude, can I even do this anymore? And it takes time. It always takes time to come back out of that scenario. And that's, again, why it's so important to stay on that even keel, to continue to live your life and enjoy your life, and to continue to have other things around you that you're motivated by as well. It can't just be about the markets all the time, So that will help those, those periods of self-doubt and, you're beating yourself up, depression and all that kind of stuff. That will help making those periods a lot smaller, so you can, automatically bounce back and jump back into the game. For me, it's like 2 months or 3 months where I sort of like size down. I'm like quiet, and then finally, once I get a couple of winners, I'm ready to get back in there.
Next up, Jared Tendler from episode 86. Jared is a mental game coach who works with world champion poker players, professional golfers and pool players, and traders too, with the aim to reduce negative and excessive emotion from decision making. And I understand that one issue that affects traders or poker players of all levels is something you refer to as tilt. Would you mind sort of describing what is tilt and how to recognize when you're actually, as you call it, on tilt?
Sure. So tilt, there's kind of a couple definitions for it. One was the definition that was there before I came into poker, which was tilt was pretty much any reason for you to play suboptimally, right? So you're making decisions that are less than what you would consider to be your best. And so upon studying, poker players and their descriptions of tilt, for several years, I really realized that, 80+% of their descriptions tended to be about them getting angry and making bad decisions. And so for me, tilt is just another word for saying anger. For a lot of poker players, they'll say, tilt is anything, as I said, less than playing your best. But what if you're drunk? What if you're tired? What if you're fearful? All of those reasons are going to need unique solutions to them. So, anger is really the biggest one. In trading, I would call the equivalent greed and fear, and maybe to a lesser degree, loss of discipline. They tend to be the words that traders use most often to describe their mental game issues, when I don't think that they're actually experiencing greed nor fear or a lack of discipline, that it's something more than that. But within poker, what I did was break down 7 different types of tilt, or 7 different types of anger that would exist. One was running bad tilt, which meant, players were losing for several days in a row, sometimes weeks or months, and they were, just getting crazed as a result of it. And the solution to running bad tilt has to do with the understanding that emotion accumulates over time. Okay, the brain has a mechanism by which it can, in essence, digest emotion. Right. So you have a stressful day, you got angry one day, and so you go to bed not in the greatest of moods, but you wake up the next morning, you feel fine. Right. Nothing bothering you. You feel it's like a normal day. Well, where did the emotion go? Right. In essence, the brain has like a stomach that digests the emotion, much like it would the actual stomach digests food. But what happens is when there's like a really emotional day, or then you might go to bed and your sleep might even be disrupted, in part because your brain is digesting all that. And then when you wake up the next morning, you don't feel quite right. It's almost like an emotional hangover, so to speak. And so when you start that trading day, or the poker player, goes down and sits to play poker again, they're not starting with like an empty cup in a sense, right? Their tilt threshold, their threshold by which the anger is going to affect their decision making has been lowered, right? Or their emotional level has already risen, however you want to think about it. And so in essence, it's going to take less tilt-inducing stuff to get them pissed off to the point where they're going to make bad decisions. So dealing with that accumulated emotion becomes really, really important. And so for traders who have this particular issue, one of the best ways that you can start to break apart that accumulated emotion is to do some journaling, is to write. And the writing, the purpose of it, first and foremost, is to get out of your head what those emotions are, right? You go have a couple beers at the end of the day, right? You're going to feel better, right? But are you going to actually get rid of the emotion? Probably not, right? So venting to other people, has a way of getting the emotion out, but it's also not as productive. So keeping things inside is not a great thing. When you vent on paper, what you do is you give yourself a record of the emotional reactions that are occurring, and that becomes helpful when you go back and look at it a day or two later and you see, like, what the hell is going on here? Why am I getting so pissed off? And that's an important question to ask, regardless of the mental game issue that you're dealing with. In particular, we're talking about tilt. Why is it that I'm getting so pissed off here? Is it because I just can't deal with losing this many days in a row? And so then you're able to start to solve things. But at a minimum, you can start to deal with running bad by just getting that emotion out and minimize the accumulation day by day so that you can give yourself a chance to kind of reset. The next type of tilt I talk about is called hate losing tilt. I should have actually called it competitive tilt in retrospect, because like traders, poker players, you're going to lose a lot, right? And for people who are competitive, especially those who are athletes or were in any kind of forms of competition earlier in their life, they have more control in those other avenues. They've been more successful. And so they have more control over winning and losing. So not only do they hate losing, but now they've entered a profession where losing is built into the fabric of it, and it just pisses them off. There's no way around it, right? There's a lot of competition. Well, what you have to do there is have to really start to understand exactly what it is that you're competing for. And that's how you can start to correct it and reframe the nature of the competition, right? And so, you can look at your goals as being something that you're competing for, sometimes confidence or good feelings, emotions, you're competing for. And when you start to understand exactly what the nature of the competition is, you can start to round out some of the edges that will create those problems. Injustice tilt, entitlement tilt are two ones that I've mentioned already today. Mistake tilt, revenge tilt. Kind of always a fun one. In poker, that would be a particular player is just constantly beating you, or they say something or do something that kind of just annoys you, and then they beat you, or a particular player who has just gotten the best of you, time after time after time, and they, now just hearing that person's name gets you pissed off. As I mentioned, right, trading is a little bit less personalized than poker is, but revenge trading definitely exists, and in a way of trying to get the market back for screwing you, right? So it may be less about a person and more about getting the entire market back. And then the last one is called desperation tilt. And this is where I would say there's a line drawn between a performance issue, right, versus an actual gambling problem. And this is a very important distinction to make for some traders and poker players to make, right? A performance issue means that what you're doing, and let me describe first. So desperation tilt basically means that when you are so desperate to recapture your losses that you'll pretty much do anything, right? You're going to increase your bet sizing. You're going to enter trades that you're going to start placing bets in industries or in names that you don't even know anything about, right? It becomes more pure gambling in a sense. That desperation to win overrides all logic, and you do a lot of stupid shit that you're regretful of, the next day or even later in that day. When it's a performance issue, you can handle those losses. You can handle all the dumb stuff you've done. When it's a gambling issue, now you're betting with life savings. Now you're betting with money that you borrowed from friends. Now your life is becoming impaired, and that's where you've got to really look in the mirror and say, do I actually have skill in this game, or am I just a degenerate gambler? And fortunately, most of my clients have been in the former category where it's a performance issue and we are able to correct it. But if somebody has, a gambling problem, like I mentioned, I refer them to somebody locally because it's not something that I work on.
Now, I'd like to share with you what I think is a pretty fascinating segment from Michael Samuels on episode 165. Michael's an equities guy with a prop trading background who now predominantly trades news flow around mergers and acquisitions and other major events. Can you tell us a little bit about this situation with Qualcomm? And I can't remember who the other company you mentioned was. You said this deal's kind of falling apart at the moment. I mean, how are you trading around that?
One of the mistakes that I've made is I'll call it the cost of time being sunk in, or time sunk cost. The more time that I put into something, and the more money I invest in it, the more research I do with it, the harder it is for me to change my mind on it, if that makes any sense. So the short story in this, again, this is 19 months that I'm going to try to sum up in 2 minutes. The short story is Qualcomm tried to buy this company, NXPI. They needed 9 different countries to approve this deal. 8 of the 9 countries agreed, and 1 country did not, and that was China. And what ended up happening was it got very wound up and wrapped up in all sorts of different international conflicts that are currently happening between the United States and China and Trump and and Chairman Xi. And I have found myself at points, head spinning over this thing, and I've gone to drastic measures to try and gain an edge in this, and the only result has been that it's just made me crazy. And, if you want to, I can tell you about some of these drastic measures.
Sure, yeah.
So, and again, you have to stay within the confines of legality, right? So there was a point in this story where the Wall Street Journal broke a story that said that Qualcomm executives were waiting for the 10-4 from China to fly over there and finalize the deal. So in my mind at that point, the signal that I wanted to see was the Qualcomm plane taking off from San Diego, California, and going to China. And now there's various services that track these sort of private planes. But in this case, that wasn't possible. And the reason that wasn't possible was because Qualcomm themselves blocks the tail number on their plane. So the next thing the only other option you have then at this point is, and again, this was a story that I had made up in my head, was that the only way to track this plane is to physically be out there in San Diego and watch it take off. And so I literally just posted we have something called TaskRabbit. I don't know if you guys have that there, but
We've got something similar, yeah.
Okay, so I posted something on TaskRabbit, and the TaskRabbit post read something like, go to this airport and watch this plane take off and send me a video of it. And I got a response in about 15 seconds. And this woman who was, just a mother of three, she would drop her kids off at school, and she would go to the airport, and she sat there at the airport for me day after day after day after day. And she was probably there for like a week. And I had to deal with her, and the deal was this: I'm going to pay you X, this much a day, and if you get a video of this plane taking off, I'll give you this bonus money, this big bonus money. And she calls me a week later, and she says, it's happening. And, you're probably wondering, well, how did I know where the plane was going, right? That's the big question. They have this plane. How would I know? And the thing is, you don't. But the way that, and again, I was making a lot of this up, perhaps, Qualcomm has two planes. One is for short distances and one is for long distances. And so I was tracking the big one, and the big one took off, and she sent me a video of this. And of course, she sent me the video of this at like 3:45 on a Friday, where I have 15 minutes to make up my mind of what I want to do with this situation. And, that's the kind of stuff that can make you crazy. And because you think you have this piece of information that no one has, you think, well, what if it happens this weekend and I don't take advantage of it? So I had better do that now. And not only that, but I was so mentally wrapped up in this thing. I was so emotionally committed to it, like it was a person, this trade, that I wasn't thinking rationally. And of course, I ended up putting on a large position. The deal is still not happening. And, it's probably taken a few years off my life just watching this situation unfold.
Right, man, that's a crazy story. Have you done things like that in the past? Like other situations where you've kind of done some, I don't know, stakeouts?
Excessive due diligence?
Yeah, let's call it that.
Nothing to that extreme.
Okay.
Nothing to that extreme. I mean, a lot of this job, in my opinion, is, you could call it getting lucky, but you have to be on these conference calls. You have to be in the game. Don't be lazy. One of the best trades I ever had, I happened to be a bit lucky, but I happened to be on this, Lumber Liquidators, which is sort of like a lumber supply company, conference call in 2014 or 2015. And they happened to mention in the call for, at complete random, that they were going to be, on a show called 60 Minutes, which is an investigative journalism show that Sunday. And it was like, a grenade went off in the middle of this call. And one of the analysts, it was an earnings conference call. Suddenly no one cares about the earnings. And they said, well, what's the deal? Why are you going to be on 60 Minutes? And he said, well, I can't really describe, the contents of it, but I will say this. I stand by the safety of our wood, which implies, oh shit, well, the whole segment's going to be that the wood's not safe. And you probably had 5 to 6 minutes before this hit, the Bloomberg wires and all the major news wires. And, in trading, that's an eternity. 5 or 6 minutes is an eternity. And, I did great in it, but you look back and you say, well, man, I could have done this, or I could have done that. But I guess what I'm trying to say is one of the things to always remember is just don't sit on your hands. Get in there, be on every call that you can get on, just be there.
So when you got that information, how did you actually build a trade around that? Did you just instantly go short the stock, or was there something more to it?
In that situation, and again, I've replayed this in my head, oh, I should have done this or I should have done that. I mean, at that point, the stock was trading for 69. You could have shorted it all you wanted down to, let's say, there was unlimited amount of liquidity in this name till, 65. And at that point, I think it was still like maybe down small on the day. And just so you know, on Monday after that segment, the stock opened at 30. So,
Wow.
you know, there's lots of things I could have done. You know, I could have bought puts that were going to expire the following Friday and, you know, before the vol and the puts had exploded. There was lots of things I could have done. What I did was just sort the stock outright, because in the moment, you know, when it's happening, you just think, what's the easiest way for me to get exposure?
This following clip was recorded at a live event which aired on episode 163 with the legend John Moulton, best known as Rambo, a nickname and reputation he earned while throwing around huge volume as a spread trader in the pits of the Sydney Futures Exchange. Let's go back to the point you made where you spoke about how it's important to lose. It sounds like you've got a few things you want to say about that, so let's hear it.
Well, it's just my observation the last couple of years of my life that a society in general doesn't really teach people how to lose. They teach you how to win. Winning's easy. Everybody knows how to win. You know, they see LeBron James win a basketball game making the last shot. He knows how to win. He's a winner. Winning's easy. But is there anything in society that teaches you how to lose? Is there a course at university you take that says, hey, come take this course, we're going to teach you how to lose? Engineering. There is one thing that will teach you how to lose, and that's organized sport. Because in organized sport, you will lose. Okay? That's the only thing I can think of that teaches you how to lose. Other than that, you have to figure it out for yourself. You really do. And losing and how you deal with losing is extremely important in trading. Because winning, I'm telling you, is easy. That's easy. It takes care of itself. The key to trading is learning and figuring out how to take a loss and how you deal with that up here. Do you hang on to it and let it bother you? Or do you release it and let it go? All I can say is that you need to learn from when you're trading, you have to learn. And you can learn from being correct and say, I did that correct. And you learn from that. And you can also learn from when you lose. And when you lose, you have to experience the loss, feel it, learn from it, and spit it out and let it go. And focus on the next trade. If you hang on to a loss too long, it will pollute you. It will not allow you to make the next trade. And you have to focus always on the next trade. The next trade is the most important trade in the world. Not the last trade, or the trade before that, or the trade before that. Just let the trades happen and focus on the now of trading.
Do you have the belief that each trade is individual of itself? Like, there might be times where you're actually going through a rough period. Do you still treat every
Why
trade?
are you so negative?
I'm not, but we're
Rough
talking
period?
about losing here. It's,
No, that's true. I mean, the way I've always traded, I don't want to use the word high frequency because you guys have algorithms that are high frequency trading algorithms, and I'm more of a hands-on trader. And what I'm always doing is I'm focusing on the next trade. I don't think about the trade before it. And I'm not analyzing the risk I just took with that previous trade. It's just a fucking trade. I don't care. You know, it's just put it in the books. Let's get on to the next trade. And because I'm mainly a spread trader, so I'm buying here, I'm selling here, I'm trading 20 different things all the time on the bid and offer, blah, blah, blah. A lot of times I have no idea what I'm doing. I'm just trying to make good trades. And then the market closes and I go, I wonder what my position is. Let's look at that position calculator. I look at the position and go, well, okay, I'll get that up on the chart. I'll get that up on the charts and see if that looks good. Oh yeah, it looks good on the charts. I like that position. I might keep that for a day or two.
Mambo yetu itakuwa fine, future bright na bambika na light.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk trading. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds regulated as a registered broker dealer and member of FINRA.
We've got a great episode for you. Starting out with juggling multiple jobs as a valet driver, firefighter, and entrepreneur. Our guest, Jack Kellogg, at 18, about 6 years ago, dreamed of financial
not really affect them because they could do whatever you want. So I didn't really have like one, I want to buy a Ferrari or I want to buy this house here. It was kind of just, I know I can buy those things, but I have to focus on gaining the freedom and growing my account. I know those things are very far away.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet your strategy. Invest in stock and conditions at tastytrade.com.
This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome, everyone. This is Chat with Traders, episode 193. I'm your host, Aaron Fifield, and with me is Greg Newman, who previously featured on the podcast in 2000.
Mambo yetu itakuwa fine, future bright na bambika.
Every decade, the market reinvents itself. Online brokers open
relevant focus on current events. As we've seen making headlines recently, reserve banks of numerous countries have been adding liquidity to the market in an effort to stabilize economies. While some listeners will already understand exactly how reserve banks conduct these operations, I figure there will be many others, myself included, who don't completely grasp what takes place below the surface. To get clarity on the subject, I kindly asked Kevin Muir to appear on Chat with Traders for a second time and to explain the actions of reserve banks during this market downturn. Because, in my opinion, Kevin has a gift for analysing and explaining complex subjects in a way which is easy to follow. Kevin was a derivatives trader for a Canadian bank during the 90s and has been an independent trader from 2000 onward. He also writes a brilliant financial newsletter, The Macro Tourist, and co-hosts the Market Huddle podcast. For links to his newsletter, podcast, as well as our first interview, check the show notes at chatwithtraders.com/192. Kevin, before we get into your thoughts and your perspectives too much on what's happening, let's just get some clarity about what's actually taking place.
marketplace that they're looking for $6 billion of these securities. Then they go talk to the primary dealers and they tell them to submit their offers. And the primary dealers send in a list at that scheduled time. And then the Fed actually just lifts their offers. They actually buy it. So the primary dealer was holding this in inventory, and they're no longer holding it in inventory. And in a lot of ways, it's that simple. They're buying the assets from the marketplace that the marketplace is having trouble financing and warehousing.
So what's an example of a primary dealer? Like, who would that be?
It would be a JP Morgan or like Royal Bank, I believe, is a primary dealer. Even though we're Canadian, we're a primary dealer. They're basically just very kind of senior banks that deal directly with the Fed.
And why would someone like JP Morgan or whoever the other primary dealers might be, why would they actually want to sell to the Fed?
Well, they're selling to the Fed because they're making markets in these securities all the time. And not only that, it is their job to go and to facilitate the trades of the Fed. Just like it's their job to bid on the securities when the Treasury is auctioning securities, they're actually obligated to bid for a certain amount. It is their duty to actually help the Fed conduct these operations. Someone has to trade with the Fed. They can't just go out and buy directly from the clients. They're basically a middleman between the clients and the Federal Reserve. Interestingly enough, Aaron, that the Fed is buying so much right now that for the first time ever, I was talking to a tips trader that was telling me that the Fed was trying to buy $6 or $7 billion of tips, and the primary dealers only offered them 4.7. They literally ran out of inventory to offer to the Federal Reserve. And that's the one thing I just would like people to kind of understand is the level and the speed upon which they're doing these purchases is completely unprecedented. They announced 2 weeks ago that they were going to do $700 billion of quantitative easing, and they left it open. They said it was going to be over a period of a couple of months, but they didn't say that they couldn't stagger some more at the beginning. And so what they did was they went and looked at the state of the market, and they got a feel for how much they needed to do. Well, they literally went through that $700 billion in the first week. They are buying the equivalent of a 2008 quantitative easing. It used to be basically 60 to 80 billion. I can't remember the exact number. They were doing that every day for the past 2 weeks. The stack of blue tickets on the Federal Reserve's desk is monstrous. And then there's other ways as well that they can provide liquidity to the market. One of the most interesting things that they've done is that they've done these swap lines where they actually go and provide US dollars to other central banks. They did this in 2008. They did it to I can't remember, I think there's 4 standard banks that they do it with. It's Bank of Canada, ECB, Bank of England, and I don't know, I'm not sure who else it is, but they go and they provide these kind of liquidity, these US dollar liquidity to free up the system. Well, there was such a demand for US dollars at this time that they expanded their counterparties to 10 different banks, central banks. And this was all in an attempt to try to help the world economy that was in desperate need of US dollars to provide the liquidity that no one else could provide.
You did say something in your answer there. You spoke about TIPS. What are TIPS?
TIPS are Treasury inflation protected securities. They're just another form of government security. So the Fed, not only do they buy regular government bonds, but they also buy Treasury inflation protected securities.
Okay. And what is the goal that the Fed is trying to accomplish by doing this?
Their goal is to try to make the system have enough kind of liquidity so that it begins to operate correctly again. See, what happens is that there's basically not enough money in the system because credit is being contracted, and basically there's not enough chips to go around. So therefore, it ends up being this kind of game of whack-a-mole that, one person whacks it and then it comes up again and they try to whack it again. And it just becomes a self-fulfilling prophecy where the credit contraction of selling causes the value to go down, which then means that more people have to sell. And so what they're trying to do is provide enough liquidity to stop that kind of reinforcing kind of spiral. And what they do is they take all the securities that they can that from the dealers' balance sheets that they're having trouble financing and having trouble owning, so that the dealers can buy other things that are more risky. So the goal is to try to make it so that these banks, the JP Morgans of the world, don't need to worry about financing treasuries and don't need to worry about that. And they can go out and they can buy the more risky securities that basically the Fed should not be buying. Because at the end of the day, the Fed is supposed to buy only government securities. Now, it is being kind of, let us just say, it's changing this time. In 2008, there was the TARP program, and there was some different things, and the Fed got in trouble because they blurred the lines of what they were allowed to buy. And then Congress went and they actually tied their hands again. But in this case, what's happened is the Treasury's gone and actually taken a role where they've worked hand in hand with the Fed so that the Fed can buy corporate bonds, but the Treasury takes the first loss so that the Fed is in essence still taking the government risk, and it's a riskless security for the Federal Reserve. Because the Federal Reserve is not supposed to be trying to pick which companies should survive and which shouldn't. They shouldn't be sitting there going, I'm going to buy GE paper, but I'm not going to buy Boeing paper. That's not their goal. Their goal is to provide liquidity for the system. Now, unfortunately, what happened was because there was this, terrible virus, and because nobody wanted to own any securities, the government was forced to go and say, no, we're going to backstop investment grade paper as well. Meaning investment grade is the kind of higher grade corporate paper, bonds. And so what they did was the Fed found a way, working hand in hand with the Treasury, to actually buy corporate paper.
Can you just explain what corporate paper is?
Okay, so that's like GE or Boeing or Microsoft or Apple issues bonds, and those bonds trade in the open market, and that would be an example of corporate paper. Investment grade has to do with the ratings attached to that bond, and generally that's considered the higher quality companies. And then it goes from there, it goes into high yield or junk, which is anything below triple B. And that is kind of what the Fed said. We're not going to buy any of that, but we're going to buy investment grade paper.
Okay, so how come they were doing that this time? Like, why this time?
Because the market became so dysfunctional and that there was nobody willing to buy it, that the Fed needed to backstop it.
Now, is this, correct me if I misunderstood you here, but when you were talking earlier, it sounds as though the Fed comes in with all these billions to buy back government bonds, and they might do so from a primary dealer such as JP Morgan, which frees up some capital with JP Morgan, which then allows them to go and purchase more risky assets if necessary.
Right, or to make room for their balance sheet for the assets that they need to hold. Either way, it's just helping the system in terms of providing liquidity to the system.
Okay. So in this case, what happens if the Fed announces that they're injecting $700 billion worth of liquidity into the market? What do they do when they don't get the reaction that was intended? I don't remember exactly which date it was, but I think it was a Sunday evening when the e-mini came back online, and they must have announced it shortly after or just after the open, and it instantly went limit down.
Right. Well, first of all, I would argue that the Fed does not care about the stock market. Well, they care, but that's not their primary goal. They are more interested in the functioning of the credit markets. The stock market is something that they watch out of the corner of their eye, and it's obviously important as a signal. But really, what kind of lit the fire under their ass in terms of actually doing stuff was when the credit market started breaking. And that's when they decided that, nope, we got to get in there and we have to do it. Because if the credit markets start breaking, then everything else just falls to the wayside really quickly. And this is one of the things that I would like to stress for, when investors are thinking about this environment and they're thinking about the different opportunities there are after this huge sell-off in, from the virus. And they see guys like Mark Lazary from Avenue Capital or Seth Klarman going out and actually raising money to go out and buy assets. One of the things that I want them to probably understand is that these guys are probably not buying the equity. What they are buying, more often than not, are these distressed bonds that are high quality bonds that are trading at levels that are just wrong. And so one of the things that you have to just keep in the back of your mind is that some of the smartest guys out there are actually seeing the opportunities today and actually committing capital, but the opportunities are not in the equity market. They're actually in the corporate market.
Let's just take a step back there. You said that the Fed is not so concerned about the actual stock market, more so about the credit market. So when you talk about the credit market, are you referring to the government bonds?
The credit market is both government bonds and also corporate bonds.
Okay.
It's bonds of all sort. It's also money market. It's just all the functioning, the day-to-day functioning of the kind of the credit that goes back and forth between companies and the cash flows and the financing of commercial paper and the financing of the government's balance sheet. It's all that is infinitely more important than the equity market.
Right. So you said that the Fed wasn't so concerned about the stock market breaking down. It was more about the credit market breaking down. So most of us listening to this know what it looks like when the stock market breaks down. What does it look like when the credit market begins to break down?
Well, the first thing you'll notice is that securities that are not on, like what are called off the run, meaning that there's a standard bond that everybody trades that's the most recent bond, but then there's the other ones, the ones that were previously auctioned, and those usually trade at a slight discount to the on the run because there's less liquidity. Well, all of a sudden, investors couldn't sell those at all. So that's called the spread between the on-the-run and off-the-run bonds. And that was a trade that, for example, in 1998, that Long-Term Capital had on. They would go buy the 29.5-year bond and sell the 30-year bond. And eventually that spread would go, back into line, but they would have to hold it for a little while. Well, those spreads, those kind of trades started blowing out. Meaning that they, whereas they usually would trade at a 20, basis point difference, they started trading at 100 basis point difference. And then you would see things like high yield and corporate spreads, meaning the price that a corporation has to pay versus the government bond. So if the government borrows money at 1 and an investment grade borrows money at 3, that would be called a 200-point credit spread, meaning that you have to pay 200 extra over the government. Well, those spreads went from, I think that, let's just have a look here. I have this written down. Let me grab it. The aggregate corporate spread went from 100 basis points, and then it went to 365 in the space of 2 weeks. That's just that's unheard of. The high yield went from 350 basis points to 1,100 basis points. So whereas you had, companies that used to be able to borrow money at 5%, they now all of a sudden had to pay 13%. Is that sort of moves that you imagine if you're all of a sudden you're going and your mortgage is floating and they tell you it's gone up by 800 basis points in the space of 2 weeks. That's the sort of stress and that causes the system to really get into trouble because it ends up being that without that kind of those spreads blowing out like that, the whole thing starts kind of unraveling.
Just going back to the question I asked you a little earlier, what does the Fed or any reserve bank for that matter, what do they do if their injection of liquidity doesn't have the intended reaction? And has it had the intended reaction this far?
Well, I would say that when they announced the first one, because don't forget, they've done 2 QEs so far. They did the first one, which was $700 billion, and now they came back with the QE Unlimited, which is basically no amount, and we will do whatever it takes. The first one, the $700 billion, they didn't tie their hands about how much they would buy every day. They left it open-ended. And I think that they went into the market, they bought it, and they realized how much was for sale, and they upped the amount that they were going to buy. So when you ask, what does the Fed do when it doesn't have the reaction that it's intended, they do more. So they realize that the system, they don't know the right number because they don't understand the stresses like that well in terms of like the specific how much it's going to take to fix it. So there is that a lot of people will think to themselves, oh, the Fed's going to run out of money. The Fed can never run out of money. They are the issuer of the government is the issuer of the currency. Theoretically, they could buy every bond on offer if they wanted to. And so when you're thinking about shorting against this and thinking to yourself, oh, you know what, the Fed's going to stop and the Fed's going to run out of money or this isn't going to work. I always say be very careful about that idea because the Fed could literally just keep buying and buying and buying and buying. There's nothing even stopping them from buying stocks if we change the rules that we operate under. That is a self-imposed rule, meaning that the Congress has told the Fed that they can't buy stocks. But in other countries, the central banks are allowed to buy stocks. Japan, they're buying stocks. And in fact, in Switzerland, they're buying U.S. stocks. So imagine a situation where it gets really bad and the virus continues to kind of, make society unstable. And one of the worries is that we're having a financial crisis. I could envision a world where the Fed starts buying S&P 500s. It's not, out of the realm of possibility. And there's nothing fundamentally stopping them because they are the issuer of the credit. They could just, debit one side and credit the other. And it's as simple as that. They're just entries in a computer.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit Tasty Trade Incorporated as a millions or even thousands or hard to borrow fees. It's just a one-time evaluation fee itself from online brokers to commission-free trading. Now, the new
of them actually intervening in capital.
The link in the description to start trading with Trade the Pools Capital.
What are the negative effects of central banks having an unlimited supply of money? And also, are there negative effects of them actually intervening in capital markets?
Well, Aaron, some people will say that, the hard money guys that think that we should be on a gold standard would argue that there's tons of negative effects and that this is the reason that we're in this predicament is because the Fed keeps intervening and doing this. I don't know if I buy that argument, but I will say that without the Fed, we would have a situation where we would have had more deflationary busts. Now, you might argue that that's what the system needs. The system needs kind of a cleansing deflationary bust. I would argue that it would actually have caused massive kind of unemployment, and it might have cleansed the system, but it would have been very painful. So it's a tough philosophical thing that comes down to what you believe money is and how it should operate and who's the benefit for. and what is the goal of the Federal Reserve? Is the Federal Reserve there to try to maximize employment, or is the Federal Reserve there trying to maximize or maintain the value of the dollar?
So as we've been talking about here, central banks adding liquidity into the marketplace, is this something which just takes place on an ongoing basis, week after week, and it normally doesn't make the headlines? Is this something which happens regularly anyway? It's normally just on a smaller scale.
So there was a time when the Federal Reserve basically didn't announce any of their changes and would execute a monetary policy by intervening in the market and buying or selling T-bills. And I remember a time, I'm showing my age, but that you would have to wait till 11:45 and you would go watch for them and you would see what they did. And if they conducted operations, you could see that they had changed the rate of the interest rates through their open market operations. So to answer your question is that it used to be that the Fed was constantly buying and selling T-bills to maintain the rate that they were trying to kind of target. Then what happened is in 2008, when we had the great financial crisis, we basically hit the zero bound, and then that changed the way that the whole system operates, and we went to a system with interest on excess reserves. And during that period, when the Fed can actually just set the rate and basically have a savings account that the primary dealers use, then there's no need for them to buy and sell kind of securities on a regular basis. Now, having said that, don't forget that they had run up their balance sheet in the QE 1, 2, and 3 under Bernanke, and then they were trying to wind that down under Powell when he first came in. That was what the taper and eventually the quantitative tightening. Quantitative tightening is the exact opposite of quantitative easing, that instead of the Federal Reserve kind of buying securities, they sell securities. And so they ask dealers for bids instead of asking dealers for offers. And so during those periods, they actually were in the markets on a regular basis, but it wasn't to the extent that they're in there today. When the quantitative tightening, I think they might have sold once or twice a week. And so there would be 2 operations a week at most. Even during the quantitative easing, I think it was 2 operations a week. This one is just, this quantitative unlimited is completely and utterly unprecedented. I'm counting it here, 1, 2, 3, 4, 5, 6, 7. They have 7 purchases per day of different securities. So this is much, much different. The virus was something that we've never seen before, and the Fed's reaction to the virus is something we've never seen before.
What do you make of all this? Let's flip this to get a bit more of your actual perspective and your thoughts on what's taking place at the moment, and I guess how this might play out a little bit. As you've said a couple times, it's uncharted territory. We've not seen something like this before. Yeah, what are you seeing?
Well, I understand why the Fed's doing it. I'm sympathetic to it. And I think that they're doing the right thing. And even if I didn't think they were doing the right thing, it doesn't matter what I think. Well, all that matters is what they're actually doing. I saw that the Bank of Canada the other day, the governor of the Bank of Canada said something to the effect that some have suggested that he is using a lot of firepower. And then he says, a firefighter has never been criticized for using too much water. The central bankers of the world are rightfully scared about a shock to the system because this is something that's, we've basically shut off our economy for a month, or could be 2 months or 3 months, who knows? So they are throwing everything they have at it. And whereas a lot of kind of market pundits will look at it and say that's going to end badly, I think I'm going to short like S&Ps because it's going to cause, this thing's going to collapse in on itself. I'm more worried about the opposite. I'm more worried they're going to throw so much at this thing that it's going to ignite like a fireball. And I look at when we come on the other side of this, how they're going to unwind this is going to be very, very difficult. But I don't think they're worrying about that right now, because there's just this is a lot different than the 2008 crisis. In the 2008 crisis, it was a bunch of greedy banksters that had kind of gotten over their skis and gotten into trouble. Now, eventually, it threatened to take down the whole system, and the central banks had to come to the rescue. But on the whole, they didn't really want to save the system. They wanted it to cleanse out. They wanted to get Lehman to be taught a lesson. They wanted to have these things change. They wanted the system to kind of de-lever because it was too levered up. In this case, this was an exogenous event that was really nobody's fault. And not only that, it's not some greedy banksters this time. It's, everybody, including the mom and pops that, did nothing wrong. So when I look at the kind of central banks, they have the moral authority to do whatever it takes. And you'll see them saying that time and time again. We will do whatever it takes. And if there's one thing I would just kind of like to leave, your listeners with, it's that don't forget that. They will continue to buy and support markets in whatever size is needed. And they are not going to get scared off because it's a certain size. They are just going to keep standing in there, and they're going to keep buying it. And if it ends up being that they own every treasury on the market, so be it.
One of the things you said to me prior to our call is that you'd like to speak about how we've never seen the government, I think it was the government and the Treasury, correct me if I'm wrong there, working so closely together as they are at the moment. Is that something you'd like to speak to?
Sure. Yeah. No, I'd love to talk about that. I've contended that Donald Trump was the most MMT president that we've ever had, modern monetary theory. And what a modern monetary theory kind of theorist believes is that the government is never constrained by financial constraints, meaning that the people that tell you, the government has 100% of debt to GDP, they don't worry about that. They say that the government is only constrained by real resources. And what does that mean? It means that the government can keep spending until they reach a point where they use so much real resources, that they cause inflation. And I've argued that Donald Trump is the most MMT president that we've ever had, even to the fact that you take like his stimulus plan. He did a stimulus plan 8 years into economic expansion. Most Keynesians would tell you at that point that you should be trying to balance budgets, not Donald Trump. And when they asked him why, he wanted interest rates lower, and when they asked him why, if the economy is so good, why he wants interest rates lower, he says because there's no inflation, which is exactly what an MMTer would say. So when we come to this point, we get to this kind of crisis that we're having from the virus, and a lot of kind of Austrians and hard money guys would say, well, the government can't be spending at this point because we don't have the balance sheet to do it. We're already indebted by whatever it is, and we don't want to be saddling our grandchildren with this debt. Well, that isn't happening here. The government is going and doing a kind of a fiscal stimulus or saving a fiscal kind of rescue package to the tune of 10% of GDP. Japan is talking about doing 16% of GDP. So governments are spending like nobody's business, and rightfully so, because there's been a huge demand shock. And if you think about it, the Federal Reserve and other central banks are there to finance it. And if it comes down to the market ends up being worried about how much the government is spending, we could eventually hit a point where instead of the government issuing bonds and then the Fed buying them back through quantitative easing, we just get a situation where the Federal Reserve says we're going to, do $2 trillion of spending, and the Fed's going to buy it all. Because if you think about the process that we're going about doing it, the Treasury spends, they issue bonds, the public, the primary dealers buy them, the public, trades them, and then the Treasury or the Federal Reserve buys them back. So we could just eliminate the middleman. And that is one of the things that should give kind of the hard money guys shivers. And because eventually we're going to see a situation where that's occurring. And we've kind of gone through 3 decades or 4 decades of lower and lower inflation rates. And everybody thinks that we can't create inflation. And I argue that we can't create inflation because we keep relying on the private sector to try to create inflation, through the banking system and through people taking out loans. Well, as we saddle people with more and more debt, it becomes more and more difficult for them to take out even, the incremental amount of debt ends up being more difficult. So they're kind of more hesitant. So eventually you get to a point where the private sector can't create inflation, which is basically what you're seeing in Europe. No matter how low you put rates, they don't respond. And in fact, you get to the point where you get into negative rates, and the private sector, as you send them lower, they become even less incentivized to actually go and take out loans because it ends up it's deflationary. So at that point, it's up to the government. And up until now, most governments, apart from Donald Trump, have been reluctant to go and spend. You see Germany trying to balance their budget and saying that Italy can't go and run a deficit. Even you see in your country, Aaron, you're from Australia, right?
Mm-hmm.
Your latest guy up until before the forest fires, he was talking about running a balanced budget, and he ran on trying to balance the budget, and that's starving the system of money. And in an environment with limited private sector credit creation, it's kind of, it's the formula for lower and lower interest rates. So I understand why people think that we can't make inflation. But what they fail to realize is that if the government goes and spends, they can do it whenever they want. I look back at history and I don't know a single country that has ever collapsed because of deflation. But I know lots of countries that have collapsed because of inflation. And all you needed to do is have a change in attitude about government spending. And I think that you're going to find that we're going to be able to create the inflation that was so elusive. And this virus, I think, will prove to be the deflationary impulse that changes that attitude and encourages people to go and spend. And at first, it'll feel great, Aaron. I think that it'll do really well as the government spends, and it'll be terrific. But like all things, they'll take it too far, and we'll go through what'll feel great at the beginning will end up hurting at the end. But we're miles away from that, though. I just wanted to say I understand that road is for the hard money people will say like that's a terrible road to go down because that's where we end up. And it doesn't even matter, Aaron, if you and I think that's where we're going to end up. All I'm saying is that's where we're headed. And I think that this virus has kind of cemented that path in front of us.
Well, Kevin, I think this has been really insightful, certainly helped myself, and I'm sure many people listening to this to understand some of these subjects a little bit deeper below the surface. Is there anything else you'd like to add before we close things out here?
No, you know what, Aaron, it's been a pleasure being on with you. I just want to say thank you for having me, and I really enjoy your show, and I think you do a terrific job, and it's a great resource for traders alike. And I just wanted to thank you for all the hard work you put into it.
No trouble at all, man. Thank you again for coming back on. Anyone who's listening to this, if they'd like to follow along with your insights, I know there's a couple places they can do so. You have a podcast. You have a newsletter. You're also reasonably active on Twitter. Do you want to share those few things?
Sure. So on Twitter, it's at Kevin Muir, M-U-I-R. I write a letter, and if you want to see an example of it, just shoot me an email. The letter is called The Macro Tourist, and you can get it to it at themacrotourist.substack.com. But send me an email at kevin@themacrotourist.com, and I'll fire you off kind of a couple latest kind of copies of the different editions. And then finally, if you're interested, I do have a podcast. It's called The Market Huddle. It's a little more kind of laid back. It's a couple guys drinking beer and talking markets. And you can get that at themarkethuddle.com.
Cool. And you have a co-host on that podcast. Who's that?
That's right. That's Patrick Ceresna. He, I laugh about it. He cheats on me. He also is on Macro Voices.
Okay.
He's the co-host. He's the co-host on Macro Voices. And then this is our fun thing that we do on the side is we like to get different traders and drink some beer and talk markets.
Yeah. And if there's one particular episode, you've been doing it for about 1.5 years now. If there's one episode which people should start with or just check out to get a good idea on it.
So previously, our most popular episode with this fellow by the name of Jimmy Jude, who is an ex Merc trader, like it's the Chicago Mercantile Exchange. We decided that he was so much fun and that the world could use a little bit of something to smile at that we brought him back this last week, and he came back and it was a huge hit. So go check it out. It's Jimmy Jude, Jude, and he's just a blast, and it's kind of it's a great taste of what the show's like, and I think you'll enjoy it.
And what episode number is that?
Oh, I don't. You know what? You're putting me on the spot. I don't actually know.
I'll dig it up and I'll put it in the show notes.
Okay, that's terrific. It's the one from March 27th.
Okay.
March 27th.
2020.
Yes.
Cool.
That's right.
All right, Kevin. Well, again, thank you very much for returning. It's been an absolute pleasure to have you on again, and I'm sure we'll speak again before too long.
Well, thanks for having me on, Aaron. It's a lot of fun.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
(2018) and was recently included in the Best of Risk Management compilation episode 2. Greg's a founding partner and the CEO of Onyx Commodities, a London-based proprietary trading firm that's prominent in market making of oil derivatives. Now, in line with the last couple episodes that have focused on recent events, this episode covers what's been happening in oil. More specifically, Greg goes through key events and themes driving oil prices, including the virus impact, supply and demand dynamics, why the crude and Brent futures alone aren't entirely a true reflection of the oil market, how lower prices affect producers, corporates, and other large purchasers of oil, etc. So given the subject matter, I know this episode won't be for everyone. It is very specific to oil. But if the energy sector does interest you, then Greg is an incredible wealth of knowledge. All links mentioned, including a link to our first interview, episode 159, are listed in the show notes at chatwithtraders.com/193. Lastly, this episode was recorded 2nd of April 2020, and I apologize for the sound. It's a little scratchy in some parts, but overall, not too bad. Ladies and gents, please welcome Greg Newman. I wanted to reach out to you because I know there's been a lot happening in oil as well. So I'm interested to hear about sort of some of the themes which are driving oil prices, some of the dynamics that you're observing, and of course, how your firm's been trading around it. So I think probably a good starting point for this would be if we go back to the beginning of March. There was a major event where oil gapped down something around 30% over the weekend when it came back online Sunday evening. As a firm, how did you manage trading the evening oil gap down so much?
Do you know what? If I could take it back a bit, because oil has been very, very interesting. Yeah, but we came into 2020 And actually, there's a lot going on. It's been a very interesting market in oil, particularly in the last year. You know, going back, we had the Saudi Arabia tax, the threat of a war with Iran, OPEC decisions, and then actually a really big one was the International Maritime Organization. They enforced a specification change in shipping fuel. They lowered the sulfur cap that you could have in the oil, and it had really interesting kind of impacts on the market. I don't think anyone really expected it to have the impact it had. We suddenly had this fuel that was pricing, an end user product that was pricing way above anything else, and it was changing the way people were buying certain crudes and certain different behaviors. And actually, the way you looked at the market was suddenly very, very different. So it was a really interesting time. But ultimately, coming into 2020, the trade houses and the majors and these guys with big derivative purchasing power in the market, the guys who do a lot of trades, they'd done very, very well. And I think there was an element of coming into this year with a lot of confidence, and there was talk more of oversupply in the crude market, even in early 2020. And certainly at Onyx, we had that kind of view longer term. So you were starting to see the signs, but you did have this kind of these dynamics at play that were making things interesting. But I think when the coronavirus started to be taken more seriously, because, we did hear it being talked as early as December, and then January, it was on the focus for the oil market because in China, the Chinese are a huge buyer of oil and oil products, and it's really important to keep an eye on what the Chinese are doing. And because they were very impacted, and the Eastern market in general was starting to get impact early on in the year, you were starting to see the signs of corona on the oil market in the early parts of the year. But I think like anyone else, like anyone sitting at home or looking at things this year, immediately it didn't seem like a global pandemic at the time. There wasn't any certainty that this was going to become what it's become. And of course, what naturally happens is that filters through into your psychology for your decision making, if you're a trader. And I think these guys that came in, a lot of them quite confident on the long side in general, done very well last year. I think they were to an element of denial, right? An element of this is probably not going to last. And it steadily became worse and worse. But then, yes, this pricing war situation happened, which has become, really talked about across the world. And bang in the middle of this, we had the OPEC Plus, meaning Russia and the OPEC conglomerate. And ultimately, there were discussions about what they were going to do about the coronavirus, a clear demand slump when they wanted to cut production even more. But the thing is that these guys have been cutting production for quite a long time now. It was only ever meant to be a temporary thing. I think only 18 months initially. And they've been rolling these cuts, every 6 months again and again and again. And Russia were never really that keen about this. They did it reluctantly from what they were saying and what was being read. So I think it was just a matter of, look, we don't want to cut even more. I thought, yes, we can roll these cuts, but to cut even more is just not something they were prepared to do. And Saudi Arabia in particular saw this as, well, we need to either be protecting the oil price, protecting the supply that's going in the market, or getting market share. And so they came out and said, right, if we're not going to comply, then we're not going to let anyone else produce more than us. So we're going to produce as much as we can and then go for market share. So that's what's happened. But the really interesting thing, I think, yes, in combination, you had the demand destruction from coronavirus, but then combined with the pricing war, it was really clear that the market needed to go lower. And I think anyone really with oil market, looking at the oil market, you didn't need to have a huge amount of industry knowledge to know that this was going to be really impactful on the downside. So it was the fact that it was released on the weekend that was very, very interesting, because if you go back to last year with the Saudi Arabia tax from allegedly Iranian missiles, that took off 10 million barrels of production, just straight off the market, real oil not being able to be delivered. And that, again, is very binary up. It's very binary, a bullish thing for the market. And it happened over the weekend. So usually what happens in markets, and it's very common across all markets that are financially traded, you have a situation where something happens and then you need to react, or you need to do something if you have risk on. Either you want to trade it to try and through a strategy, or you want to get out of your current risk. But either way, there's going to be a herd type, panic type situation. And the common phrase, I'm sure a lot of people have heard, is buy the rumor, sell the fact. And what that essentially means is, when it's happening right now and you don't know what's going on, there's a good kind of strategy to profit from the kind of hysteria and contagion of fear, to buy into it and ride it up, and then once the news actually comes out, be aggressive in getting out. And it could be the reverse way. It doesn't have to always be up and down, but it could be down and up. But either way, that's usually what happens when this information is fed through during the day and when the markets are open. But the markets in the oil markets, so the derivatives in oil, aren't traded over the weekend. So you had a situation last year that on a Saturday, these missiles hit, and then everyone had time to actually consolidate and think, what does this actually mean for oil? And no matter where you spun it, it was not a rumor situation. It was genuine production offline, and there's going to be a genuine impact to oil. So when you came in on the Sunday evening, when the markets opened, so it's 10 p.m. UK time, it's going to be so obvious that the market's going to go up. So what happens, and why dynamics now come into play, is that when the exchange opens, they match all the orders that have been put on as pre-orders. So you can go in and say, I want to buy oil. You can say at market, right? You can put your price in, I want to buy up to this level. And then you have the other side, which is the sell orders, and the exchange will just match them, and the market will open to where these orders are satisfied themselves. But on that time, you had mostly buying, of course, because it was so clear what was going to happen, and anyone who was long wasn't going to sell. They were going to wait, because why would you not? It's so clear what's going to happen. So the market just gapped up $10, and that's a huge thing to do. $10 just in a microsecond, and then from there you have panic and all that kind of thing, and then it took some time to settle down. So I think there's an element of strategy there. I think you can never prove these things, of course, but in my mind, it was a very strategic thing to do to release this news on the weekend. So you already had a demand slump. You already had quite a long market, as I was saying before. So you went into this weekend, the market long, demand starting to peter out from Corona, and then releasing all this supply on the market, or the news that you're going to release on the supply on the market. The sell orders on the weekend just were flooded the exchange, and we gapped down, as you said, 30% in a split second. And why was that so important this time? Well, as I said, I believe the market was generally very long, or at least quite long. And so, again, if you have this happening during the day, you have time to get out of it. You can even get short if you're quick enough and you're efficient enough. Quite hard to do if you're a big player. But this time, it just gapped down. So yes, the outright price gapped down 30%, but so did all the differentials, all the time spreads, all the components of oil in the oil derivative ecosystem would just gap down. And there was no room for anyone to trade out of it. You were either short and participating in the move down, or you were long and getting hurt. And then what do? When you come in on Monday morning, say, right, we're down a lot of money, or our position's against us, but the market's moved down so much, it's not an obvious thing to then sell again. See what I mean? So it was a very difficult time, and it hasn't closed. It hasn't evened out. The market activity has been crazy. The price action has been crazy ever since, because you've got to look at it from a trader's perspective. It's actually still early on in the year. We've got to get our revenues for the year, and if we're down, we want a chance to fight back. So what do we do from here? So there's a lot of things going on. There's people trying to capture the difference between the prompt price and the forward prices by cash and carry. So what is that? It's buying a ship and filling up the ship with oil right now, storing it out in the ocean and waiting for the prices to recover. There's people doing that. So there's derivative flow from that. There's derivative flow from speculators getting short. There's buyers who are end users who want to profit from, or want to at least capture the low prices to allow their businesses to run. So there's a huge amount going on, huge amount of volatility, and it's really, really very interesting. But for us, the initial worry was not the price action itself, because we are trading the granular swaps and differentials, and as I say, the ecosystem around oil that's more related to the physical and the flows and geographical locations, all these things going on. That's where we're trading, and that's the swap market in general. And that has been really good market conditions. We like volatility. We're there to provide liquidity. We're market makers. So someone wants a price, people are very willing to do it and not negotiate, because it's a fast moving market. So a lot of the work is being done for us in that respect. But our initial concern was, well, God, this is really serious on a global economy. side of things and operationally, are the exchanges going to be okay? Is the clearing bank going to be okay? How's the financial system globally going to react to this? And so hats off to the regulators at the end of the day, because I think the banks are a lot more prepared this time compared with the 08 crisis, or certainly the 08 crisis. But since then, there have been issues, and it's been very hard for banks to get dollar liquidity. And I actually love to listen to that podcast that you said you had with that trader on the kind of Fed movements, etc. But that was our initial concern, that the functionality of the market, the trading access would go down. But actually, the exchanges have had loads of contingency. They're all okay. The clearing banks are okay. And actually, everything's operating as normal. So it's more about getting operationally sorted from our point of view. And as we were talking about before, Aaron, it's just been a matter of our tech team and operations team making sure there's trading stations for everyone at home, and the internet connection is good, the remote server's good, and they've been absolute heroes for us. And they've really allowed us to be in the game and profit from all this violent price action and market conditions. So yeah, that's been good for us. And I think generally speaking, the market will continue to function, which, as I say, hats off to regulators and banks and exchanges all kind of prepare to this to some degree.
So what exposure did you have going into the weekend? I understand you're a market maker, and I understand that you're also trading not only the futures derivatives, but you're trading the swaps, which are more closely tied to the actual physical, etc. What sort of exposure did you have, regardless, going into the weekend?
So what we'll inevitably have is residual risk left over from taking the market flows across all the products and across all the crudes. There's many different differentials in each region. So there's products can vary based on specification, based on region, based on product. And what happens if we're trading all those together as a company, you can never really get flat. So what we're left over with is a lot of time spreads, a lot of cross-product differentials, and what we call boxed up risk. So essentially trying to keep our delta as close to zero as possible. And so what we're exposed to is just the difference between the prompt prices and the forward prices, and as I say, cross product prices. And that tends to move less and tends to be more manageable and tends to be more flow driven. So we might even actually hold that risk purposely to pre-position for the next time zone. So if it's in Singapore, for instance, there's Eastern flows in the Singapore-based market, and they behave very differently and have different requirements to the European. So if you know that and you trade the US market, for instance, in the evening, you can position yourself into flows or into contracts that will assist you in market making the next morning. And so that would be the majority of the risk we had going in. And to some degree, there's some speculative positions also. If you're going to preempt where liquidity is going to be required, there is an element of speculation to that. So coming in, we certainly had that kind of risk on the books, but ultimately it's a very low proportion relative to our intraday trading. And so it's managed in such a way that even in huge moves, we're not expecting to draw down considerably. And actually we want to be we want to be trading and able to react to these situations, because this is when the market needs liquidity most. And this is where there's really our function and service providing to the market comes into fruition. This is really where we're wanted and needed by the market. So as long as we can go in clean enough in our books and not too much damage on a drawdown basis, we're there to function. And it's just been very, very, very busy.
Does it make it difficult for you to make a market during events like this? Because as you kind of described earlier, it's like this was very clearly a sell sign. Everyone was trying to sell. I mean, is it hard for you to make a market in that condition where a lot of the flow is very one-sided? I understand that might be a bit of a naive question, but I'm interested to hear your answer.
Sure. So again, it comes back to the outright price or not. So if you want, it was very clear from an outright price perspective and outright differentials. If you've got a market that a crude differential or a product differential, it has its different dynamics. It's actually more straightforward for a crude differential, because you know that the crude market is being oversupplied. The refiners don't want the crude because they can't make any money. There's demand destruction. So you'd sell the outright price if you wanted to trade the outright price, and you might sell the swap differential to the outright price as well. But on the flip side, when you have a product differential, or to be fair, a certain type of crude differential as well, it's a relative value thing. It's not going to move like for like with the outright price. So actually there's scenarios where, for instance, if I look at, say, the residual fuel oil market, which is the bunker fuel, or now is used into the blending pool and sometimes to run into refiners directly. So you've got this market which actually is decorrelated. It's inversely correlated, to Brent futures. So if Brent futures go down, the differential goes up. And there's a number of reasons for that. The first one just being that's just market dynamics. If enough people buy into that style, then it does tend to be what happens. And when that correlation breaks down, then that's a sign that something's changing, that kind of thing. But ultimately it comes down to, or it could come down to, an end user needs to buy, for instance. So they want to buy a product, a derivative, let's say an airline, they want to buy jet. So they're going to buy the jet fuel outright price. And they're not so worried about the jet differential to the Brent futures. They just want to buy the jet. So if they're in there buying, and there's a lot of flow buying there, but there's a huge amount of flow selling from the Brent futures, then you will naturally see that jet fuel differential to Brent future widen and actually go up, not down. So that's an example of how it's in the swaps and diffs and time spreads. It's not linear. It's not completely correlated to the outright price moves. And if you take that one step further, if I again use jet fuel as an example, the difference between jet in Europe and Singapore will not be correlated to Brent futures at all as well. It will be more dependent on the shipping costs, because it's pricing in the differential or pricing in the economics of moving jet fuel from one region to another. And you can go again and again, the difference between a jet specification in one area to another, in Northwest Europe to Mediterranean, it gets more and more granular the more you look at the products and the different types of crudes. So that's where we're sitting. And again, that's just the products themselves, but actually the time structures. So if we're trading in the forward curve, we're trading, as far as 2 years out, it's going to be very different, or not correlated at least, to Brent futures. There's going to be different people doing different things. There might be people buying the time spreads because they need to lock in this cash and carry, this storage play I told you about. There might be an end user, there might be a utility who wants to buy in a very specific area, and all the flows will move around depending on that. And ultimately, everything is linked, and that therein lies the skill of a market maker. They're trying to bring flows from different areas, from different products, to provide liquidity in different areas. But if you avoid the outright price, there's still a huge amount to do. And as I say, not correlated with the price of oil outright, on an outright basis at all. Does that answer your question?
It does, yeah. I understand how you're spreading your risk across different contract expiries and different products, etc. I mean, that's it in a nutshell, yeah?
Well, it is, but it's also the fact that it's not about just, okay, yes, the oil price is going to go down, and generally the prices for all oil and oil product is going to go down, but the differentials within that and the different time regions, they're not going to move on that basis. Do you see what I mean?
Yeah.
That's the crux of it, and that's why I say there's a lot of need for people to lock in these differentials. You might be a buyer of jet fuel or say fuel oil in Europe, and you want to bring it to Singapore, and you're always doing that. Therefore, you need to buy the difference between the two contracts, and so there's loads of these different types of trades and strategies and hedging to be done. So there's all these different types of price movements that aren't correlated to the oil price. That's essentially what I'm trying to say.
Okay. I might just ask you to explain the terminology for the word differentials.
Sure.
I think there might be a few people who get caught up on that.
Okay. So a differential, what I mean there is again, focusing on the swaps. So everything needs a benchmark, right? Everything is traded relative to a benchmark. So you have the Brent futures as an example, and then you can then determine the Brent swaps from the Brent futures, and the Brent swaps, you will trade differentials to that. So for example, let's say dated Brent. So dated Brent is the North Sea, is representative of the North Sea crude oil market, and that will have a price, and that price difference between the actual underlying North Sea oil versus the Brent swap is is what we call a differential. And then you can do that with many, many products. So for instance, you could say, as I said, the jet fuel in Northwest Europe, that will be a differential to Brent swap as well. You could have a differential to jet fuel to gas oil. And what it essentially means is the stable interactions that the physical guys use and the derivative players use to trade around. So there'll be liquidity in these key diffs, and that's where you need to focus to get your liquidity. So for an example, if you're a Mediterranean jet fuel buyer, you'll actually focus on the jet Northwest Europe differential to Brent swap, because that's where the liquidity is, and then you'll then manage your Mediterranean versus Northwest Europe exposure. So it's all about essentially the contracts that link the contracts. That's what a differential is. It gets very granular, but that's the way we describe it. And the differentials will reflect what's going on in the regions. So for instance, again, that dated Brent example, if Brent swaps are a function of the Brent futures and a lot's going on in the Brent futures, a lot of speculation, etc. But then the dated Brent differential to that will be more reflective of the underlying physical. So if it's very weak, it's showing you that the prices for the benchmark are too high for the physical players to actually commit to. They're only willing to commit to a lower price. So that's essentially telling you the information that it's weak in the market. And that is how we generally look at markets, even if we want to know what's happening with the outright market. We want to know what are the differentials doing, because that's the real signals of what the physical market is doing. And actually, it's very, very relevant, that kind of analysis right now. So remember last year we talked about trading what you're trading. Do you remember that?
Mm-hmm.
And what that essentially meant, what I was trying to say there was, be careful about your expression or your view and how you're expressing it. So right now it's very interesting because Brent futures, as an example, have been very weak since the move down on that weekend a few weeks ago that we talked about. But actually, since then, it's been very difficult to break below $25 per barrel. And that doesn't really make much sense in a supply and demand basis. But this is the key thing. The futures aren't a reflection of supply and demand. They're just one price. The physical oil prices, i.e. the differentials, the physical oil prices that are traded at differentials to the benchmark are all very, very, very weak. And they're reflecting the true price of physical oil, and they can continue to move down. But the Brent futures market can stay where it is because it's only one derivative. And I think this is generally not really understood too well, which is that if, in order for Brent futures to reflect supply and demand, it would need to perfectly mimic the physical market. So what that means in a kind of overarching sense is the only way for Brent futures to reflect supply and demand dynamics of global crude production would be if every single producer of crude oil sold the Brent future as a way to hedge their production. And conversely, only if all the consumers hedged 100% of their consumption with Brent futures. And then any difference between the two would then indicate a supply and demand difference. But of course, we know that doesn't happen. One, the global producers of crude and consumers of crude, they don't 100% hedge. I mean, that's for sure. There's a lot of governments that's just too big. They don't even bother hedging. So that's the first thing. Second thing is that those who are hedging, they're not going to use Brent futures exclusively. In fact, very rarely are they going to use just the Brent futures because it's not reflective of their actual physical. They'll buy a swap or sell a swap in their particular region. So they might do dated Brent if they're North Sea or European crude. They might do Dubai swaps if they're Middle Eastern, because it's much more reflective. So there's no way that you could justify that Brent futures are reflective of supply-demand basis just purely on a hedging point of view, because they don't balance out. But on top of that, the volumes that trade in the Brent futures market are many, many times the underlying global crude production. So actually, what makes up the majority of the market is speculation and buying and selling derivative power from trade houses, majors, hedge funds, macro players, foreign exchange traders. So that's what moves the Brent futures market in particular. So it's quite confusing for people when they say, well, why is Brent futures still doing this when markets are so weak and all the physical prices are so weak? And yes, the first clue that the market is weak is that all these differentials that we're talking about are very low. But it's not a great reflection to say, or it's not a great way to express your bearish view by selling Brent futures at the moment. Why? Because everyone who is participating since that weekend, it's been such a clear thing that it's a sell, that you've got a situation where the market is heavily saturated short. And if the market's heavily saturated short, then there's no one really left to sell in decent volume. And so all you're left with are opportunistic buyers. So end users who want to buy to capture the low prices, like airlines and shippers, etc. Or you might have guys who want to short cover their short positions. And the way to know and get signals that this is going on is to see the reaction to headlines and physical information. So for an example, just yesterday, we had the Department of Energy in the US release their statistics for their crude stocks, and it was expected at 4 million barrels. And you could argue that these things are never really that accurate, but ultimately, you would say that the realms of possibility should be 1 or 2 million barrels around that number. And actually came in at 13 or more than 13 million barrels stock build. And that is incredibly bearish, or more bearish information. And the market went down 25 cents and then recovered by the end of the day and actually went up on the end of the day. And that's not really surprising if you know that the market, A, is very short already. B, this kind of physical information is probably already priced in. And so it makes it very difficult, very frustrating for those trying to reflect a bearish view of oil with the Brent futures price. However, if you trade with a differential, like we're talking about, or a time spread, there's actually a very high chance that this is going to trade with supply and demand fundamentals. And the reason being is because the swaps that ultimately price out and are valued to physical oil, a real proportion of physical oil, depending on what the swap contract specifications are, you can't fight the supply and demand. It will price where the physical prices are trading. And so no matter how much you buy, if you wanted to push up the market, it doesn't matter because it's going to settle to where the physical is. And that makes it a lot less able to be pushed around by speculation. And you hear guys on CNBC and generally people talking about the macro market saying the oil market is manipulated and this and that. But what they mean is the oil market doesn't move like for what's going on in oil. But as financial traders, and this is the same for any market, you need to understand market psychology as much, if not more, than the underlying supply and demand, because you've got to know the participants who are trading and the traders that are able to influence the price by their buying and selling volume. What are they doing? And it's completely clear that everyone's short. So I think it's quite worrying for, I think traders should be careful speculating on the outright price right now. They should be doing it with an expression that really does marry what they're trying to express versus what they're expressing. So this trade what you're trading thing I talked about last time, it's still very, very, very important. And another example is the US crude. You can trade on a retail basis. A lot of people can get access to the WTI, the US crude futures. But that's even more dynamics at play because you have US flows, yes, but actually it's reflecting the oil of Cushing. So actually Oklahoma, which is 500 miles away from the waterborne or able to export that oil to the open market through ships. So you've got all these pipeline dynamics to be aware of, and those hedging their pipeline dynamics, arbitrages, and there's just so much going on that you need to be aware of all the factors and know what you're expressing. If you sell WTI futures, you need to be aware, or buy WTI futures, you need to be aware of not just who's participating and why, but where it's the underlying basis and the dynamics, the physical dynamics at play, et cetera, et cetera. So it's just to reiterate that point, really, but it all comes together with this, what you originally asked, which what differential actually is. And it's essentially the reality of the physical oil market, the prices that need to benchmark against something. Because it's not useful to say, if you're in West Africa or somewhere not close to oil hubs like Dated Brent or like Cushing and WTI, it's very difficult for you to say, right, let's agree on an outright oil price. Because where you're going to come up with that number, it's much more straightforward to reference a benchmark price like WTI futures, like Brent futures, and then you will then determine value of your oil depending on the difference in the regions and how you value that difference in the regions and how you difference the value in the specification. So the West African example, if there's a West African crude producer, they will look at what the Dated Brent market is doing, what the Brent futures market is doing, and they say, well, we think our oil is slightly different to that market, and we're going to value that at plus $1 because we think it's a better quality. We also know that it takes a fair amount of time to bring the oil over. You need freight costs, etc. So we're going to incorporate that into the price as well. And it's much easier to negotiate the price basis a benchmark than it is an outright basis. So that's why they're so popular and used so much. But consequently, because they're the ones, these differentials are actually the reflective of the prices that are being negotiated in the physical market, it's therefore much more reflective of what's really going on in the underlying physical. And I actually talked about it this morning, did a post on LinkedIn about how, yes, a lot of people are talking about how the US oil prices are very low, the actual physical oil prices for shale, etc., are very low, and therefore there's going to be production cuts. Okay, that's quite a myopic view. That's anyone can kind of see that, but then what's next? Well, if you've hedged and you've hedged correctly, i.e. with the actual swap that's reflective of your physical, then that's the whole point of hedging. You can keep operating because you've locked in the cash flows, right? You've sold what your forward production, and yes, you're producing and making a lot less money than you were on your physical, but that's been offset by your derivative hedge. So that keeps them in the game for longer. And there's those kind of dynamics at play. So you need to say, okay, well, how do I actually get evidence for that these producers in the US are slowing down? And again, the swaps market will tell you that. So the LinkedIn post this morning was essentially saying, right, the last 2 days, we've seen the US grade, we call it US grade domestic crude market. So it's the differentials in the US market to WTI futures. And those differentials, and they're the Gulf Coast, different specifications in the Gulf Coast, in Houston, in Cushing, in the Midlands. And so you look at all these differentials and they're all correlated at the moment. They're all strengthening. And that is a great signal that you don't need to know who's doing what. You just know there's a lot of flow pointing upwards, which suggests, and the evidence suggests, that there is genuinely production cuts. And because it's traded in the future, because these differentials, a lot of them are traded forward looking, it's actually reflective of decisions being made. So traders are clearly anticipating that the US oil production is going to go down and therefore the prices should recover. So they're reflecting that in, say, 1 or 2 or 3 months forward in the swaps market because they're preempting it. So you don't need to know which specific trader is doing that to know that, well, if everyone's doing it, there's clearly something going on that I don't know, which makes sense because I'm not a physical player. I don't have shale oil production, but I'm seeing this market react that way. That is the evidence you need to know that, yes, production really is slowing right now in the US. And there's a case to be said that perhaps something's going on even deeper, that there could be agreements being taking place. You just don't know. But what you can do is marry what's actually happening in the physical market through the information and swaps, and then start to express it how you want. Does that make sense? And that's why differentials are so important.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Bill involves risk. If only I had the capital, or sat on the sidelines because your account balance caps, ETFs, and even the newest IP. Create your account and start trading. Build confidence, risk-free before you ever pay a cent.
The actual oil producers themselves, I'd be interested to know or hear you talk about what impacts the drop in the price of oil, how that's impacted other industries, for example, maybe airliners and other companies which are major purchasers of oil.
So with companies, it's actually typically what we call them corporates. They're not oil traders. They just have requirements to purchase oil and oil products to run their business. As you say, for instance, an airline. And typically when you get the price of oil lower, it's great for them. It's a windfall, that they're able to either just buy cheaper jet fuel right now in the prompt, or they're able to then look at the swaps market, the forward market, and say, right, here's the levels that we're going to be able to buy jet fuel in the future. If we hedge right now, let's do it. And that allows us to plan, in 1, 2, 3 years forward. And it's great. So they can know their economics, and they're ultimately going to make a lot more money if they've got lower costs. The problem is this time is that it's also coupled with a demand destruction from the coronavirus and planes being grounded and airlines going bust. And it's a shame because the way it typically works is you have a hedge. So if you haven't hedged, then the airlines will be able to buy cheaper jet fuel. But also if they have hedged in the past, then they'll actually be losing money on that hedge, which should be offset or should be mimicked with the physical jet fuel they're buying. which is then cheaper. So they're losing money on the hedge, but buying cheaper physical oil. So net on net, they're just kind of flat, depending on how much they've hedged. That's typically what happens. But this time, they aren't getting the ticket sales. There's not been an increase in ticket sales, and there's just been a complete demand destruction. So not only are they losing money on their hedge and have a negative mark to market on that, they also don't have any ticket sales to then justify buying physical jet fuel at a lower price. So they're just losing money on lack of ticket sales, and they're losing money on the negative mark to market on the hedges. And the reason why that's so important is because they might be able to withstand the negative cash flow, but it's the fact that they need to actually fund that cash. In these extreme scenarios, banks aren't willing to leave the credit lines open without some kind of funds. So they now are needing to transfer real cash over, which is very much needed right now to stay solvent. They're needing to, as per agreement, transfer this cash over to the banks, to the credit lines, or the exchanges, depending on how they've traded. And they're losing twice. They're bleeding their cash. They're not able to profit from the low prices, and they're losing money on their hedges. So it's a very, very difficult time for airlines at the moment. That said, if they can consolidate, unwind their hedges, bleed the cash, so stop the bleed in the cash flow, and kind of minimize operations and consolidate, they can actually look forward. And if you think you're going to be flying in the future, which you would expect, as we talked about just before, Aaron, maybe 6 months is what been's quoted for things back to normal. Whatever it ends up being, you've got to have some kind of opinion on what you're going to be able to do in the next year, 2, 3 years. And with oil prices this low, it's still a good idea, a very good idea for oil end users like airlines who need to buy jet fuel to forward hedge right now and lock in these prices at this low level. Because if they do that, as and when we come out of this situation, you might get a big recovery in oil. There might have been an agreement made with OPEC at that time, and you would have been able to lock in these historically very low prices, which are very appealing on a historical basis relative to your costs. The price of oil fluctuates hugely, and it can be the difference between doing well in an airline or doing badly. So I would still, we have a consultancy arm now in Onyx, and we're definitely pushing for airlines to consider this and at least try and hedge something in the forward production. Albeit, yes, not right now, because there's so much uncertainty, but you would expect in the next year or two to be able to get going again, and the prices are still low for the next year or two. And that's what's going. And that's the same for shipping companies, road freight, anyone buying any oil product. It's exactly the same. But again, the on the flip side, the producers, so those wanting to trade equities in US oil companies, it's actually really important in these times to look at their hedging. And I think the public companies, they'll make that public, so you can know the percentage of their production that they forward hedged. And a lot of these shale oil producers, they only get lent money from banks if they have committed to a hedging program to lock in their forward oil prices. So if you look at that and you can see that they're quite well hedged and they've got some decent cash flow, then they're well positioned to at least sustain for a short period while this goes on. And as and when oil prices do recover, they'll be in a strong position to maintain solvency. So the ones you want to look at are the ones that didn't hedge. If you're looking at companies that are going to continue to go lower, you'd want to look at the companies that didn't hedge, have no protection on these low prices, and of course a lot of debt, etc. The only other thing I'd say on the company basis is the refiners, those actually refining the oil. Again, typically refiners will do quite well in low oil price environments because it generally, historically, has been, in the last 5 or so years, the sell-offs have been led by an oversupply of crude. And if there's an oversupply of crude rather than a demand destruction, then that means you can buy crude, cheap prices. And if you're strategic about it and you have access to the world's different oils, then you can increase your refinery margin, the amount you're selling your refined products for versus the amount that you're buying the crude for. And generally that's quite good for refiners. But as I say, this time it's actually been led by both a supply increase and a demand decrease. So if you're going to look forward, you need to be tracking these refinery margins. So if we do get a return of demand, we still have a crude oversupply at the moment. So in order to figure out how the oil market's going to move forward, what I expect to see is you will know when the demand's returning in the oil market by the refinery margin. So you'll see that refiners are starting to generate profits. And then when that's the case, then there'll be more demand for certain crudes. And then you can start to piece things together that way. And certainly if you're looking at a company who is just a refiner on an equity basis, then once the demand returns, they're actually going to do very, very well. In 2014, when we had the big sell-off last time, and 2015, they had an absolutely amazing year, refiners. The refinery margin, despite the oil market on a crude supply basis being very low, they did very well in terms of capturing the value in between. So that's something to look out for. And I know, again, it's coming back to how do you access that if you don't have all the swap market information? Well, that's what we're trying to do at Onyx. We're trying to provide more transparency. What we're hoping to release in the next 2 to 3 weeks is the Onyx Price Hub, whereby we're going to provide live prices for refinery margins, for jet fuel, and these differentials we're talking about, so people can get more transparency and clarity into what's actually going on in the oil market. I think it'd be very useful, particularly those who don't typically have access, because it's a very difficult thing and sophisticated thing to have access to at the moment. So that could be really interesting. But what I would advise anyone speculating on oil futures in particular is to track the refinery margins and the differentials as best you can. But as I say, Aaron, I hope to have that website up and I'll give you the details so you can release them if it's easier.
Yeah, for sure. I'll make sure there's a link to that in the show notes. And by the time this episode comes out, there's a good chance that if it's 2 to 3 weeks, that'll be available now for anyone who's listening.
Another way to track that would be through our LinkedIn. We have our Onyx group. We have our trading arm, Onyx Commodities, and Onyx Capital Advisory, our advising arm. We're releasing information all the time. So if you track that on LinkedIn, there will definitely be information once that's released of how to access those prices.
Okay, cool. Greg, I was going to ask you, just to wrap things up here, what are the key fundamentals which we would need to come into play to drive oil prices higher again and to recover? I think you mostly answered that already towards the end of that last question, but I might just ask you again just to take us out here.
Yeah, sure. So the first thing to note is that the futures prices, again, and even the swaps to some degree, they're traded on forward physical prices. So there's always an element of thinking, even if what I'm trading is related closely to physical, the traders who are trading those contracts, they still have to have a interpretation of or an opinion on what that physical oil in the future is going to do, even if it's only 1 to 2 months forward. So that's why things can change very abruptly, because you might not know exactly what's going to happen, but you might have a fear as a physical trader that things are going to turn around, and it can happen, really very, very quickly within the space of a few days. So you might want to protect yourself, or you might want to preempt what's going on. And knowing that everyone's short, if you know there's going to be a deal made or some kind of change to the physical market, then you're going to react very quickly to it. So what we're going to need to see is either a deal made in the OPEC and Russia, and actually the US are allegedly getting involved in those discussions now. We need to see a deal made there, because that will give confidence in speculators on the forward price. We need to see essentially some confidence returning for speculative buyers. And I think that's really important, because, as I say, the speculative market drives Brent futures so much, because there could still be a situation that even though we do get a retracement in the Brent futures prices, the differentials may stay weak, because just because a deal has been made, or just because there's been something happened in discussions, doesn't change the fact that the market's heavily oversupplied and we're completely full globally of storage. It doesn't change that. So what you might get is everyone looking forward will be trading the outright price, and they will speculatively buy that, and that will drive prices higher. But then the differentials will still remain low, and you need to be careful, because the market may get overexcited and overextend on the long side, whereas the physical market's still lagging. And again, you can get that signal from the time spreads and the differentials. And so then you would see probably a retracement or at least some volatility at that point. But to get a true underlying physical recovery, I'd say if and when a deal is made to taper this kind of considerable oversupply in crude, that will then allow at least some storage to slowly be unwound. And when the market's full of storage and full of supply, at some point it gets to the point where no one's left to buy physical oil. So if you stop this, real attempt to just pile the market full of oil, then that will at least slow that happening and may start to release some oil out of storage. But as I said, once the demand returns, which you'll see in the refinery margins, that will be when the demand destruction that we've had, which is I think Trafigura said recently, they reckon it's 30 million barrels in March. Vitol said 20 million about a few weeks ago. Either way, you're going to get that returning to the market. So you're going to get, and you'll see that in the refinery margin turning positive. It's negative at the moment, so the refiners can make money. So they're going to go out and buy the crude. So you'll have a deal made which stops there being oversupply or serious oversupply. And you have refiners willing to buy more of the crude. And that should start to tip the market in balance. And the most important thing I will always say is, you can't look at it like, okay, so this is what the state of the oil market is right now, therefore I'm going to trade it. It's always forward looking. What do people think is going to happen in the next 2 to 3 months? If you're thinking like that, it will then make sense when the market moves ahead of you. So you might say, well, yes, I'm aware that refining margins are strong, a deal's been made, but the physical market's still really weak. Yes, but everyone's preempting the prices in the future, and that's what's going to drive a futures market. It's a lot on speculation, so you've got to be really careful. And it goes back again to how you express your view. If you want to express it in a certain way, and you need to choose the right contract and choose the right expression, which you can do with oil. So I think in a nutshell, that's what needs to happen. Confidence returning, deals being made, and real refinery margin increases.
Okay. Well, Greg, it's been awesome to catch up with you. Man, you're just an absolute wealth of knowledge when it comes to all things oil and energy. So I appreciate you coming on again and sharing it with us and going into such great detail on these subjects. I think it's going to help a lot of people who have an interest in this sector for sure.
Absolutely. No, happy to come back anytime, Aaron. It's great.
And if someone does want to find out more about yourself or Onyx, where is the best place to go right now?
I think we're utilizing LinkedIn quite a bit right now. We've got our advisory team active on it daily, and myself as well. I'm releasing videos and my thoughts on market dynamics. So if you just Greg Newman on LinkedIn or follow one of our companies, that the Onyx Capital Group, Onyx Commodities, Onyx Capital Advisory, there's lots going on there. We're releasing our opinions, what's going on, but also, as I said, links to the price hub that we want to provide transparency and things like that. We're really trying to provide a platform for oil derivatives to increase the accuracy relative to physical, increase the transparency for guys to know more about what's going on, and ultimately liquidity. That's what we do. So we're trying to grow that out, and you'll see more and more of that as we go forward. And as I say, LinkedIn is the best way. We have a website as well, but I think LinkedIn is probably easier for everyone these days.
Okay. And I will also mention you do have a podcast, or Onyx has a podcast. I think you started it last year and there's been a couple episodes come out this year. Is that something you're still actively doing?
Definitely. I mean, it's been very, very busy, and ultimately we don't have any dedicated, the people that do it are the people that work day in, day out. So we do try to get it when we can. Obviously, time's being very busy. It's been difficult to release one recently, but certainly we'll be continue to do that. Absolutely. And what we're really enjoying with that is, yes, our opinion on how things move and what goes on, our philosophies in the market, etc., but also actually what it's like to be a trader, or what it's like to be anything at Onyx. So we even had an HR, our head of HR was talking not so long ago about how it is to work at Onyx there. And so, yeah, there should be lots on that podcast for everyone, anyone interested in a career in finance in general. It could be quite interesting.
Yeah, and it's available pretty much on all podcasting platforms.
Spotify and Apple.
Okay. Well, they're the two main ones.
Yeah.
Excellent. All right, Greg, let's leave it there and we'll catch up again soon. Thank you very much.
Great. Thanks, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Every decade, the market reinvents itself. Online brokers opened the doors. Mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool. Limited risk fortune at tastytrade.com/
with Traders podcast, hosted by Aaron Fifield.
Hey everyone, what is good? Welcome to the show. Here we are for episode 194. Joining me is Liam Vaughan, finance author and senior reporter for Bloomberg. Liam's latest book is Flash Crash, which tells the story of Navinder Singh Sarao, a London trader living at his parents' house who made $70 million from his bedroom and was later accused by the US government of playing a part in the 2010 flash crash. Just for anyone who is unaware, this was a deeply perplexing event in which the US stock market one afternoon plunged approximately 9% and then almost completely rebounded, all in the space of just 30 minutes or thereabouts. Liam sent me a copy of the book beforehand and it was hard to put down. Truly, he's done an amazing job of the book, and although in this episode, Liam does speak about many interesting moments from Nav's life, from starting out as a prop trader in 2003 through to when he was extradited to the US in 2016. Believe me, it is only the tip of the iceberg. The story runs much deeper. Go get yourself a copy of the book. It's available from May 12th, 2020. And if you punch in chatwithtraders.com/Liam, Liam, that will redirect you straight to Flash Crash on Amazon. Again, that's chatwithtraders.com/Liam. All right, please enjoy the episode. I knew a little bit about Nav, like I followed the story I wouldn't say very closely, but with a little bit of interest. But I mean, obviously learned so much more about it from reading the book. So let me ask you this question just to get things going here. What compelled you to actually go to all the trouble to speak with all these people and write a book about Nav and the flash crash and the events surrounding it?
Yeah, so I've been a financial journalist for about 15 years. And for the last few years, I write predominantly about white collar crime. You know, a lot of the time you're writing about people who, you know, are very well educated, have gone to investment banks like JP Morgan or UBS and end up getting in situations like, you know, the LIBOR scandal or, you know, the rigging of foreign exchange rates, things like that. And they're pretty interesting, you know, as a journalist, but the people that you're writing about tend to be of a certain type, or you get the other end of the spectrum, which is like straightforward con artists, of which there's a few in my book. You know, and they're fun stories as well, because these people are just really fascinating characters that they're willing to lie to people and to sort of steal their money, and that's interesting, you know, in the way that they spend it and stuff. But Nav was just totally unique, really. He was just such an odd and unusual character, came from a completely different world, and also just the fact that he was a day trader. You know, he never really had any dealings with any major financial institutions. You know, was very much on the kind of outskirts of the normal world that Bloomberg would write about, and yet he was just brilliant. And you know, there were so many unanswered questions. Like when I started looking into the story, there was just so many unanswered questions. Like, was he really a good trader? You know, was he just a cheat, or was he actually brilliant in some ways? And did he really cause the flash crash? Because there was so much dispute around that. And as a writer, one of the things you look for in a character is somebody that divides opinion and that is got nuance. And that's the thing about Nav. It's like, if you ask somebody, they might tell you, listen, the guy was cheating, he was spoofing, he knew the rules, he did it anyway, there's nothing brilliant about that, he deserved what was coming to him. But then you ask a lot of other people and they'll say, look at the markets, look at the way that HFTs operate and make money, and you get a guy like Nav who finds a way to fight back, and he's really, really successful. And they consider that as kind of amazing, even if ultimately it was, illegal. So he had everything. And then obviously there's all the stuff that everyone knew straight away about how he never spent any money and he always wore a tracksuit and he drove a
Like he used to tell people he had a Lambo, but it was actually a bright yellow bike with a Lambo sticker on it, and it's just a really funny character.
Yeah. You know, I was thinking about what sort of questions I would ask you last night, just doing a little bit of prep for this interview, and it was really tricky because in some ways I don't really want people to get too much. Like, I want people to read this book because it was really good. I feel like we'd almost be doing a little bit of a disservice by giving too much away. So there's a few points, of course, which I'd love to get in. But yeah, let's certainly save some for the book. So this is not going to be the comprehensive Nav story, but Nav started as a trader at proprietary firm Futex, which was in London, I believe. And I actually had Dan Goldberg, who was a partner at Futex, on the podcast like years ago. What year did Nav start trading at Futex? And just tell me a little bit about the kind of environment at the time when he came into the firm. Was there anyone sort of influencing his trading? Was he left to his own devices? Did he pick things up fairly easily? Like, what was that? What were the early days at Futex like for Nav?
Sure. So he joined in 2003. It was actually called, I think it was called Independent Derivatives Trading at that point, and they changed their name later. And it was a really interesting time in the sort of evolution of financial markets, because futures trading had recently started to kind of migrate from the pits, really. You know, over a long period of time, but particularly in the kind of late 90s, all the pits are closing, and increasingly futures trading is moving and migrating onto screens. And at that point, you get all these kind of prop shops and arcades that spring up. And Nav had recently done a degree, kind of pretty average university in London, in maths and computer science. And then there was an advert that was placed in a local newspaper. It was like, you know, traders required, you know, must have determination, you know, I can't remember the exact criteria. So he applied for an advert like lots of other people and got invited down to quite a modest office, which was above a supermarket, in a place called Weybridge, which is about 45 minutes outside of London in suburbia. And he was one of the second group of intakes that they ever took on. And it was run by a guy who's a pretty colourful character himself called Paolo Rossi. And Dan Goldberg was also one of the sort of management team. And they were sort of ex-life traders from the pits, you know, sort of East End geezers who had, you know, particularly Paolo, had all this success in the pits and saw an opportunity to hire people. But obviously in the pits, the type of people that you were hiring tended to be, you know, big guys, people with big personalities that could sort of handle the hustle and bustle. But when you're talking about trading on a screen, it's almost like a different, you know, it's the same job, but it's a different skill set. And for that, you know, people like Nav, who have got like a photographic memory and all these just innate math skills, and ability to sort of process data and information very quickly, and you know, almost like computer gaming types as well that are very nimble fingered and stuff. Like, it really suited guys like that. So Nav was one of the very first people through their door, and it was a bit of an experiment at that point in time. And you know, the impression that I got of the place was that it was a bit rough and ready. You know, that the personnel would come and go, and that the training was sort of a mixed bag, but also it was really fun and exciting time because everyone there was really ambitious. They were all kind of young and all wanted to make it as traders, so they were all kind of helping each other. At that point, it was predominantly focused on trading index futures, and the main sort of strategy that they were doing was kind of scalping and very short-term trading, as opposed to any kind of fundamental analysis or anything like that. I mean, by all accounts, Nav, you know, he didn't immediately take off, but he was good and he was very patient, and he had what a lot of people don't have, which is amazing focus. So he could sit there and watch the ladder without placing a trade patiently for hours and hours at a time and pick his spots. And he accumulated a bankroll pretty quickly.
Yeah, it seems like from reading the book that risk taking was something quite well suited to his personality. Would you agree?
100%. Yeah, everyone you speak to was just completely amazed by his ability to just keep upping size and continually take on more and more risk.
And in doing so, it sounds as though it made management a little bit nervous at times.
There's a lot of anecdotes about, him sort of butting heads with the Rossies and stuff, because he constantly wanted bigger and bigger limits. And they were in a bit of a quandary because on the one hand, the whole business model was kind of predicated on finding people like Nav that could get to a big enough size. And then he was obviously paying a percentage of his profits to the firm. So they wanted him to get big. They wanted him to be profitable. But if he got too big, there was a kind of risk to the actual existence of the firm. So it was a sort of balancing act. But he got incredibly big very, very quickly. And part of, you could see that in the way that he is, because money just didn't really mean anything to him other than as a way of keeping score of his trading improvements. So he didn't buy fancy clothes. He bought a moped that he used to drive into the office, and he apparently used to fall off it all the time, and used to sometimes come into the office with his helmet still on his head. And if me or you are doing it, Aaron, suddenly you've got a mortgage to pay, or you've got debts to pay off, or you've got your family to consider. But Nav just didn't really have a lot of that stuff. So if he lost a huge amount of money, it didn't really make any difference to him. He was living at home in his parents' house. He didn't really have any desire for material goods, and so he would lose huge amounts of money one day and nobody would even know about it because his demeanor just didn't really change. And as a trader, you tell me, but I would imagine that is a huge, huge asset to have.
Yeah, the mental game is a huge part. I mean, majority of traders will tell you that. So what products was he trading? You did mention index futures. Was he trading index futures the whole time he was there with Futex?
Yeah, so he started out trading a few stocks before he even joined Futex. That's how he kind of got into trading. And then when he got there, he was trading index futures. I believe it was predominantly FTSE at that point, FTSE futures. And then he kind of almost outgrew that market. Like he got to the point where he was trading hundreds of lots. And so he took a decision that he wanted to get into a bigger market where his trades wouldn't be noticed as much, where they would be absorbed by the market more easily. So he switched to S&P E-minis. So at that point, he starts coming into the office at 1 o'clock, 2 o'clock, and trading through US trading hours. And that was his bread and butter thereafter. Like he did trade other things. He traded the DAX, and there's a good anecdote in my book, and I'll let your readers find it for themselves. But he found a really good opportunity to trade the DAX, which has got ties to another sort of notorious financial rogue trader. But most of the time, he was trading S&P E-minis.
Okay, and what did he build his bankroll up to while he was at Futex? Like by the time he came to leave there, how much cash did he walk away with?
So he left in about 2008. He'd basically sort of outgrown that sort of model because he was so successful that he was just giving away too much money to Futex, and he was paying commissions on his round trips. And if you're making at that point he was making say $50,000 to $100,000 a day on a good day, he's giving away $5,000 to $10,000 just in commissions. So he sort of got fed up with Futex, and he ended up leaving in 2008 and went somewhere else. And at that point, he had about $2 million built up. But yes, very quickly after leaving, he had his best year during the 2008 financial crisis.
Do you know what he made that year?
Yeah, again, like I sort of detail the biggest trades of his career, if you like, and one of those that I talk about in the book is in November 2008. I think it's the S&P 500, maybe it's the Dow. Was it a record low or maybe a decade low because of everything that had been going on, the collapse of Lehman and all that stuff. And then he decided that he would just take a long position. Unusually for him, he wasn't scalping. It wasn't a short-term position. He just went very big long, and he timed it perfectly. And over the course of the next week or so, he kept adding to his position. And I think US markets went up by something like 19% in a week. And his bankroll went from like $2 million to $11 million. Yeah, over the course of that year.
That's pretty serious.
Amazing. And there's a great quote in the book from somebody else that was sort of sitting near him at the time. And they were sort of saying, a lot of people think it's gambling, but it's almost like the opposite of gambling, because he knew, because all of the press at the time was talking about the fact that the US were going to have to initiate these bailouts and that, it can't be allowed to continue. And so the writing was on the wall. And the analogy that they use is like having two aces in poker. Like, that the market's going to have to go up and everyone's talking about it, but have you got the balls to put everything you've ever earned into that trade? And that's exactly what Nav did. And so he really reaped the benefits, and that set him up to then become the trader that he did.
Yeah. And again, that just sort of goes back to his ability to just take on a lot of risk.
Yeah.
I made note of there was I think it was a quote from Nav, or maybe someone had mentioned it to you, or it came out later in the trial, etc. But something along the lines of, he made the bulk of his wealth in no more than 20 days, spread across his trading career. I thought that was really interesting and something worthwhile highlighting, which kind of ties in here.
Yes. Yeah, so Nav's strategy was principally to go short the market in a falling market, and then get out quickly and keep getting in and out, during highly volatile periods when markets were falling. So if you look, he made his first million was in, I think it was January 2008, during a period of real turmoil. Then in November 2008, obviously, famously, during May 6, 2010, in the flash crash, he made $1 million that day. And then he had his best day in August of 2011. And again, it was like a record fall in markets. Like, markets had fallen 5% in a day or something. And he made, if you can believe this, he made $4 million in his bedroom in a day. And one of the things we haven't really talked about yet, and to be fair, we should talk about, is that it wasn't just that he was sort of brilliant at scalping the market, although he was brilliant at doing that, but he also, by 2009, 2010, had started on this route of really majorly spoofing the market as well.
Right. Let me just jump in here, because that's something I definitely want to get into. But I did want to ask you a question before that. And it was almost like, from reading the book, it seemed like there was a pivotal point where Nav kind of changed a little bit, where he became convinced that he could identify, and he was seeing other market participants that were just blatantly cheating in the market. Can you speak to that a little bit?
Yes. I mean, that was, for me, it was like an amazing find, because that had never been talked about. Nav had never talked about it. It was never anywhere. But I managed to track down that he had an account on one of the major trading forums. And he's quite funny on there. Like, you'll see it in the book, but he's a pretty sort of cheeky, kind of like borderline offensive character to other traders. But at some point in 2007, he basically puts on this trading forum exactly what he thinks of the market, and also exactly what he plans to do about it. But it's quite amazing to actually see it, because it's 2 years before he even sort of built the machine, if you like, the algorithm that he would go on to use to sort of spoof to such devastating effect. He sort of lays out on this forum his plans to do exactly that. And if anyone was really paying attention, maybe they could have stopped him. But
yeah, let's speak about the software that he had developed, because this is kind of where the spoofing, I think, began to come into his trading career, if you will.
Yes.
Tell me a little bit about the software that he had developed, his intentions in developing it. And also, if you could, this is something I found particularly interesting and was quite surprised to actually see this in the book, was the actual functionality of that software he had developed. Like there were several kind of triggers that did certain things. So if you could just describe some of the functionality of the software he had developed and his intentions in doing so, that would be interesting to hear.
It sort of evolved over time. The first sort of iteration of it was something that the US authorities would later call a layering algorithm. And it was pretty straightforward. What it would do is it would place large blocks of orders, like you could specify the amount of ticks away from the current best bid. So he would place blocks of orders, usually 4, 5, and 6 price points away from the current best bid, and they would sit there, and there would be very large orders, like 600 lots on each price point. And then the functionality that he sort of designed and got someone else to create for him was such that every time the price moved higher or lower, this sort of block of sell orders would move in lockstep. So they would never get any closer to the current price and would therefore never be hit. And what that did, in a quite a rudimentary way, is just add huge amounts of selling pressure, to the market. And if you imagine that algorithms are looking and suddenly seeing that the amount of sell orders at those price levels is significantly higher than the amount of buyers or whatever, then they'll react to that. And then simultaneously to doing that, he would also be just shorting the market, waiting for it to go down a couple of ticks, and then exiting his position. So it was almost like I sort of use the analogy of a sort of turbine in the book, but a lot of people are sort of surprised that he could have such an impact, but he would do it for short periods of time. Like he would do it in a burst of 5 minutes or 10 minutes when the market was already falling, and it would just add to the downward pressure in the market. And he would be in and out so quickly that he wasn't sort of relying on the market to fall several percent or anything. He would just get in and out after a few ticks, but he was trading such big size at that point, hundreds of lots, going up over time. It went up, but so that, that's still a very, very profitable strategy.
There was also something about this software. There was all the functionality of it is actually covered in the book. But there was one part where if there was another order added to the queue, his order would increase by 1 lot so that it would send him to the back of the queue. What was his intentions in doing something like that? Because normally the fight is to get to the front of the queue, but he was intentionally moving his orders to the back of the queue and wanted to be last in queue. Was that, again, just part of his intent to spoof the market?
It was, yeah. So basically, over time, the kind of original algorithm that he built becomes slightly less effective as other market participants become more sophisticated, and as HFT, really kind of starts dominating the market. Other participants suss out fairly quickly that if there's this sort of price, if there's a load of sell orders that are like miles away from the current price, they're not going to take that as much into consideration. So Nav realized that in order to really sort of trick other market participants, he needed to place orders right near the current price. So what he then started doing is he invented this thing that he called back of the book, whereby he would place a bunch of orders, usually at 1 or 2 prices above the best bid. And what would happen, as you rightly point out, is every time a new order arrived behind his orders, his algo would automatically increase his order by 1 lot. And because of the CME's system, what that would do is just send his orders automatically to the back of the queue.
Mm.
And because it's such a busy marketplace, by putting that on, that meant that those big orders that were having downward pressure on the market were constantly being sent to the back of the queue and never, ever being hit. And so, again, what he would do is at the same time as doing that, he would enter a genuine short position, wait for the market to sort of tick down a couple of ticks, and then get out again. and switch the algos off. I was lucky enough to speak to some of the investigators that investigated his case, and they said that basically Nav was kind of amazing because he had so many strategies, so many nefarious strategies. So he would do this thing where he would place all these big orders away from the market. He would do this other thing with the back of the book so they were closer to the price point. And he would also do like manual spoofs. So he would flash 2,000 orders just for a second or two. And it was all just designed really to trick the automated algorithmic traders into supply and demand in the market for long enough that the market moved and he could make a small profit.
Right.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stop strategy select Tasty Trade to all involved or sat on the sidelines because your account balance felt too small. Yes, and even the newest IPO. Create your account and start trading with confidence, risk-free.
Before you this, Liam, because you spoke to a lot of people in
itself, from online brokers to commission-free trading. Now, the new era of limited risk trading has begun. Click the link in the description to start trading with Trade the Pools Capital.
Let me ask you this, Liam, because you spoke to a lot of people in putting this book together. From the people you spoke to who were kind of in the know, who understood what it means to really spoof the market, did they say anything about how effective it actually is?
I mean, there's different points of view on that, and I would say that it becomes less effective over time, but it was sufficient for Nav to make a huge amount of money as a sort of bedroom trader. And if you look at if you look at recent news out of the US Department of Justice, they've fined and gone after traders from the biggest HFT shops like Tower Research and Jump. They've got this big case at the moment where all these JP Morgan metals traders are being criminally charged for running sort of spoofing schemes for a long time. You're talking sort of dozens and dozens of traders now that have been criminally charged with spoofing. So I would say that it works. It's hard though. At the end of the day, you've got to have the capital that if you get it wrong, you've got to take that bath. And, Nav did everything he could to sort of mitigate that.
Yeah. And Nav did receive, before the flash crash occurred, Nav actually received some letters or some warnings, is maybe a better word, from the exchange or regulators. Like his activity had sort of shown up on their radar somehow.
Yeah, so one of the things about Nav's story which engenders a lot of sympathy with him is that he felt like not only did he complain on the forum about what was going on in the market and what he was seeing, but he complained to the CME all the time. And to the point where he was like a total pain in their ass. Like he would phone them up and he would threaten them, and he was just so pissed off because he saw spoofing all the time. But because the CME didn't do anything about it, they didn't take him seriously, he just took the view in the end, well, fuck it, I'm going to do exactly the same thing. And he did. And you're right, like they did send a couple of warnings. And then much later in the story, after he's sort of been identified, then, yeah, they did. The CFTC, the actual regulator did start to write to him as well. But it was pretty sparse, to be honest. And I feel a lot of sympathy for Nav because if the CME was doing its job, they would have noticed what he was doing pretty quickly, told him to cut it out. They could have given him a fine or whatever, but they didn't do any of that. And so, he ends up going from nothing to criminally charged.
Yeah.
Because there was just no oversight at that point in time.
Let's jump forward a little bit and speak about the actual flash crash event. So this is the flash crash which occurred in 2010. Let me just ask you this question straight out. Can he be blamed for causing the flash crash?
Almost definitely not. One of the things that I tried to do as a journalist is not overstretch my kind of capabilities and try and sort of get into the data and kind of economic analysis of this, because that's not my field. But what I did do is talk to as many people as I could from all different perspectives, including lots of finance professors, including the people that actually investigated the flash crash. And, there's a very wide dispersal of views. One thing I would say is that at the time in 2010, there was already an investigation into the flash crash. And what they found is that this big US pension fund had placed a massive non-price sensitive sell order into the market in an already extremely volatile day. And that was exactly at the point at which the market began to fall. So there was already a sort of major trigger. And if you look at the macro conditions that day, it was right in the heart of the Eurozone crisis. There was like Greece was, had suddenly received a bailout. And so there were all these swirling conditions that made the markets extremely volatile. And I think the most you can really say about NAV is that he was a big participant in that marketplace. He did place a huge amount of spoof orders that day, but no one's been able to sort of definitively prove that he was a major contributory factor. I think in the book I use this sort of analogy of like, how do you turn around and say what caused the First World War or something? Like you could read thousands of history books and they'll all come up with different factors depending on how they sort of view the world. And I think the NAV was undoubtedly a factor in the same way that anyone that was trading significant size is a factor in a market at any point in time. But nobody successfully sort of demonstrated that without him, there wouldn't have been a flash crash. And for what it's worth, I strongly believe the flash crash would have happened anyway.
Yeah. I mean, markets are such complex systems and there's just so many factors to be able to pinpoint a single cause. I just don't know how you could.
Well, the only thing I'd say on that, to give them, to be fair to the US authorities, they were always quite careful to say he only helped cause or he contributed or something.
Okay.
But inevitably, if you put that in your press release, then he becomes known as the flash crash trader. And, I think that they tried to almost use the flash crash to get more publicity for this case. And they probably didn't need to do that. They should have just charged him with spoofing and included the fact that he was spoofing on the day of the flash crash, rather than sort of pinning the flash crash on him, as you say, which, was very, very hard for them to be able to actually stand up.
Yeah, that makes sense. That large fund, and you speak about this at length in the book, which was selling like billions of dollars worth of E-mini futures that day. And they were using some sort of algorithm to do so, like almost like a volume participation algo would match the volume which was being done up until they'd sold the quantity that they needed to get sold. How did they escape the hot seat through all this?
Well, because there's no criminality for being stupid. Ultimately, it was a really, really dumb trade. As you say, it was entirely volume sensitive, and they didn't put a price floor. They basically just put this order through of like, we want to sell 75,000, I think, off the top of my head, E-minis. And they were going to sell them at a rate of 9% of the volume in the market at that point in time. But obviously volume went absolutely through the roof because it was this sort of market crash. So they were just like selling into a falling market. And there seemed to be no real traders there that pulled the plug and said, hang on a minute, let's cut this order. So they did, they got some criticism for it, and they obviously lost some money. But yeah, they didn't, other than sort of maybe a bit of embarrassment, they certainly didn't face any sort of criminal charges or anything.
Yeah. Before we get into the criminal charges, etc., which Nav found himself up against, this is something I was totally unaware of before reading the book, is Nav actually had interests or investments in various businesses. I don't expect you to talk about all of them, but could you just tell us about one of those businesses which he had invested in? Like, what did he do with his trading profits?
Yeah, so one of the most intriguing elements of this whole story is that Nav never told his friends or family how much money he was making. He's quite a humble, kind of eccentric guy, and he took the view that if other people knew about it, they would treat him differently. So he basically just kept it to himself. And at some point, his accountant notices that he's making millions and millions of dollars and says, hey, Nav, you should meet some of my friends. They can help you invest your money. And so he gets introduced to, it's no exaggeration to say, like a queue of, salivating criminals who basically see him coming. There's this guy who's making vast amounts of money, but has got no use for it, and if you tell him, Nav, we can get you a fantastic interest rate, then he's sort of willing to do it, because on the one hand, he's incredibly gifted at trading, but on the other, he's quite a sort of naive individual. He's not very worldly. And so there's a whole litany of these characters, but one of the main ones is this sort of Mexican entrepreneur called Jesus, who kind of comes into the picture, and he's got this scheme, and he offers Nav and other participants 11% guaranteed returns per year. And if you can imagine, at that point, I think the interest rates, UK sort of base rate was 0.5% or whatever. So it's pretty hard to guarantee someone 11% returns. But this is what this guy did. He's just this kind of amusing character who's got a kind of Russian wife called Ekaterina. He lives in Zurich. He drives a BMW electric car, and he's got a chauffeur-driven town car, and he looks the part. And Nav ultimately, without sort of giving the end away, but ends up giving almost everything he ever makes to this guy and people like him.
How was this guy guaranteeing an interest rate of 11%? What was he doing with the money?
That particular investment was around something called trade finance. So basically, and it might be, this is sort of from memory, but essentially, say you've got a situation where, a country wants to buy a huge amount of coal, and you've got a coal producer, but to actually get the coal to the country and for them to sort of verify that it's the right amount and to actually make the payment is a process that can take several months. So you get these companies that sort of sit in the middle, get things called letters of credit or letters of guarantee from both sides to confirm that subject to these conditions, they will do the deal. And then they kind of step in and put their money in as like a stopgap. And then they'll take a sort of cut of the profits. And so this guy, Jesus Alejandro Garcia, basically told Nav that he was this kind of Mexican wealthy magnate from a family of very successful Mexican businessmen, and he knew governments and companies around the world, and therefore he could make these connections. And so the idea was that all this money would be used to kind of facilitate what they called the global trade of physical commodities. So that was the pitch. But, you and I know that there's no such thing as risk-free returns.